Good morning. It is Wednesday here in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Brian Sazi. We're taking a look at futures here this morning. Let's get in over to the Dow Futures to kick things off. As of right now, we're seeing a little bit of a move higher by about 0.5%. Nasdaq Futures, you're also seeing that in positive territory, largely reflecting some of the earnings that we're keeping an eye on. 1.5% higher there. And then the S&P 500 futures also in positive territory. And Saz, if we take a look at the heat map, especially for the Nasdaq 100, those are some of the pre-market moves that we're going to be keeping an eye on and breaking down some of the earnings around too.
Yeah, this is a bizarre week so far. We had that big Walmart warning yesterday. You come here today, you're hearing Microsoft, Google talk about on their earnings calls last night, weakness in small business, weakness in YouTube. We'll talk more about that, but still surprising to see this market action here in the early going. Now, here are three things you need to know right now. Another rate hike incoming. The Federal Reserve is expected to announce another 75 basis point interest rate hike today as white-hot inflation continues to climb. Let's head to D.C., where Yahoo Finance's Brian Chung is standing by ahead of today's announcement. Brian, really enjoyed what you wrote about the Fed meeting today in the morning brief newsletter. Walk us through it.
Yeah, well, it's kind of like landing a plane, what the Fed is trying to do this morning. But, of course, all eyes on that 2 p.m. announcement. So let me just break down what we need to watch for as the Fed tries to land that plane. Let's call it our FOMC3, the three things I'm watching. The first thing that I'm watching, 75 basis points, right? I mean, we didn't know what was going to happen before the June meeting when they abruptly moved to 75 basis points instead of the message 50 basis points, although markets are getting the message that the Fed unlikely to do a last-minute switcheroo because market pricing around 75% chance that they'll follow through on another 75 basis point hike, which brings me to my number two question. That means that interest rates would be somewhere around 2.25% to 2.5% if they follow through on that later on. The next question is, can we get much higher than that? The question is, how much higher does the Fed need to raise rates before at some point maybe a recession forces them to start then cutting rates? Now, you have a lot of estimates on the street. Goldman Sachs saying 3.5%, Deutsche Bank saying 4.1%, the Fed itself messaging at the end of the last meeting that it could be as high as 3.8% next year. No one really knows. We're going to have to hear from Jay Powell in that press conference at 2:30 for what he says could happen in the next few meetings. But of course, my number one question is not about the nuance of the number or the neutral rate. It's really all about the R-word recession. That's going to be the big focus after we get that print on GDP, which won't happen until tomorrow morning. 2 negative quarters of GDP, does that constitute a recession for the Fed? Does that definition matter? That's something the Fed chairman is going to have to answer. We'll have the press conference at 2:30, statement out at 2 p.m. We'll have all of that coverage right here from a very hot Washington, D.C., guys.
I should have known that we could count on you for a Kanye West reference as well here with Can We Get Much Higher there, Brian? So, even as we're going into the announcement, but then additionally the press conference, as you mentioned, what's the question that you want to get through to the Fed and to Federal Reserve Chair Jerome Powell?
Yeah, well, I think the big question is, what does the labor market look like right now? Of course, we're all concerned about that 9.1% inflation read that we got in the month of June on a year-over-year basis. But the real question for the Fed in trying to avoid a hard landing as they try to land that plane is avoiding any sort of substantial uptick in job loss. Now, right now, the unemployment rate is very low. It's, in fact, right essentially back where it was pre-pandemic. But the Fed is a little bit worried that as it starts to hike interest rates, as company margins get a little bit smaller, do companies then start to have to lay off their workers? If that happens, that could really accelerate the downturn that people are worried about. Could unemployment take up to 4%, 5%? Maybe even higher than that. Some economists are saying that's what's necessary to take inflation and economic activity down. So I think the big question is, are you starting at the Federal Reserve to see any sort of job loss? Is that a concern that says maybe this plane might have a bit of a bumpy landing?
Brian, how closely do you think the Fed watches corporate earnings? Because like we mentioned at the top, you had Walmart come out here and warn about a consumer spending slowdown. Microsoft, Google, I would say they warned on their conference calls last night. It is not pretty right now in corporate America.
Brian, I'm not going to ask Jay Powell about what he thought about Walmart earnings.
You should.
I mean, I could try.
You should.
But
That's
I don't
the
know
question.
If he's going to bite on that one. Hey, look, at the end of the day, I think you're right. I think he is going to be paying attention to corporate earnings because, again, the part that I just described, those large employers, and they've actually gotten larger in terms of the employment base of America over the course of the pandemic, they are going to be so critical to that question of how many people are going to have to lose their jobs to take the economic, kind of pace that we've been going at post-pandemic down a notch that would take inflation down as well. Now, the Federal Reserve, for its part, says we don't have to make that trade-off. And the reason why is because the high demand incentivized a lot of these companies to put more job postings out there. maybe in many cases they never filled those job postings, right? You see the JOLTS data showing continued elevation in the amount of job postings that employers simply can't hire. Maybe they just take those postings down on LinkedIn or Job Recruiter or what have you instead of start to lay people off. But again, you're hearing anecdotes. You look at Shopify just yesterday. You're looking at in the big tech sector, a lot of other layoffs as well. Maybe that's already starting to happen.
Yahoo Finance's own Brian Chung, he's going to be tracking all of the movements from the Fed that comes out today, as well as throwing a few questions their way a little bit later on during the presser. Brian, thanks for joining us here this morning in Washington, D.C. Let's switch gears. We were talking about earnings. Let's talk about big tech earnings. They're on tap this week. Alphabet and Microsoft, they joined the chorus of companies warning of trouble on the horizon. And both companies reported earnings after the bell yesterday. Right now, you're seeing Microsoft here pre-market trading higher by about 3.7%. Alphabet, Google, that's moving up by about 4% right now. Let's start things off, though, with Microsoft, because there were a few things to really call out here. And we previewed this earlier on this week and talked about how this would really be an earnings period for tech, circling around ads and clouds here. And we got just a little bit of both of that for Microsoft. And for the cloud strength that they said that drove a lot of the fourth quarter results here for cloud specifically. And they say even more opportunity helping every customer using some of their cloud solutions here. But I think most notably, they saw strong demand. They said they took share. They increased their customer commitment to the cloud platform, and commercial bookings grew 25%. Cloud revenue, $25 billion, up 28% year over year.
I'm surprised. Again, this is another report. I'm going to keep using Walmart throughout the show. That's just the market reaction is really surprising me, because that conference call last night from Microsoft, and we'll mention Alphabet in a second, was not that great. Here's Microsoft first. We showed that chart of Microsoft's cloud business, Azure. You can see a slowing growth rate sequentially in that mighty cloud business of Azure as recession fears mount. You heard Microsoft talk about a slowdown in small businesses. I heard that same tone when I was at the Goldman Small Business Conference last week. Small businesses are a key business for Microsoft, and they are under a lot of pressure right now with slowing demand and high levels of inflation. What the market is probably hanging its hat on here, and you see Microsoft shares up in the pre-market, is their guidance. So for the next 12 months, Microsoft outlined double-digit sales guidance and double-digit operating income guidance. Now, we have to put an asterisk next to that profit guidance, because that includes a new way of accounting for Microsoft depreciation. I hope you didn't tune out, because it's really, really boring. But still, it's going to be a big profit boost for Microsoft over the next 12 months. But still, I think the market hanging its hat on that. Not as bad guidance for Microsoft.
You know, there's so many things that you get out of Microsoft earnings. You get the B2B relationships on the cloud front and on a lot of the different solutions that, of course, they've put into pretty much every type of workspace. But then additionally, you get that consumer front on the discretionary spending for some of the individual technologies, the consumer technology. You get the spending on some of the gaming side of the business. But then additionally, we're starting to get even more, and perhaps this is the good segue into Google, is on the advertising front. Microsoft made a very key acquisition of Xandr, and that just closed last month. They talked about this on the earnings call. They have a new partnership in Netflix. Netflix, of course, moving forward with their ad-supported tier and choosing Microsoft as their exclusive technology and sales partner there for their first ad-supported subscription offering. And so that particularly is something to keep an eye on, because advertising revenue right now for Microsoft, it's in search, it's in Bing, if you want to talk about Bing. It's also in LinkedIn, and LinkedIn contributed this quarter. But I think moving forward here, it's going to be this battle of the demand side platforms in a Microsoft versus a Trade Desk out there that had really been that DSP provider for so many advertising campaigns to really go to a marketplace and just bid in an open market for some of those ad insertion orders as well.
No, it's very important you brought it up, because now we always talk on the show about connecting the dots with investing. Yeah. Really bad quarter from Snap last week. You had LinkedIn ad weakness in this quarter from Microsoft. You had YouTube ad weakness sequentially over at Alphabet. All the ducks are in line for a potentially challenging quarter for Meta when it reports very soon. And not just a challenging quarter, also challenging outlook. But let's just go on Alphabet here. Jefferies analyst Brent Thill, friend of the show, really noting out several macroeconomic concerns that Alphabet highlighted. First, to your point, a slowdown in YouTube revenue because of a pullback in ad spending. Travel demand, a little bit of weakness there as well. Also weakness in other revenues as businesses pull down various sides of spending. So look, here's Alphabet, here's Microsoft warning about the state of the economy. Market doesn't care, but maybe it should.
Yeah, traffic acquisition costs. So basically what they pay to get a lot of that traffic to their websites, That was up 12%, hit $12.2 billion. That's something that really factors into the overall services revenues, where they factor in some of the search and advertising revenues. That came in at $40.7 billion. And this is still largely for Alphabet and advertising business. Still runs away with just about 80% of their overall revenue on a quarter by quarter basis. And so thinking through that and where they're seeing that even start to slip up a bit because of the traffic acquisition costs that they have to put out, that's something worth keeping an eye on in going forward quarters from here. And here's why: because of something you mentioned, and they had to acknowledge on the earnings call for Alphabet, the quarter over quarter deceleration in both YouTube and on network advertising revenues. It primarily reflects the pullbacks in spend by some advertisers. This is something that we're going to continue to hear even as we get into Meta, the parent company of Facebook, into their earnings to see exactly where the companies are still spending on advertising spend as they're restructuring their costs.
From tech to food, it's not just guac that's going to cost you extra at Chipotle. Now, the fast casual chain announced it is raising prices again in August. This after Chipotle raised prices in the second quarter to spur profit growth despite a pullback in visits from lower income shoppers. CEO Brian Niccol isn't losing sleep over the loss of customers, though, saying on the company's earnings call that the majority of its customers are higher income households. So interesting here. You have Chipotle pushing through more price increases in August. That's what they do. They have historically been very measured in price increases, but looks like now that floodgate is open. And now they are, I think, going to really be tested to see how much value the consumer sees in their product. Now, by and large, Chipotle has been able to pass through price increases very successfully. And you're seeing that being rewarded, I believe, in the Chipotle stock price here this morning. The market really likes to hear these August price increases. But how much are you willing to pay? And I have a graphic here. Last night, I ordered Chipotle. There is my bill. Yes, I got double.
Wow.
I got double steak. I got double chicken. I get it. And I got it delivered, so I have to pay an extra fee. But my 2 salad bowls cost over $60. And sorry, folks, my credit card number is not on there, so don't even go try to screen grab it.
Did you house both of those salads?
Yes, that is my dinner. That's what I eat. I can eat large quantities of food, but still over $60 for my 2 salad bowls. I think the extra meat was $6.90. That's tough. And I love Chipotle, but I am now at that point. Do I cut back on a bowl?
Yeah.
Do I just not go to Chipotle as much? I'm at that point right now.
You were part of the digital sales, no?
Yes.
They honestly, and our producer Alex is saying you're a cheap tipper, though. But
that was 15%.
It was 15%, yeah. Well, the operating margin that they see at the restaurants right now in this most recent quarter, 25.2% here. And this is noteworthy because at a time where they are going to still filter through costs to the consumers, keep a close eye on the margins going forward from here. This was an increase of 70 basis points. But for me, who has been a longtime Chipotle customer, I've started to pull back on how much I spend at Chipotle, and I've noticed this year over year, and I can go all the way back to what I remember spending for a burrito in college, which was $12. Now, it's like 15. You can't get out the door without paying $15 to $16 for a burrito.
Right, and maybe consumers are starting to realize this. Yeah. So Chipotle did note in the conference call, same-store sales early on so far in the third quarter up mid-single digits to high single-digit percentage. So traffic may be slowing down a little bit as consumers bump up against those price increases, but still, we'll talk more about this with Chipotle CFO Jack Hartung later on the show. And Alex, I'm a very good tipper, okay? That was 15%. That was very good, okay? I'm just going to leave it there.
We'll have to get
I'm a very good tipper. Ask anyone.
The update on the guacamole attachment rate, we're going to have to get that too later on with Jack. Everyone, coming up, we're going to take a deeper dive into Alphabet earnings with RBC Capital's Brad Erickson. That's coming up next. Welcome back, everyone. Continuing our coverage of the big tech earnings this week. We've got much more help now joining us to break down those Alphabet earnings. Brad Erickson, RBC Capital Markets Internet Analyst, entering the chat here. Brad, first and foremost, want to get your takeaway from what you saw and what this kind of shapes up for the rest of what we may hear for big tech.
Yeah, so this one's pretty interesting, actually. So I think what's going on effectively is clearly we're headed into some magnitude of an advertiser pullback. Obviously, the management spoke to it last night. And then, of course, Snap last week really gave us indications that that's going on. I think at this point, where it's a little bit challenging with Google in particular is that they don't provide us really any sort of quantitative Q3 guidance. And so we don't really know the real magnitudes. Our channel work we've been doing for the last 3 months suggests that about a quarter of advertisers, SMB, small and medium-sized advertisers, have in fact pulled back. So the magnitude is real, but we're not really going to get sort of more fulsome indications of that until Meta reports tonight. So,
Brad, given the concerns that were voiced throughout the earnings call last night, are you surprised by the market reaction here?
Not totally. I think there's a couple things going on. One, obviously the writing's on the wall that we're headed into some level of downturn, right? And again, after Snap, people got really freaked out last week that the whole ad market is imploding. I think if you look at Google's results, just take purely search ad revenues for Q2 alone, things looked pretty good. And so from that perspective, definitely better than feared. Secondarily, I think as we zoom out just from tech into the broad, say, S&P 500, there's very, very few names that are such high quality that you would want to own before you'd own Alphabet. So I think those two things are kind of working for the stock here this morning.
We heard Microsoft talk even more about what their advertising ambitions are. What do you make of this finalization of the acquisition of Xandr, early partnerships, and what kind of contribution that could actually provide to the business?
Yeah, so I can't speak for Microsoft, obviously, because I don't cover the stock, but certainly they're clearly looking to become a bigger player. I mean, they started this years ago with the acquisition of LinkedIn, which their business has done tremendously well, we think, through COVID, and then obviously, yeah, with the acquisition of AppNexus, now Xandr, certainly getting themselves into more in the ad tech space here going forward. So yeah, could definitely be a share gainer. I think the debate has always been 70% of the ad market is kind of the walled gardens, right? The Googles, the Facebooks of the world. 30% is what's referred to more as the open internet. So obviously where Trade Desk, a name you mentioned earlier, tends to play. Certainly, I think the view is that they can gobble up more share and potentially drive more share in that 30% bucket here going forward.
And Brad, interesting nugget on Alphabet. So buybacks were $15.2 billion in the second quarter. That was the highest ever for a quarter, up from $13.3 billion in the first quarter. What signal is that sending to you?
Clearly, management thinks the stock's undervalued, but I think more importantly, just longer term, it highlights the fact that this management team is clearly very committed to returning capital to shareholders. This business generates a ton of cash, and we think will generate even more cash in the future. So, yeah, I think just easily signifies that this management team is going to remain committed to lowering that share count, returning capital to shareholders.
With regard to Alphabet, they had talked a lot about YouTube and the time spent on the platform, trying to give more metrics about how it's competing with its offerings from YouTube TV all the way into the ability to have more people spend time on shorts. And so with all of that in mind, everybody's still chasing after that new type of consumer that is spending more time and engaging more on TikTok. And so what's the best way forward for YouTube to be able to be that contributor to Google or to Alphabet that it needs to be in this broader competitive landscape?
Yeah, it's interesting that there's definitely a shift going on, not just on user engagement, but I think in the future as to how advertisers will monetize through that new surface, which we call short form video, which is what TikTok sort of invented, and then now everyone's trying to sort of do their own replication of it. I think where Google is especially probably well positioned long term, we can talk near term, but longer term, Google's pretty well positioned in that, they came out with this product called Performance Max. Basically what Performance Max is you're an advertiser. You don't quite exactly know where you're going to optimally spend your ad dollars, but you're effectively leveraging Google's AI to distribute your ad dollars across search, across YouTube Shorts. I I think where we're still sort of in discovery phase, the ad industry is in discovery phase, is around short form video. TikTok is clearly capturing the hearts and minds of America's youth increasingly, but secondarily, advertisers don't still quite understand how content will monetize on in a short form environment as opposed to stories or a news feed where they have a lot of history over the last decade. So I think that's still very much in a discovery process, but we do believe over the longer term, between Google's 1P data as well as options like Performance Max I mentioned earlier, they're going to be really well positioned to sort of efficiently allocate as many of those dollars as possible.
I think I'm in the wrong gig, Brad. I should be creating cat videos for TikTok, but we'll take that offline. Brad Erickson, RBC Capital Markets Internet Analyst. Good to see you.
Thanks, guys. Have a good day.
You too. Coming up, the storm that is earnings season is in full swing. We're back with analysis next on results from Spotify, Texas Instruments, and a few others. Don't go anywhere. Welcome back to Yahoo Finance Live. We're a few minutes away from the opening bell on Wall Street. Wall Street eagerly awaiting the Fed's decision on interest rates later on today. But first, we must deal with a barrage of earnings reports. And Brad, let's start with Texas Instruments. Another response here in the pre-market that I find surprising. I'm locking in on this Citi note on Texas Instruments quarter, calling out, rightfully so, they mentioned weakness in the PC market. This is something you have been tracking. We've been talking about at length here. Another tech company warning about weakness in PCs. Heard that from Microsoft too as well. Also, Citi calling out weakness in profit margins sequentially and warning that a correction in Texas Instruments fundamentals are likely to be coming soon. But again, the market appears to be looking at the earnings beat, but not necessarily digging beneath the hood and looking at some of these concerns.
Microsoft, Intel, HP, all of them citing in tune a PC weakness. And so with that slowdown and potentially here with Texas Instruments, especially as they have leaned more into, of course, many of us know them for perhaps their TI-84 calculators that we used growing up. Everybody's raising their hands there, owned a few. But as you think about all of the other elements that they infuse into your car experience through semiconductors, everything that may even operate just the lights that are going on in the car. And so all of these things considered, it's going to come down to the production capacity, them being able to service some of those longer term contracts. And I think that's exactly where much of the growth opportunity still lies for this business. But as of right now, they're also saying that revenue in this most recent quarter, that had increased 14%. It should increase if you're seeing the type of strong demand across the semiconductor landscape that is present. And so that's something potentially to keep in mind. But this third quarter outlook, that revenue is in the range of $4.90 billion to $5.30 billion. And then earnings per share, they're looking for that to come in at about $2.23 a share, and the top end, $2.51 a share.
I have to knock this company again, though. It would be nice to hear from Texas Instruments CEO Rich Templeton, again, not on these earnings calls. I don't know if this is I'm unsure. It's unsure if this is a historical practice for this company, but it would be good to hear from the leader of the company in an environment that is, in fact, so uncertain, especially when you see margins under pressure sequentially. But you mentioned that calculator. I recently bought a new TI calculator, and I went to I like using calculators, so I went to go put the batteries in it like I did in high school. There were no batteries. You charge it up with a USB cable now. You want to feel like a boomer. That's the moment.
That's the new thing that they're doing with some remote controllers as well for television sets. You buy a new Samsung television, some of the controllers, you just charge it. You're not changing out batteries anymore.
That is bad for the Energizer Bunny. Well, I felt very, very old because we always went through batteries through those $100 TI calculators. This one you just charge up.
Absolutely. We're keeping a close eye on the major averages as we get closer to the start of today's trading session here on the day. Of course, the big thing in focus here today is the Fed and Facebook a little bit later on, or Facebook parent company Meta. But as we've been tracking, you're going to get a little bit of everything in today's show. You're going to get the Fed for sure. We're going to continue to discuss that. You're going to get even more of the lead up to Facebook earnings, especially with all the tech earnings that have come out. And then even later on, we've got a little bit of that guacamole attachment rate with the CFO of Chipotle. We'll discuss that. But I think as of right now, for the markets, futures still pointing positive, and the expectation, 75 basis points, that's off of that 100. So relief is perhaps in sight and in play as of right now.
Yeah, relief. And I'll go back to what we were talking about yesterday. Be mindful of rooting for this bad news is good news for the markets, because that can go up in smoke very, very quickly. And the bottom line is that earnings season so far has been a struggle. We've seen some earnings beats. It hasn't been a disaster scenarios, but still, you dig really into these companies. Weakness in small businesses, inflation that continues to impact profit margins, price increases that are not offsetting inflation. There's a lot of headwinds that in many cases, they're getting worse.
But we've seen beats on lowered expectations as well. Even for companies that have reduced their guidance, Microsoft had to come out weeks ago and reduce their guidance and trim some of the forecasts due to FX. FX has been at play here, and so that's something that we're going to continue to track going forward. We're also tracking the opening bell on Wall Street. Here's a look at the NYSE. All right, really diversifying the camera shots here at the New York Stock Exchange over the past couple sessions. Taking a look there at the opening bell where Splash Beverage Group is ringing the opening bell there.
Water? They sell water? No, I'm just unclear. I'm guessing they sell water.
I mean, it said vino, so
Splash.
I mean, water's been turned into wine before. Why can't it go back? Well, anyway, taking a look at the opening here, Dow Jones Industrial Average, you're seeing that open higher on the day by about 0.4%. S&P 500, you're seeing that pop at the open by about 0.9%, 36 points in the green. And the Nasdaq Composite, that's up by about 1.7% for the tech-heavy average. No doubt on the back of some of the earnings reports, we're seeing those shares for Microsoft, for Google move higher, for Alphabet rather, move higher. So we'll see if they hold on to these moves here as we've begun the trading session. We're also keeping a close eye on shares of other earnings-related companies that have come out this morning. Consumer packaged goods, Mondelez reporting a rise in revenue from chocolate growth, while Kraft Heinz sticking with its price hikes as it sees demand drop here.
On a Federal Reserve announcement day, very important. Let's lock in on what both of these companies are saying in terms of price in North America. That's our market. That's where we live. That's what we're focusing on right now. So Mondelez came out and said they raised prices by 10.2% in North America in the second quarter. Volume down 1%. So another way to look at that is consumers are balking at some of these price increases. That is a similar message than what we heard from Kraft Heinz this morning, noting that in the North America market, they raised prices 13.1%, and their volumes declined 3.3%. So overall, I would say a still very inflationary environment impacting both of these companies. Kraft Heinz warning high levels of inflation are continuing in dairy, packaging, and transportation. And that's why they're taking a little bit more cautious tone in their outlook. You're seeing shares get hammered there in the early going.
I know we were focusing on the U.S., but for Mondelez, some of the growth that we had seen internationally, especially in Latin America, up 31% versus the prior year. Massive growth there. And in the emerging markets, that's really running away versus the developed markets there. Emerging markets growth, perhaps something to keep a close eye on, as we've seen that to move higher by about 22.4% over this most recent quarter versus the prior year. And so perhaps that's exactly where they see some of that expansion opportunity, especially in the snack category right now.
All right, from snacks to travel, Hilton earnings are out with a rising outlook on spiking travel demand. You're seeing Hilton shares pop here in the early going, up close to 5%. And I would say, finally, that is a justified move in response to earnings. We've been talking about all morning long how a lot of these earnings reports are seeing pops. Maybe they don't deserve it. Hilton deserves it. RevPAR, revenue per available room, a key industry metric for the hotel industry, up 54.3% year over year. You saw occupancy gains strongly across all of Hilton's brands. You had them also come out here and say, voice confidence in continuing to buy back stock. We saw the similar type of move here by Alphabet, but by and large, good a quarter from Hilton, likely one coming in a few days from Marriott as well. And later on, we'll talk to Hilton CFO Kevin Jacobs all about it.
Two things, and this totally makes sense to what you were mentioning a moment ago because of what we've also heard from other players within the travel space. Even as Delta CEO Ed Bastian was telling us about how they're not reducing fares actively because the demand is there and they have the opportunity to lock in certain revenue rates as of right now. The same thing is going to be the case for the accommodation space. As long as there is the demand that is still set in place that customers are not balking at, then they're going to say, all right, well, that's the rate that we're charging. And I think going forward from right now, it's going to come also back down to the number of rooms that they continue to add on in capacity. They added on, I believe it was 14,400 rooms to their system during the second quarter. That contributed to 13,300 net additional rooms in Hilton's system during the period. And so moving forward from here, it's going to be about the capacity. It's about where we see even more of the travel spending remained intact, because a lot of the travel spending this year, let's be real, it was revenge travel spending. And so if that remains the case, depending upon where the pricing strategies and mechanisms are, that's in this shift from goods to services where Hilton has been a beneficiary. But question is, does that continue to be the case?
I'll just add quickly, you mentioned rooms. So they now have, Hilton, 23,400 rooms in development. That is huge. That is an acceleration from what we saw in the second quarter from Hilton. If they believe demand was going to fall off a map, they're not putting that type of number into the development pipeline. I mean, that is a huge, huge number.
Yeah, absolutely. We're going to continue to keep track of shares of HLT. We're also tracking shares of SPOT, S-P-O-T, Spotify reporting earnings with total users and revenue beating earnings estimates. Yahoo Finance's Ali Canal joins us now to discuss. Ali, what do you know about Spotify and what they've reported here today?
Well, Spotify, we've seen a wider loss than expected, but it really is that beat on revenue, that beat on subscribers that seems to be driving the stock higher. It was up as much as 10% pre-market on the heels of that report, but now we're seeing it nearly 13% since the opening bell. So pretty strong quarter overall, revenue coming in at $2.91 billion versus the expected $2.85 billion. Again, that adjusted loss wider than expected, 86 cents a share versus the estimated 72 cents. But total monthly active users, that is increasingly an important element for a lot of these streaming companies, 433 million versus the expected 428 million. And those net additions of 19 million, they represented the company's largest ever growth in Q2. So that's pretty significant there, and expectations set even higher for Q3. The company says it expects to add 450 million users. But guys, this company is not profitable. Okay, we have a wider reported loss than expected. They are spending like crazy, especially on a lot of these podcast deals. A reported $200 million deal with Joe Rogan. The vibe I'm getting is that they're really doing the long-term play here. They are telling investors, stick with us. There's going to be a lot to come with podcasts. Daniel Ek said during the Investor Day that the podcasting unit could generate 40% to 50% in margins, but we'll see if that actually happens. So it's a long-term play here, I think.
Worth noting quickly, Spotify, third hottest ticker page on the Yahoo Finance platform. But to your point, Ali, and it is a correct one, at what point does this company consistently make money? It looks like the market is focusing on better than expected user growth, but at some point, they have to make money on these podcasts. These investments in podcasts, we just heard from them at a key investor day earlier this year. They need to start making money from this stuff and soon, especially now after the stock is up 13%.
Yeah, and I do think it's a positive thing that they're moving beyond just music, introducing podcasts, audiobooks, other types of formats. That's all good. But to your point, they do need to make money. They do need to start being profitable, showing some better things on the balance sheet. And until then, I think investors are going to be waiting, but it's a question of how long are they going to wait before they start to get a little bit.
We might all be retired by that time.
Exactly, right? But the stock is doing really well. So investors, for now, are happy with where things are at.
All right, investors might be leaning into that advertising revenue. That grew 31% during the quarter, year over year, 13% of the total revenue right now. So we'll see how they continue to evaluate.
Especially with the recession too, that could be there could be a pullback there. So we'll have to monitor and see how things go.
Yahoo Finance's own Ali Canal joining us here to break down Spotify earnings. Coming up, everyone, stocks, they're looking for direction ahead of the Fed's rate decision. But it's the press conference that's going to grab attention over the New York Stock Exchange. We go next. Welcome back to Yahoo Finance Live, everyone. Taking a look at the major averages. Right now, we're holding on to gains across the board. Let's get on down to the New York Stock Exchange, where Yahoo Finance's Jared Blickery is standing by. Jared?
Let's go straight to the Wi-Fi Interactive. Usually on these FOMC days, we see a little bit of drift, but we're getting some upward thrust right now. And I want to show you a picture of the 2-day price action in the Nasdaq composite. And you can see we are right back up to the unchanged line, just slightly in the green here. So I guess my big takeaway is this is what happens in a summer when there's not a lot else going on. We have tons of news, but not a lot of traders actively trading. And so it's important to realize that a lot of these moves don't necessarily have momentum in either direction they're going. I said yesterday, I had a little bit of a warning. I didn't want to be dire, but this comes down to what I think is a coin toss, 50-50. This market could rally 20%, it could tank 10% in the next few weeks. Today we're seeing the mega caps getting some nice love here off of those Microsoft and Alphabet earnings. Interesting to see the initial direction yesterday on Microsoft was down, but here's one thing that's really getting my attention. This is the 10-year T-note yield, and this chart has me a little bit excited here. This is a giant head and shoulders formation. I'm trying to draw it on here. We'll see if the Wi-Fi Interactive can catch up with me, but if this breaks to the downside, we could see a huge, huge risk-on rally. The question is, when would that happen? Now, this could take some time to complete, or it could happen today. So interesting to see everybody waiting for that negative GDP print tomorrow morning, guys.
Jared, staying on the markets, of course, Cathie Wood looks to be making some power moves on Coinbase.
Yeah, she's selling out of Coinbase, sold 75 million shares, and this comes as the company is under investigation, a probe for selling securities. And guess what? They're selling tokens, but those are classified as securities by Gary Gensler. I think that Gary Gensler is going to end up regulating the entire industry, especially the exchanges, and it's going to look a lot more like Wall Street than DeFi. So the handwriting is on the wall here. These guys are going to pay a massive fine, and they're going to be heavily regulated. And all these scams that have been perpetrated over the last few months, if not years, a lot of that is going to come to a screeching halt.
Beware of those 20% declines down there, Jared. Hang tough. We'll talk to you later. All right, we have a chart of the day for you today. One I know Brad is very excited about. Lululemon launched its first ever sneaker line in March called the Blissfeel. Judging by Google search interest, consumers have responded with a collective yawn at Lululemon's attempt to take on Nike, Under Armour, and Adidas. You can see on that nifty chart from Jefferies that search interest for Blissfeel has not only been really low, it has continued to drop since the product's launch. And Brad, I guess I can't say I'm surprised because you walk into these stores, you can't necessarily find the product. There hasn't been a lot of marketing. And I'll double down on my call. I think the shoes look ugly.
It's a walk, don't run scenario right now for Lululemon's footwear. And it's something that they've said before on the earnings calls. They've alluded to it. They've said, we're not going to pay to fly in footwear, especially given some of the global supply chain constraints that they've been monitoring within their own entry point into the broader footwear category that I would argue on even the reseller upper end of the side and even on the performance category, they're seeing a little bit of the slowdown because of the consumer discretionary dollars that might be drying up even among some of the most popular footwear out there. So where does that leave this entrance into the market for Lululemon?
So to be clear, you haven't seen any of these Lululemon sneakers yet on StockX?
No, I have not.
No, of course not. Probably not.
I guarantee you that.
I guarantee you that too. All right, straight ahead, Chipotle. Chipotle shares are on the move following a better than expected quarter. The company also said it would take a price increase in August to help offset inflation. We'll chat all about it next with Chipotle CFO, Jack Hartung. Seeing the bulls eat up shares of Chipotle today, I should say devouring, after the Burrito King revealed a better than expected quarter. But the company did warn that sales slowed down a touch to kick off the third quarter as consumers pinch pennies with recession fears mounting. Let's dive in here with friend of the show and Chipotle CFO, Jack Hartung. Jack, good to see you here. I think the market's locking in on what you said about pricing. Taking another price increase in August, how much is that increase, and do you think consumers will start to push back a bit?
Yeah, we're looking at about a 4% price increase in August, Brian. And listen, inflation continues. And, what we're seeing is the next wave that we're going to see into the third quarter is going to involve beef, dairy, packaging. And we're still seeing waves of wage pressure as well. We took that big increase where we took our wages up more than 15% over a year ago. That brought our wages to a $15 an hour average wage. But we're still seeing pockets where we have to increase wages beyond that as well. So inflation is here to stay, or at least for a while, it's here to stay. The good news is we have pricing power. And so we have the ability to raise prices. That's not what we love to do. But when the inflation keeps coming at us and it doesn't look like it's going to abate in the near future, we will have to take price from time to time. As
I mentioned at the top, Jack, consumers are in a tough spot right now, especially lower income consumers. Have you started to just parse your data to see who is coming into the restaurants and who is buying what and who is not buying it?
Yeah, when we stratify our customer base, we did see a slight slowdown during the quarter. We're really seeing our upper income consumers, those at $75,000 or more, have not changed their buying habits. They're coming just as often, if not more often, and they're spending just as much, if not more. Where we're seeing a little softness is under $75,000, and it's understandable. I mean, when you're paying double or near double for gas, compared to what you paid last year. Vacations are more expensive, groceries are more expensive, everything's more expensive. At some point, the consumer has to pull back a little bit, and it's unfortunate that we are seeing that. Luckily, our consumer base does skew towards more upper income consumers. About 60% of our customers are in that $75,000 and higher income bracket.
Jack, to your point, I mean, I've even pulled back some of the levels of spend, not just at Chipotle, but around a lot of the lunch or dinner experiences, especially in cities like New York. But when you think about the different cities and the different pricing mechanisms that you have to your advantage, what do you kind of look out to in the future to say that the customer can either continue to take on costs in one part of the menu, or whether you're going to actually, and they were able to pull how much I spent pre-2022 versus during 2022. Look, I've pulled back a little bit here. So, what are you looking at within the customer to define exactly where they're going to be able to continue to take on costs?
Yeah, the main thing that we look at is what is a Chipotle meal, what does it cost compared to other competitors? And when we look at Chipotle compared to others in the fast casual, sector, we're still underpriced. Every competitor we look at, whether they're in the Mexican category or they're in the salads, but they have a food ethos, they're much, much, much more expensive. Even after this price increase, you can get a chicken burrito. More than half of our customers get a chicken burrito or a chicken bowl for around $9. Now, that's on average. In New York, it's going to be more. In the middle of the country, it's going to be less. But on average, it's still going to be around $9. It's really hard to find a meal anywhere in fast casual for less than 10. It's getting harder to find a quality meal with real ingredients like you find at Chipotle and real culinary like you might find at Chipotle for less than $12 or $13. So that's the thing that tells us we're still underpriced based on the culinary we provide, the food with integrity we provide, the customization, and then the speed, whether you're coming through our digital channel or you're coming in the restaurant, and we provide great throughput. So that's the main thing we look at to make sure that the meal we provide at Chipotle is still a delicious meal that our customers love and at an affordable price compared to any other alternative.
I always find it fascinating to get an update on the rewards members. You've got over 29 million. I believe that's 1 million net add during this most recent quarter since the last time we checked in with you, at least at about 28 million. And so with regard to that, what are you noticing in the spend levels from those rewards members? Are they spending higher, or are they being driven by some of the menu innovation items that get added onto the menu?
Yeah, well, listen, our customers that are in loyalty, they come more often, they spend more. And I'm not just talking about them joining the program because they're already a frequent customer. After they join, even frequent customers come more often. After they join, even medium frequency customers come more often, and they tend to spend more. Now, there are a few cohorts within that group. And again, it would be more the lower income cohorts, who have pulled back a little bit. But as a group, the loyalty members, they do love trying our new menu items. They love coming more often. The more they come to Chipotle, the more we have a personalized message to them where they learn more about new menu items. In fact, one of the things we're doing with every loyalty member on National Avocado Day, they're going to be able to buy either guacamole or queso for just 1 penny. So there are rewards like that where we'll surprise and delight to make sure our customers love being part of the program and love coming back to Chipotle.
Jack, I want to highlight something you guys said on the conference call last night. You said, quote, "We are exploring an automated real-time kitchen production system." Now, I know you guys to cut all your vegetables, cut all your meat, and grill it accordingly. I mean, are you going to start turning these locations into scary-looking McDonald's internally just to meet the demand you're seeing?
No. Rest assured, we still value real culinary. We still value real ingredients coming in. So whole onions, whole avocados, mashing by hand. But there are some tasks in the restaurant that, our crews just don't love doing. And, one of the things we're experimenting with is a automation called Chippy, and it will automatically fry our chips. Frying the chips, it's really hot. I mean, the crew is standing above a hot fryer for a number of hours to fry these chips. And so if we can take a task like that and bring automation along with the employee experience, it makes the employee experience better. They can focus on other culinary in the restaurant. They can focus on customer service related items like that. But the easier choice, Brian, that would have compromised our culinary, we won't do, is we could have the chips made offsite and then brought in a bag. We won't do that, but we will look for automation that's going to allow us to continue to make fresh food in the restaurant and then enhance the employee experience.
All right, going to have some up-in-arms employees if Chippy starts winning Employee of the Month out there, Jack. Chipotle CFO Jack Hartung, thanks so much for joining us here today. Appreciate it. Guys, coming up, activist investor Elliott Management has taken a stake in PayPal. Sazi is going to share his stake. Activist investor Elliott Management has taken a stake in PayPal, according to the Wall Street Journal. The size of the stake and Elliott's intentions undisclosed, but Brian Sazi has done a deep dive on this one. Sazi, got to get your take on this one.
Yeah, fascinating. I should say off the jump, Elliott declined to comment to Yahoo Finance on this report by the Journal, but I am hearing some chatter that this stake has in fact happened. PayPal did not return our request for comment. Let me set this up and why I find it so interesting. So on July 14th, you saw Elliott, and there's a nice little nifty timeline our team put up there. Elliott took a stake in Pinterest on July 14th. Pinterest shares popped, went up to the roof, 15%. July 26th, of course, as we're talking about now, you saw Elliott reportedly take that stake in PayPal. PayPal shares on the move. Now, go back further. October 20th of last year, PayPal was speculated to be buying Pinterest or have interest in buying Pinterest. Now, October 25th, PayPal came out and said, we're not exploring a bid on Pinterest. So those rumors died down. Now here, let's look at what Elliott might be trying to do here. One of the most noted and just really noted activist firm on Wall Street. They might be pushing with positions in Pinterest and PayPal. They may want to get both of those teams to the table and start to get a deal talk together. It would make a lot of sense. PayPal, of course, a leader in payments. And then you have Pinterest that needs some form of commerce and payments platform to take its platform to the next level. Next, if they don't want to get that deal happen, you could see Elliott push PayPal to spend more of its cash. PayPal's in a very strong cash position. Perhaps they should be doing more to buy back their stock, get that stock moving in the right direction. It has not been in the right direction the past year, down about 75%. Or lastly, get PayPal to pull back on some of its spending like many other players are doing right now in the tech industry. PayPal is really not giving that indication to Wall Street that it wants to pull back on spending. It probably should. And then lastly, why I'm really intrigued by here, of just the people that are involved in this potential whole tie-up. You can see Dan Schulman right there on the screen. He's been the CEO of PayPal since 2014, one of the most well-regarded CEOs in corporate America, but it has been a challenge for him the past year. You've seen PayPal shares down about 75%. You have seen profits slow at the company, but still Schulman, one of the top CEOs in corporate America. Next, hang with me, folks, we have Bill Ready. He is the new CEO of Pinterest. He took over officially on June 29th. He spent 6 years working at PayPal and worked alongside Dan Schulman extensively. And in many cases, many viewed Bill Ready as the successor to PayPal CEO Dan Schulman. So lots of intrigue all right there. And last but not least, I'll toss this one in here. That is PayPal Chairman John Donahoe. He is the current CEO of Nike. Interesting, he was the CEO of eBay from 2008 to 2015. eBay was attacked by Elliott in 2019. So you have an Elliott team, of course, that is after John Donahoe left that job at eBay, but still Elliott, you would have to imagine, is very familiar with the work that John Donahoe did and perhaps didn't do at eBay. Now, Elliott ultimately got a successful spin-off of the StubHub business and the classified business for eBay and over in 2019. Overall, here's my take. I do think you'll probably see speculation start to increase about a deal between Pinterest and PayPal. It makes a lot of sense. Now, this is not going to come overnight. No. A deal of this size and logistical challenges would take a while, but still, you see Elliott, I think, positioning for trying to get something done here.
There's a lot of synergy that could take place here, I think, from end to end, and you laid it out extremely well. The only thing I'll add here is that for Pinterest and some of the ability for them not just to continue to see increased time spent on the platform, it's going out to advertisers in an environment like this and getting them to spend more on the platform in this interim period of time while you're waiting for more of that monetizable active usership to really permeate throughout the experience within that platform of Pinterest that doesn't want to be called a social media company.
You have to make money. You can't just sit on Pinterest nowadays and look up recipes. They have to make money.
They got some good recipes, though.
They do.
Guys, coming up, we're going to discuss what's next for the CHIPS Act with Siemens USA CEO Barbara Humpton. That's up next.
Welcome back to Yahoo Finance Live. I'm Brian Sozzi alongside Brad Smith. Julie Hyman will be back tomorrow. We're only a few hours away from the Federal Reserve's decision on interest rates. The Fed is widely expected to raise rates by 75 basis points to get red-hot inflation under control. Right now, markets are taking all this in stride. We're seeing the Dow, S&P 500, and Nasdaq in the green. Here's what else we're watching at this moment. Chips, please. The CHIPS Act has passed another key hurdle in Washington, D.C. We'll chat with Siemens U.S. CEO Barbara Humpton on why the bill is so critical to the country and the bottom lines of corporate America. And a state of financial stress. A new Yahoo Finance Morning Consult poll reveals how badly inflation is hurting American households. Yahoo Finance senior columnist Rick Newman will bring us exclusive analysis on the poll's findings. And the future of crypto. Tron founder Justin Sun stops by for a chat on crypto you will not want to miss. Now let's go over to Inez Ferre at the Wi-Fi Interactive. Inez.
Yeah, Brian, and taking a look at the markets, we are seeing the Nasdaq, which is outperforming out of the major averages. And we're looking at technology on our Wi-Fi Interactive board, communications services, consumer discretionary. Those are the ones that are seeing gains. Those are the sectors that yesterday were losing. Taking a look at the Dow, we're watching Microsoft, Salesforce, Boeing. Those are the leaders there. And over on the Nasdaq 100, the left-hand side of your screen, the mega caps, the tech names, those are the leaders. We're watching Microsoft up more than 4.5%. Alphabet up more than 5%. You've got Amazon, which yesterday was in the red, today up 3.5%. I do want to take a look at the home builders because we have some pending home sales data that just came out month over month. Pending home sales were down 8.6% in June. The expectation was a decline of 1%, so quite a bit more than expected. Year over year, pending home sales were down 19.8%. The expectation was for them to be down 12%. So definitely those soaring mortgage rates impacting pending home sales. Also, mortgage applications fell last week 1.8%. The prior week, it had fallen 6.3%. I just want to point out a trending ticker since we're talking about home sales, et cetera. Sherwin-Williams, this is a paint maker. Now, they service the professional industry, the do-it-yourself home industry as well for paint. A big miss for the quarter on the top and on the bottom line. The weak spots for them was Europe, Asia because of those China lockdowns, and also the do-it-yourself segment in North America, guys.
Wow. All right. We're going to continue to keep a close eye on shares of Sherwin-Williams, as we know you will as well, Inez. Thanks so much for breaking all that down for us here this morning. Yahoo Finance's own Inez Ferre. And on Tuesday, everyone, the Senate voted to advance the CHIPS Act, which aims to boost the U.S. semiconductor manufacturing industry. Democrats hope to pass the legislation before August recess. And with more on this, we've got Yahoo Finance contributor Kevin Cirilli. So, Kevin, where do things stand on this right now?
We're anticipating a vote in the Senate later today, and then it would head to the House. And candidly, I'm expecting that there will be a vote in the House of Representatives sometime next week. Now, President Biden, for his part, speaking yesterday with Commerce Secretary Gina Raimondo, saying that this is a national security imperative to advance this legislation, which would provide $52 billion worth of investment in the semiconductor chip manufacturing space, as well as additional financial investment across the country in various different tech, fab, center, foundry, manufacturing plants and hubs, creating hubs in the United States in order to do this. President Biden tweeting out, quote, "America invented the semiconductor. It's time to bring manufacturing and the jobs that come with it home." And Senate Majority Leader Chuck Schumer speaking yesterday on the Senate floor in support of the bill and saying that this would help to increase competition against the Chinese Communist Party. Take a listen.
As a percentage of GDP, we spend less than half as much as the Chinese Communist Party on basic research. Less than half, which is even more devastating given China has spent decades stealing America's intellectual property. With this bill, that's finally going to change.
And I pulled some research on Yahoo Plus, and the Congressional Research Service says that in 2019, nearly 4/5 of global fab capacity was in Asia, think about this, 28% coming from South Korea, Taiwan 22%, of course TSMC located there, Japan 16%, and China 12%. The remaining 22% has been elsewhere. Now, back in the 1960s, the United States produced about something like 40% of semiconductor chips in terms of global production. So a massive shift that has occurred over the last several decades. But no doubt there's optimism, bipartisan optimism, by the likes of Senator Todd Young, a Republican from Indiana, that this type of investment in critical high-tech manufacturing infrastructure would be able to provide a national security boost and also an economic one as well.
All right, really excellent breakdown of where this all stands and what's coming next on this. Kevin Cirilli, thanks so much. Let's continue this conversation now with Barbara Humpton, who is the president and CEO of Siemens USA. This obviously a massive effort in order to move forward the broader chips and semiconductor industry. What are your expectations in terms of not just what we'll see next, but what kind of capacity and production may be unlocked if this fully goes through?
Yeah, Brad, first of all, we're thrilled to see the CHIPS Act moving. This is something we've been supporting for quite some time now, with the recognition that this technology is key to America's future leadership in the world economy. You see, we're entering a new era for manufacturing, and it's taking shape right here in America, where manufacturing is more digital than ever, and where advanced manufacturing technology makes everything possible. We think about digital twins, automation, virtual reality, augmented reality. All of these technologies go into the electric vehicles, the smart buildings, and even, as we heard from Chipotle, the chip machines that we'll be using in our everyday life. So truly, global innovation is essential, but making things locally is now key to our overall security and our productivity. The disrupted supply chains we've seen really show the need to establish local production and be resilient against future disruptions. So the CHIPS Act, both in the investment it will make in new manufacturing capacity, as well as the investment it will make in research and development, are both going to be essential to establishing America's leadership position for this next decade.
Barbara, fortunately, there has been no shortage in Chipotle salad bowls, because I just want to be in a good mood. So I'm glad that has not happened. But look, over the past year, looking back on the chip shortage, how has that impacted your business, and what has it prevented you from doing?
Well, I think all businesses have been really struggling with the semiconductor supply because, as we say, it's in everything. An EV uses some 2,000 chips. And in order to build an electric vehicle, manufacturers are looking to automation that Siemens provides. They're looking to the electric vehicle charging stations that Siemens provide, both of which use semiconductors. And so what we've done, our heroes in supply chain management here in the corporation have been using analytical tools, market tools to look out and use intelligence to understand where there may be pinch points in the supply chain. One of the key tools they've been using is transparency into our own operations, aggregating our need across businesses, making sure that when we communicate with semiconductor providers, they can trust us, that we have a real need and that we will be using all of the supplies they make available to us. What we're moving into now is the ability to actually use predictive tools to be able to look into the future. So with all that, I guess the underlying message, Brian, is the ability to use technology that is readily available to us today, get into that digital realm itself, and use that to help us manage the flow of product to where it can be best used.
What are you hearing from your customers in terms of how they're going to be navigating, even in the absence of a CHIPS Act in this interim period where it's looking to go through fully, and where there is more capacity that's looking to come online? How are they navigating just this interim period, and what are they asking more from Siemens?
Yeah, in this interim period, what we've known is that we need to be in very close contact with our customers, because what a lot of people don't understand is that we at Siemens are in all parts of the semiconductor supply chain. When Intel chooses to build a new location, then we could well be the providers of the electricity that will make their production possible. We provide automation that's used within the production factory itself. We also provide the design tools, the software that helps their engineers envision and then ultimately design and ready for production the semiconductors themselves. And as I say, ultimately, we are end users of the product. So the most important thing for all of us in this moment of disruption is clear communication. And as you know, this has been a very competitive field where people have been reluctant to share too much about what their requirements are and what their plans are for the future. The disruption, and particularly with the leadership of the Department of Commerce, we've seen unprecedented communication about where the needs are and how we drive through the bottlenecks today.
Barbara, a lot of manufacturing executives have told us recently they have dusted off their recession playbook. Do you have one of those, and how are you preparing for the slowdown?
Yeah, I think we're all recognizing that, what we're entering right now is a very difficult period, especially with the disruption due to war in Europe, the effects that's having on global energy supply. People are characterizing what we're entering as a global energy crisis. I will tell you that here in the US, my perspective is that we have relative energy security, we have relative health. While many parts of the world are still dealing with pandemic shutdowns, et cetera. So we actually have an obligation to outperform. I was just on a call this morning with Siemens global leaders, regions from around the world gathered, and this message of let's overdrive right now in order to be sure we'll be well prepared for this coming winter. And then one piece of good news is that backlogs are strong at Siemens. And so the number one thing we have to be focused on is relieving those delivery cycle times so that other customers of ours who are going to be critical throughout a long, tough winter are going to be able to perform well.
Some good news. We'll take it. Barbara Humpton, President and CEO of Siemens USA. Always good to see you. We'll talk to you soon. Okay, before we head to break, let's check back with General Motors. After a mixed quarter on Tuesday, today, Citi analyst Itay Micali is out saying General Motors remains his top pick. His price target of $87 assumes 160% of upside to GM stock price. That's not a typo. That's what he wrote in his note. It says Micali, quote, the second quarter was a bit noisier than expected, but delivered a number of reassuring updates, such as good results in key segments, a reasonably confident guidance confirmation, indications of easing commodity pressures into 2023, and a reassuring update on Cruise. Big call by the Citi team on GM. Coming up, Credit Suisse has ousted its CEO and replaced him with someone that may be slashing expenses at all costs. Brad is back with more on that shakeup and a look at other top headlines next.
Opioid maker Teva reached a settlement agreement with the U.S. government for $4.25 billion. The deal came after multiple trials and lawsuits taking aim at the drug maker's role in the ongoing opioid epidemic. Under the deal, Teva will make payments over 13 years to state, local, and tribal programs to help ease the crisis. The Israeli-based company's opioid production dwarfed that of Johnson & Johnson, we should note, and Purdue Pharma at the height of the opioid crisis as well. Taking a look at Teva shares, they are higher on the day by about 23%. We'll keep a close eye on that. As well here, Credit Suisse is making changes in the C-suite, naming Ulrich Körner as its new CEO. The latest effort by the embattled lender to repair its reputation after a series of scandals and financial troubles. Credit Suisse also announced that it was launching a strategic review to reassess spending and cut costs. Deutsche Bank also out with earnings today. The bank beat profit expectations for the second quarter, but warned of souring economic conditions for the second half of the year. In response, the German bank also cut its cost target for the full year and struck a cautious tone when it came to full year profit. And Twitter announced that it is holding a shareholder meeting in September to vote on the $44 billion Elon Musk merger. That will take place September 18th. Now, the company's board has urged shareholders to approve the deal. This is ahead of Musk and Twitter's trial in October over the billionaire's attempt to pull out of the deal. Well, switching gears here and checking in on the world of crypto. As more and more firms file for bankruptcy, our next guest says he's ready to help those financially distressed crypto companies get back into the fray. And joining us now, we've got Justin Sun, Tron founder and ambassador of Granada to the World Trade Organization, as well as Yahoo Finance's David Hollerith joining in on the chat. Justin, thanks so much for taking the time here with us today. First and foremost, when we think about helping out and what that looks like for some of the other distressed crypto platforms and operations, what does that look like from your perspective?
First of all, I think recent crypto downturn really destroy lots of the balance sheet of crypto enterprise. I think one of the biggest reason is because all the platform use a very big leverage in their daily operation. So that's why when Bitcoin, Ethereum goes down, for example, 30%, for those companies has used a very large leverage, it probably means even 50, even 70% down. So lots of the assets got liquidated. That's why we have seen even like big companies with $10 billion in their balance sheet even get liquidated in a very short period of time. Probably like around 2 to 3 weeks, just like what happened in the financial crisis.
Justin, I want to go back to May when Tron issued its algorithmic stablecoin USDD. Yes. Now, this is around the same time that Terra's algorithmic stablecoin famously collapsed, and this is one of the major events that sort of sparked the downtrend and the deleveraging we've seen across the crypto market. So I was curious, could you sort of explain what's going on with USD? It has about a $700 million market cap at this point, and it looks like it had depegged and has got back to that crucial $1 mark as of now. But what's sort of going to define whether the value arc of this stablecoin is going to be any different than Terra?
Yes, sure. USDD use different mode compared to USD and Luna. I will see USDD is a hybrid mode. So first of all, we have over-collateralized stablecoin reserve. So basically, right now, the reserve ratio is more than 300%. I will say even more than 110% will be quite safe for USDD holders. In the reserve, currently we have TRX, BTC, USDT, USDC. So basically it's hybrid Bitcoin, other cryptocurrency like TRX, and also USDC and USDT as a stable coin. So Tron Reserve will gradually change those collateral ratio, depend on the market situation. Of course, I think back in May, the market seems to be super panic. So that's why even for USDD, we see it's over collateralized. That's why we also have, I think, maximum has around 5 to 7% dip in the market crisis. But in a very short period of time, the peg go back, I think, because of the market back to normal. I think that's the first thing. And the second thing, USDD has a very active custodian Dow reserve, which we use different monetary policies to maintain the USDD peg. So basically, when market is in the downturn, we will buy USDD and buy crypto from the markets. And when market back to normal, we will issue more USDD and also sell some of the crypto reserve in our Dow reserve to fiat to prepare for any market volatility. And also, I think the most important thing for Dow reserve is guaranteed the decentralization of USDD. One of the most important difference between USDD to USDC, USDT, all the regulatory stablecoin is USDD don't rely on any banking rail. So basically, we don't collect any users' information. So you get maximum user privacy. At the same time, you can enjoy a decentralized blockchain infrastructure. That's why we have a completely decentralized but also safe mechanism to guarantee the stable of the stablecoin itself. Different from Luna. Luna only have one mechanism to basically protect the stable of UST. Basically is Luna as a token itself, but it's very easy to fall into death spiral if the market feel super panic in May. Of course, I think the Luna and the UST price going down the same time. So we will see UST will never go back to $1. At the same time, it's minting a limited amount of the Luna token, which crushed the Luna to zero, as we see what happened in the markets. But USDD is very strong because we back by all the different collateral, including all different kind of the stable coin in the Dow reserve, and we grow in a very healthy and organic way. I think which you can also see our balance sheet. We have a very strong reserve, and also at the same time, Tron Network has a very robust use case, which we process over 10 billion US dollar worth of stable coin every day. And the USDD is only a very small percentage of that.
Justin, I'd love to get your take on this. We had FTX founder Sam Bankman-Fried on yesterday. Take a listen to what he told us about what he's been up to, and love to get your reaction on the backside.
A lot of these deals, a lot of these bailouts, we reached out to everyone we could in the industry and said, hey, do you want to come in this with us? Do you want to do it yourself? Like, we'd love someone else to take this on. And we don't want to be the only ones doing this. We want this to be a broader, industry effort. In the end, the response we got from sort of other investors was basically, wait a minute, some of these companies look like they might have some financial troubles. Or so like, yes, that's correct. That's why they need help right now. Like, I don't know what you're expecting.
Justin, so what do you feel, what are your feelings or thoughts on, one company starting to gain really a massive stronghold in the crypto industry? Is that a good thing or bad thing?
First of all, I fully respect and also fully respect Sam's offering help to all of our industry and entrepreneur to build a blockchain industry. But I also feels like we need healthy competition. I think currently there's a lot of player in the crypto space trying to become a very helpful role for everybody in the space. I think we should collaborate together to bring crypto back to normal in these difficult times.
Tron founder and ambassador of Granada to the WTO, Justin Sun. Good to see you, and good to see you as well, Yahoo Finance's David Hollerith. Coming up, Microsoft's quarter was far from a blowout. Yahoo Finance tech editor Dan Halley joins us next with a look into Microsoft's Xbox division, which is showing it's not immune to recession fears. We'll be right back.
Shares of MSFT from Microsoft. You are seeing them move higher on the day by about 4.5%. And that's despite reporting fourth quarter earnings that missed expectations, citing an unfavorable foreign exchange rate and COVID closures in China as key factors. Yahoo Finance's Dan Halley joins us now to break down the details. Dan?
Yeah, so I think the big takeaway from this was obviously they missed on the top and bottom line. They missed across the board as far as revenue goes. But beyond that, investors are seemingly happy with what Microsoft has done. It's up 5% right now for the morning. And, I think really 4.5% now. I think the big takeaway, though, is the fact that, while there were misses, the cloud still seems to be doing well. And that goes back to the fact that they had seen a 40% year-over-year increase in revenue for their Azure service. Now, that comes, by the way, as both their intelligent cloud and productivity and business processes, those are two cloud-heavy business segments for the company, missed. So we're still seeing Azure do well. That's their big cloud platform, their kind of AWS fighter, making them the second largest cloud provider in the world. But I think that's really where investors are going. And Satya Nadella, Microsoft CEO, basically said that's because of the consumption model that Microsoft has. People look to kind of optimize how they're spending during this kind of time, and the Azure platform really allows them to do that. So I think that's why we're seeing investors kind of breathing a sigh of relief almost, despite the fact that, again, they missed on all of these different segments.
Yeah, weakness, Microsoft calling out again, weakness in the PC market. We're hearing that a lot, heard it from Texas Instruments as well. But the Xbox business, I would say targets a very economically sensitive consumer base. Didn't exactly light it up in the quarter.
No, that was also off as well. It had revenue was down year over year. And I think a lot of this has to do with, you can see on the screen here, the 11% on the Xbox hardware, gaming down, content and services down. I think a lot of that has to do with, The people who were buying Xboxes have bought them. They're still, hard to come by, but not nearly as hard to come by as they were at one point. There's not a lot of first-party titles that we're seeing from Microsoft, and that's kind of an issue when it comes to how they're able to generate revenue for gaming. They're also not getting as much take-up in third-party as far as monetization once the products are purchased, the games are purchased. But Microsoft is saying that a lot of that is being offset now by their Game Pass platform. And that's the ultimate goal for Microsoft. Game Pass, they hate this kind of analogy, but it's really a Netflix for gaming, especially the cloud version. That is really kind of where they're going to be pushing for years to come, where you can jump online, start playing games from wherever you want. They sign deals with Samsung, other smart TV makers, so that you can access these platforms without needing a console. And look, I use cloud gaming. I use Game Pass all the time. My wife and I play it every night. It's an amazing deal, and it's recurring revenue. And that's so important when it comes to gaming because, look, people go out and they buy a title, and then that's it, unless they're, it's something like Grand Theft Auto where there's the continual uptick in revenue. But a Game Pass would allow people to really do that long term.
And so on the titles, since you mentioned that, the acquisition of Activision Blizzard, it's likely to go through, is what the word on the street is at this point in time. So how immediately accretive might that be to this gaming business that's going to be looking for some of the in-game purchases to tick up higher, that's going to be looking for more of some of the title purchases to prop up the gaming business?
Well, look, they have titles that are coming out. They have a game called Overwatch 2 that's going to be coming out. That's a big online multiplayer game. A lot of people like to spend money on that via different types of content. Skins, things like that. But they also have, obviously, Call of Duty, and that's, the big franchise that Activision Blizzard has on the Activision side, at least, that will really generate revenue for them. Their last Call of Duty title didn't exactly do well as far as individual sales go, but their Warzone, their online game, still does incredibly well. And I think, they're going to be coming out with a new map for that. That's going to draw more people to it again. As long as they can keep kind of the cheaters away, it's something that really does, annoy players, me included.
It's part of the culture, the cheat codes.
Oh, no, you can't cheat in online games, though. Look, every time my friends and I play and we lose, we call it Champions Night because all the champions come out and play, and that's the only reason why we lose, not because we're bad. But getting rid of cheaters, I think, is very important. That ensures that people want to stay in that ecosystem, and I think the fact that they've done so well doing that, that will be very good for the next version that comes out.
Real quick, you have a gaming chair?
I don't, and I need one.
Okay.
I just have a regular old chair.
Had to know. Viewers want to know. Dan Halley, thanks so much. All right, we're keeping an eye on shares of Boeing today after the company reported its fourth consecutive earnings miss, citing setbacks from supply chain and labor constraints. The airplane manufacturer burned through significantly less cash in the second quarter and reaffirmed its plan to return to free cash flow positive state this year. Coming up, if you are back in the office for work, you are probably using the elevator again, and that could be good news for elevator giant Otis. We'll chat with Otis CEO Judy Marks next about the company's earnings out earlier today. Don't go anywhere. Shares of Otis Worldwide are getting a slight boost today after reporting mixed second quarter earnings. The elevator maker cited COVID lockdowns in China, high commodity prices, and the strengthening U.S. dollar as key headwinds in the second quarter. Joining us now to discuss is Otis Worldwide Chair and CEO Judy Marks. Judy, always great to get some time with you. So compared to 3 months ago, how has the business changed and how are you thinking about the back half of the year?
Hey, Brian, the business, great to be with you. The business is going strong, solid second quarter results. We grew organic sales about 40 basis points, margin expansion of 20 bips, and grew earnings per share at about 12%. And that came off some weakness in China, but strength across the globe that really countered for this. Our service business was super resilient, including in China, and our service business contributed $39 million at constant currency to our bottom line. So, we've got the resilience, and then as we look to the new equipment side, record orders for Otis this quarter. We were up 16.5% in our bookings of orders, including 57% in the Americas. So construction's still going strong, and our service resiliency and just really keeping buildings and people moving continues to pay off.
In a normal supply chain period, how long would it typically take to work through some of those orders that you were mentioning and the backlog particularly, versus now where you do have to monitor this broader supply chain crisis that every company has tried to account for in one way or the other?
Yeah, Brad, we are a longer cycle industry, especially for an industrial. From the time we get to the order, typically till the elevator's installed and tested, really could range, depending on the part of the world, 6 months on the quickest, 18 months on the longest cycle. So we have the ability, which you've seen in our results, not just this quarter, but in the past, to really drive productivity, material productivity in our factories, installation productivity in our field. And that's what's, created our margins on our new equipment business, which do contribute to our bottom line. We have not changed our outlook for commodities. We've stayed at about $110 million impact this year over last year. So we think we have that really well identified. And as commodities continue to come down in the second half of the year, although we're long cycle, we'll try to optimize to the best of our ability and drive that to the bottom line as well.
Judy, yesterday we had a conversation with the team over at Whirlpool. Obviously, they're making appliances, you're making elevators, different businesses, but both manufacturers. And they told us they have pulled out their recession playbook. Do you have something like that on your table over at Otis right now? And what would it even entail?
Yeah, I think we're actually in a better place now than we were in the former recession. We have a strategy we've been executing since spin that allows us to control everything we can control, Brian, and that's what we're focused on. Inside our factories, we've got the right footprint. We've got multiple suppliers across our global supply chain. We tend to be local for local, both in our service business and in our manufacturing, our 18 manufacturing plants, so that we have really the flexibility to respond to a recession. Our service business holds up very well. Again, safety is our top priority, and the regulations and codes that drive the amount of visits we have to do and the tasks we need to perform under these annual maintenance contracts have to happen whether there's a recession or not.
Have you made a decision yet, Judy, to cut back on manufacturing and slow hiring?
We're seeing a strong demand signal in new equipment with an orders book up 16.5%. Our backlog is up 10% as we ended the quarter in constant currency, about 6% for new equipment at actual currency. And our modernization business, which also drives retrofitting and rehabbing older elevators, that orders book was up 9%. So demand signal's fairly strong. Across the globe, backlog strong. It's flattish in China, but backlog obviously everywhere else has to be about 15% to make up for that. We've got 70,000 colleagues, 41,000 of them in the field providing installation and service. We've grown year over year in headcount, and we feel really comfortable with where we are, both in manufacturing and in service. And again, I can't thank our colleagues enough for delivering for all the passengers globally.
Judy, even as we track across industries and talk about everything from menu innovation all the way to, fitness tech innovation or fashion innovation, for elevator innovation specifically, how does that continue to also allow you to go back to your existing clients and have them upgrade into some of the future products that Otis is getting out to the market as well? And what does that kind of rate of turnover in equipment actually look like over an extended period of time? And are you seeing that type of demand?
We're seeing the demand for the connected technologies, both in new equipment and new buildings, as well as in buildings where customers are modernizing because they want to attract new tenants, be it residential or commercial. And over half of our 2.1 million units are in residential buildings. Think apartment complexes, condominiums across the globe. So we're seeing people who modernize for technology and modernize for aesthetics. So both of those are driving innovation to what we call being connected, having real-time displays in the cab itself, the ability to see infotainment, to get information real time, and just the ability to connect with your cell phone, to be able to call an elevator with your mobile phone so that it really is on demand for the passenger. But probably the biggest connected piece that we've had success with is our Otis One offering that allows us real time to monitor elevators and escalators. And we decided we would invest in that and deploy that across our install base. And we're well on our way so that we have the ability to predict problems before they occur so that people won't get entrapped, so there won't be shutdowns. And it's making a difference. It's making us more productive in terms of being able to be predictive and proactive and transparent. And the customers getting the value of it as well because they can see it real time as well.
All right, if you can hail a ride, why not extend that to hailing an elevator as well? Judy Marks, Otis Worldwide Corp. Chair and CEO. Thanks so much for joining us here today. We appreciate it.
Thank you.
Coming up, everyone, gas prices aren't the only inflation concern on the minds of Americans. We're going to share the results of our new poll with Morning Consult next. Americans are reacting to inflation that has reached highs not seen since 1981. A new survey conducted by Yahoo Finance and our friends at Morning Consult shows that while gas prices are getting the headlines, it may not actually be the biggest inflation concern among Americans. Joining us now with the poll results and political perspective, Yahoo Finance's own Rick Newman, senior columnist here at Yahoo Finance. Rick, what do we know from the results so far? What were we able to extrapolate?
Well, I've paid a lot of attention to how people feel about gasoline. One of the things that surprised me here is people are obviously concerned about the price of gas, which hit $5.02 in the middle of June. But the majority in this poll actually say they're confident they can afford gas right now. 63% said they're able to afford gas right now. It's interesting because a significant number of people say they're worried they may not be able to afford gas in the future. So that's people telling us, yeah, they can afford it right now, but they're concerned things are going to get out of hand a month or two from now and the prices are going to go up and they're not going to be able to handle the cost of gas. So people are worried things are going to get better. That's one of the things that clearly comes across here. But there are other things that people have a harder time paying for. They are struggling to save money or put any money into retirement savings. And then childcare is the one thing where people say they have the lowest confidence they can afford childcare today for those people who need it. Only 42% said they're confident they can afford childcare. And of course, for families with kids, they probably spend a lot more on childcare than they do on gasoline. So, we in the media, we've been fixated on gas prices, but families have a lot of other budgetary concerns.
Indeed, they do, Rick. And I wrote up what the poll found with as it pertains to back to school supplies. 50% of those polls said they won't be able to afford back to school supplies, and they're going to have to cut back on a vacation to afford those supplies. And another 28% said they may not be able to afford school trips for their kids. So you put all this together, none of this could be good for the president, right?
Well, I mean, this is a bit of a Rorschach test, honestly. So we do have a majority saying they can afford most categories of things that ranging from necessities to non-necessities like vacation. But there clearly are families that are under stress. Now, that's always true, and this is the first time we've done this with Morning Consult, so we're going to build a baseline here over time. But yeah, I mean, look, there are families under stress, but I think once again, people really worry that things are going to get worse a few months from now, and that could be inflation gets worse, or we have this recession that we've been trying to talk ourselves into, and that people feel maybe their incomes are not safe and their jobs are not safe. So one thing that comes through crystal clear is people are just in a bad mood, and that is a big problem for President Biden.
All right, Yahoo Finance's own Rick Newman there, breaking down the results of our latest survey with Morning Consult and Yahoo Finance. Thanks so much, Rick.
Bye, guys.
See ya. Guys, coming up, we're going to do a final check of the markets on the other side of this short break, and we're going to continue to count you down to the FOMC decision later on today, plus the press conference that our own Brian Chung is at. Stay tuned.
Welcome back to Yahoo Finance Live. It is Fed Decision Day in America, and so far ahead of that big event later on this afternoon where the Fed is likely to raise rates by 75 basis points, seeing all three major indices in the green. Brad, I know you're still tracking some Yahoo Finance trending tickers here in the morning.
Yeah, Shopify. Let's take a look at that one here. Ticker symbol SHOP. Really easy to remember there. Right now, it's up. And that's after yesterday's deep decline that we saw for Shopify. That on the announcement of the headcount reductions that they're setting into motion. However, moving higher here on the day with some of the second quarter financial highlights that the company had reported. Revenue in the second quarter that grew 16% year over year came in at $1.3 billion. And then additionally, let's just check in on Visa, if we may, for a hot second there to just see where shares are moving right now, as I was seeing that move higher here by about 1%.
Decent quarter.
Moving higher over. Yeah,
decent quarter for Visa, also decent quarter last week from American Express. All right, coming up, Hilton CFO Kevin Jacobs will join Akiko Fujita and me on the back of their earnings report. You won't want to miss it.
Welcome to Yahoo Finance Live. It is 11 a.m. here in New York City. I'm Akiko Fujita. We are 90 minutes into the trading day, and we are seeing gains across the board here ahead of that all-important Fed decision. The Dow up 141 points, the S&P 500 up 52, and the Nasdaq seeing some big gains there on the back of those tech earnings. We'll get to that in a bit in the show. Let's take a look at where the Treasury yields are trading right now. As you know, we're going to be watching these one really closely going into that 2 o'clock decision this afternoon. The 10-year yield pretty flat there, as is the 30-year yield. But we are beginning with the big story of the day. All eyes on the Federal Reserve as the FOMC wraps up its two-day policy meeting. Investors expecting another 75 basis point hike as the central bank looks to cool down red-hot inflation. But the big question for Fed Chair Jay Powell, how far is he willing to go beyond this meeting? Let's head out to Washington, D.C., where our very own Yahoo Finance is Brian Chung standing by for us. Brian, as always, we're going to be looking to that 2:30 press conference to see if we get any more guidance on how much more aggressively the Fed plans to move.
Hey, morning, Akiko. Well, 82 degrees down here in Washington, D.C. It's going to heat up to 87 degrees. I mean, that's as hot as the inflation that we find ourselves in this economy, 9.1% on a year-over-year basis in the month of June. That's a big reason why the Federal Reserve says it wants to continue the pace of interest rate hikes that it's been embarking on over the course of 2022. All expectations point to another 0.75 percentage point interest rate increase at the conclusion of the meeting today, this afternoon at 2 p.m. Now, that's going to be the same size as we got in June. Market expectations overwhelmingly saying that's what it's going to be, although you do see about a 20% chance of perhaps a 1 percentage point increase. But of course, the Federal Reserve unlikely to do that, given the fact that if they did perhaps want to go with that upside surprise, they probably would have messaged it last minute like we got in that last June meeting. But the natural question is not going to be what's in the statement itself. Seems like most of the language is likely going to be the same. The focus is going to be on the Fed chairman's press conference at 2:30. What does he say about the 3 remaining meetings for the end of this year in September, November, and December? Is it going to be another 75 basis points in the next meeting? Maybe 1 percentage point still on the table? We don't know, and that's so important because the Fed, after this meeting, will have interest rates in the estimate of neutral between 2.25, 2.5%. That's the point where any further interest rate hikes will be classified as restrictive and could have a stronger bite into inflation as the Fed tries to engineer that soft landing. All eyes and ears are definitely going to be on that 2:30 press conference, which, of course, we'll have the full coverage of right here on Yahoo Finance.
Yes, and I know you're going to be right in the room to ask those questions. Stand by right there. Let's bring in our guest for the hour, Victoria Green, a founding partner and CIO at G Squared Private Wealth. And Victoria, Brian walking us through the expectations today, but you've got a pretty bold call. You're expecting 100 basis points hike.
Well, it may end up 75, but I'm in the 20% camp. It should be 100 bips. Look, the economy can absorb it, and I actually think that's almost a reaffirmation of how strong we are economically speaking. You know, even if we are in a technical recession, or now we're arguing over what the definition of recession is. But look, the labor market is strong. Inflation is still hot. Did it maybe peak in June with the commodities rolling over? Yes, but it's still very, very plateaued. And so I think the Fed, in my opinion, they should go 100. We've always been pretty lockstep with Bank of Canada. They went 100, and I really think it gives them more wiggle room in the fall. Now you have this pause, nothing happening in August, and then we'll see in September. You know, right now it's supposed to be 50, 25, 25. Obviously that could change, and we could see them be a little more hawkish. They could use QT, run off the balance sheet. They have a lot of tools. But I think this is their one chance to get in front of it, and they've been late so long. So we'll just have to see. You know, I think a lot's going to be happening in the press conference. Like you said, the verbiage, it's kind of like reading a text message or an email. A lot of times the verbiage comes out a little more hawkish post-meeting, but it's really the commentary, and we'll see if he walks it back. But come on, I'm hoping, I'm rooting for 100 today.
Well, Victoria, we'll see about that. I mean, I want to ask you, I mean, regardless of what the size is today, we know that further interest rate hikes are going to be needed. And the Fed's own messaging in the last meeting was that they could take it as high as 3.8%. That's, again, perhaps about 1.4% away from where we would be if they do 75 today, before they then start cutting interest rates again. So do you have an estimate of how many more rate hikes in total might be needed through the end of this year, through the beginning of next year, to handle inflation?
Not to sound like a Fed person myself, but it's data dependent. You know, I really do think it's going to be what happens with inflation, and do we see any pressure on the labor market? Because I think they hike until something breaks, and something's going to break either in the labor market, the inflationary status, or liquidity dries up, and that pauses the Fed. So something breaks other than the stock market, because the Fed doesn't really care about the stock market. Short of a massive meltdown like 2020, when there was concerns about the stability of the system, the Fed doesn't care if Apple or Amazon lose money. And quite frankly, we've seen resilient earnings. So right now it's green light, hawkish Fed. We are still in the camp of don't fight the Fed. You know, we'll see what comes in the rest of earnings seasons, but the Fed has to be more focused on the economic implications of people starting to slow hiring or even lay off. You've seen a lot more layoffs happening in the tech sector. You have Tesla, you have Shop, you have Twitter, you know, people that are actively reducing their labor force. We haven't really necessarily seen that trickle down into the numbers. And so you're seeing all of these conflicting signs. And I do think the Fed is as a hard part, because if you look at even what the companies are saying, on one hand, you have Amex saying everybody's traveling and spending money, the consumer's fine. And then you have Visa, AT&T, and Walmart saying, oh my God, gosh, the consumer is changing their habits and they're not spending enough money anymore. And so you have these conflicting reports coming from earnings. So what is the true underlying health of the consumer? I think we're going to find that out over the next 90 days.
Yeah, that mixed picture we're seeing in earnings, you could argue we're also seeing in some of the economic data. But you point out we are in the heart of earnings right now. And I wonder, when you look at how things have been moving, the Nasdaq today up on the back of Microsoft and Alphabet's numbers, what's the bigger driver? Is it about the Fed or is it about earnings?
I do think we got so pessimistic that not a dumpster fire was rewarded. So if you look at Microsoft and Alphabet, they really weren't great earnings, quite frankly. Under the hood, the numbers were in line or some misses. They warned about the dollar impact, but both of them had decent forward guidance. So I think the market right now is very focused not on what you did for Q2. Expectation was that Q2 wasn't that great, but because there was strong forward guidance, you're seeing those stocks pop on really what traditionally would not have been a nice pop day. If you look at just the numbers and the comps between, it wasn't a solid beat for either. So it's very curious reactions right now. Or look at Shopify. You know, I know they got hit pretty hard before the earnings with the layoff announcement and had a pretty strong drop yesterday, but they missed pretty solidly. And they're talking about this year as a transition year, and now they're up. And so you look and you're seeing some very curious moves and reactions to earnings. And I feel like the ones that are getting punished are only the ones that have bad forward guidance. Like this quarter is seen as just so forgivable. Like, that's okay. Everybody had trouble in Q2. It's fine. You didn't make enough money. Like, we expect you to make more in the second half.
So, Victoria, on that point, then, what is the allocation strategy? Are you going to make some moves after 4 p.m. today because of the fact that you're going to get the Fed decision in addition to more big tech earnings? Because it's not usually the case you see these big market cap stocks moving as volatile as they are right now. Do you ride that out, or are you ready to make some changes?
I am. I've been fairly bearish. You know, we actually consider this still a bear market rally, but it's certainly being tested. You know, we've seen kind of a month-long bottoming process here. And so I am prepared to move a little bit more aggressive if we have good news this week and we see this as kind of a signal that the bottom is in. And I know I'm waiting. Most of our investors that are private clients prefer us to be a little bit late than early and get caught out being too aggressive. So we are being cautious here. I still think there's potential this is still a bear market rally and it could flip around. I am willing to update my thesis on data. If the Fed only goes 75, they signal this very slow path, and if they, you know, and what their terminal rate is, and we see and we see inflation come down, and we see the next couple big ones with you got your Meta, Amazon, Apple. You know, and we suddenly see that the market is forgiving, then you should be reallocating some of the stocks. You know, that's the $1 million question. Is the bottom in? Was the bottom June 6th to 17th? And right now you want to go then and switch from defensive to high beta. I think it's a little early. I think the next 48 hours are going to determine the trajectory of the summer markets.
As always, some good takeaways there, Victoria. Good to have you on. Victoria Green, founding partner and CIO at G Squared Private Wealth. Our thanks to Brian Chung as well. You got a long day ahead of you. Try to stay cool out there. All right, shares of Boeing we're watching here in our trending ticker, getting a slight lift, or actually now down, despite the company missing earnings estimates. Weakness in the aerospace giant's defense unit weighed on quarterly results, although Boeing did see a tailwind in its commercial airplane unit. Investors cheering on the company's return to operating cash flow following years of losses. It generated $81 million in cash in the quarter, putting it on track to generate free cash flow on an annual basis for the first time in 4 years. CEO David Calhoun reiterating that Boeing is in the final stages of resuming deliveries for those troubled 787 MAX planes. Well, coming up next, Microsoft's latest quarter, far from a blowout, as Victoria said. We're going to take a deeper dive into that report on the other side. We'll be right back. Welcome back to Yahoo Finance Live. Big tech earnings continue to be in focus. We're watching shares of Microsoft as well as Alphabet closely today. Microsoft posting slowest sales growth since 2020, while Alphabet got a bit of a lift from strong revenue in its search business, despite the company missing on the top and bottom lines. Let's bring in Bob O'Donnell, President and Chief Analyst at Technalysis Research. Bob, we had a guest on in the last block who said, well, these weren't really great earnings. But you're actually saying, it's kind of the opposite. Aside from the FX hit with Microsoft, the numbers weren't so bad.
They really weren't that bad. And you think about it, again, these are huge numbers and they're still growing on huge numbers. And yeah, we saw IBM last week had the FX hit. We saw Google talk about it. I'm sure we're going to hear some of these other big tech players talk about it. But all in all, I mean, the thing to remember is, unfortunately, a lot of people tend to throw big tech together. And we do have to think about it a little bit differently, right? Because a company like Microsoft is really got a lot of enterprise focus, and businesses are going to continue to invest in technology for the foreseeable future in a significant way, right? Cloud computing itself, of course, is going to be a big part of it. Windows and PCs, yes, we saw a little bit of a slowdown, but we learned during the pandemic that the PC is an incredibly important device. So that business is going to continue as people eventually start to replace the machines they bought at the beginning of the pandemic. Yes, is it going to balance out a little bit? Sure, it will. But long term, there's still opportunity there, software related as well. So, to me, the biggest takeaway from the earnings call was, of course, that forecast. And that forecast spoke a lot, not only, I think, to the confidence that Microsoft has in their own business, but I think it also speaks to a certain degree to that bigger enterprise technology story. And we saw that a little bit of that of Google, of course, with their cloud business. They're struggling to get there. They're building up, remember, they're number 3, so it's a little bit harder for them. But I think we're going to see Amazon likely have very strong AWS. Consumer could be a little bit different. Apple, of course, always be interesting to watch as well. But the bottom line is, I think we need to be careful not to throw together, Twitter and Spotify and Shopify, and some of the consumer tech types of companies with the really bigger traditional tech companies. I think they're very different animals and they need to be thought about differently.
Well, and Bob, you could argue that we already saw those declines last week. Microsoft and Alphabet kind of both getting lumped in after we saw Snap report. And so maybe that's kind of the bounce back we're seeing today. Specifically on cloud, we did hear Satya Nadella talk about the investments that are being made. He said Azure is actually deflationary, in part because he thinks that companies are going to lean on the cloud even more when they're short staffed, when they need to save on costs as well. Do you buy that argument?
I think there's some truth to it. I mean, there's got to take a little bit of that with a grain of salt, of course, because he's got his own interest there. But the truth of the matter is, a lot of the reasons why people are moving more of their workloads to the cloud and trying to figure out how to modernize their businesses is because there are long-term savings involved. Now, there's a lot of the economics of how cloud computing works that gets very complicated very quickly, which makes it hard to easily decipher. But fundamentally, again, as companies recognize, if they're going to stay competitive in the modern era, as they continue to deal with the post-COVID world and how people are working and where they're working, all these kinds of things, the ability to drive more of that to a cloud environment, balanced, oh, by the way, by some of that cloud computing capability, even being within the walls of traditional companies, that notion of what's called the hybrid cloud, that's where you're going to continue to see a lot of growth. So I do think there's opportunity there. And I don't think Nadella is wrong in saying it's to some degree deflationary.
Bob, let's talk about what we saw with Alphabet. We got some strength coming through on their search business. They talked about the searches they're seeing in travel and retail. But YouTube, a big disappointment here. Their growth just at 5% compared to where we were a year ago. This comes on the back of those concerns around advertisers going to these platforms. What's your read into that, and how much of this is specific to Google?
Well, I think advertising-related companies in general are going to face this. We're obviously seeing this happen with social media. I think we're going to see other digital advertising-based companies, which, to be honest with you, have always had somewhat, I would argue, less solid business models in the long run, because they've always been based on these crazy expectations for growth. I think that the reality is kicking in for some of them. So, in the case of YouTube, obviously there's a huge amount of competition from other social platforms, and it's interesting myself. I mean, like a lot of people, watched a lot more YouTube during the pandemic, and I'm finding I'm watching a lot less of it. I'm kind of tired of it. I'm done with that, and I think there's a lot of sense of that, and I think that's been a concern. And again, it being advertising driven. On the other hand, am I searching less? Of course not. I'm searching as much, if not more, right? And just the idea is that certain principles and certain capabilities, certain technologies are absolutely essential, and people are going to continue to use them. And other things, they start to waver over time. And I think that's a tiny example of what we can expect to see with other types of companies, other types of technologies over time. Certain things are going to weigh themselves out as being more important longer term, and other things we're going to see are maybe perhaps not quite as much. So I don't think it's Google specific. I think it's part of an overall picture around how people are consuming media, the platforms they're using, and frankly, how their lives are evolving as people start to travel more and do other things.
Bob, you mentioned, the concerns around some of these companies that are very reliant on those ad dollars. A big one coming up today, Meta. And this comes at a time, to your point, where I think a lot of investors are trying to differentiate big tech by looking at very company-specific stories. I mean, if you look at more consumer-facing names like Meta, how does it compare to another one like Apple that is still consumer-facing but still has a pretty strong balance sheet?
Yeah, well, I mean, the thing about Meta is so much of it is, in fact, advertising based. Their hardware business with Oculus is a tiny fraction of what they're doing, whereas Apple's hardware business is a huge part of their story. And people are buying devices. They're not buying them as quickly as they did, and they're holding on to things like their iPhones longer than they used to. But the Meta story isn't nearly as well balanced. I think that's the other thing. If you look at Alphabet, if you look at Microsoft, if you look at Apple, they're pretty well balanced in terms of they have a lot of money and revenue coming from different places. It's not as anywhere that is the case, with Meta. It's much more biased towards that ad revenue. And that's where things start to get difficult is, like you said, if you look at it company by company and look at the revenue splits and the breakdowns, you start to see that there's some more obvious concerns that are going to be risen. And again, companies who are more well-balanced, have that business spread across a lot of places, I think you're going to see are going to do better in the long run.
Yeah, so far Meta up nearly 5%. We'll see if those gains hold after the numbers come out.
Yeah.
Bob, always good to have you on. Bob O'Donnell,
Thank
Technalysis
you.
Research President and Chief Analyst. We're going to keep the earnings theme going here with a look at Spotify. Take a look at shares. They're up 14.5% on a beat with total users as well as revenue. Let's bring in Yahoo Finance's Alexandra Canal for a look at that. A pretty strong quarter overall.
Pretty strong quarter overall, but we did see a wider than expected loss. But despite that, it seems like there's a lot of optimism on that beat from revenue, along with that beat on total monthly active users. Those numbers coming in at 433 million, 5 million above guidance. And the expectation for Q3 is that Spotify will reach 450 million users. Another positive for the quarter being their advertising revenue, up 31% to 365 million. But there are still larger macroeconomic concerns, a potential recession that could cause a pullback in that advertising revenue. Daniel Ek, the CEO of Spotify, specifically citing that on the earnings call. They also said they will be slowing down hiring by 25% in the back half of 2022, but that they haven't seen a material impact on demand on users amid the downturn. But Akiko, I think it's important to understand that this company is not profitable. Their reported gross margins did miss estimates. They're spending a ton of money on non-music content, a reported $200 million deal with Joe Rogan for some of their podcast endeavors. And I think they're really trying to lean on this long-term narrative, right? Stick with us. We have better things coming, audiobooks, podcasts. But I think they're going to need to start generating some money soon, because I don't know how long investors will stick around. But right now, judging from the stock, they're okay where things are at the moment.
Yeah, you mentioned concerns about advertising. There's also, it is a subscription service at a time where consumers are sort of weighing how much they want to pay for every service, right? The podcast side obviously continues to be a big bet for the company. What do we see on that front?
Yeah, so the expectation is really high here. During Spotify's most recent investor day, the CEO did say that he sees the podcast unit generating margins between 40 to 50%. At the time, the stock surged on that news because that would be great for the company. But again, they really reiterated that this is a long-term play, that they're still in growth mode and investment mode. But Spotify has been a public company for a pretty long time, and the fact that it's not profitable yet, I do think is an underlying concern, and that's something that a lot of analysts have noted. They did say that we'll see more advances in the podcast space as well as audiobooks in 2023. Podcasts, there's over 400 million on the service at the moment with more room to run. And I think they really want this to be a driving force for the company. I think it is good that they are expanding beyond music, but still something to look at. And I'm sorry, I'm going to correct myself. 4.4 million podcasts, not 400 million. That is a lot of podcasts. That is maybe like a 20-year plan, but 4.4 million, I think, still relative to competitors is still significant.
Yeah, incredible to think that there's still a lot of runway, right? That's what we keep hearing around podcasts.
It's still in the early days, right? Even though it's saturated in certain ways, I think there's a lot of growth and a lot of ability to get a little bit creative there.
Yeah, we'll be watching the growth story there. Allie, thanks so much for that. Well, coming up next, Cathie Wood's ARK investment buying shares of this stock after selling Coinbase. We'll reveal it on the other side. We'll be right back. Well, the SEC's investigation into Coinbase appears to have rattled Cathie Wood, the longtime Coinbase backer, selling over 1 million shares in the company for the first time this year. Our very own Alexandra Semenova here with me at the desk. I'm going to just call you the Cathie Watcher.
Yeah, I basically am
checking her portfolio.
at this point always keeping up with what she does. Yesterday, 3 funds across ARK sold 1.4 million shares of Coinbase worth about $75 million as of yesterday's close. The lion's share of that came from her flagship ARK Innovation ETF. And this, of course, came after Coinbase lost about a fifth of its market value yesterday following news about the SEC probe, bringing total losses down to 80% year to date. And important to note that ARK has been selling Coinbase at all-time lows. It has been purchasing the stock at an average price of $255 a share, selling it yesterday at $53 a share. So locking in really tremendous losses there. And it was also the third largest holder of the company as of the end of last month. This is obviously a big statement about Cathie Wood's confidence in the company, because she has been a big, crypto bull, a big proponent of Coinbase, steadily buying up shares even during the worst of days of its sell-off. So now that she's kind of parting ways with Coinbase, it says a lot about what she sees about the company, though notably, as she sold Coinbase, she bought up shares of Shopify, of course, after the 14% sell-off yesterday. Very on brand for Wood to be buying the dip.
Yeah, buying the dip, and Shopify getting a bounce after, although we saw a significant decline yesterday. We've also been seeing a bit of a pop here in semiconductors, led by Texas Instruments today.
Yeah, semiconductors also in the spotlight today following the report, the earnings report yesterday from Texas Instruments, which what was particularly notable to investors was the guidance that they put out, countering some of the recessionary fears that some people had about the chip industry. We are seeing shares of companies like Qualcomm and Intel up as much as 2% today. The Philadelphia Semiconductor Index was down about 30% year to date, of course, amid growing bearishness, over the industry and, supply chain issues, all the worries of an economic slowdown and a slowdown from the big boom in chips.
Well, and Texas Instruments also expected to get a big bump, one of the big beneficiaries of the CHIPS Plus bill, if in fact it does pass the Senate, goes over to the House. All right. Here's a story that you can probably relate to, you too as well. Flying has undoubtedly become tougher this summer with ongoing delays and cancellations. Flight tracker site FlightAware has a list of the worst flight delays at the world's busiest airports. So let's take a look at the list here. Toronto Pearson at the very top of the list, Montreal, Frankfurt, Paris, as well as Lisbon. In terms of U.S. airports, Chicago Midway, Orlando, JFK, Newark, and Baltimore rounding out the top U.S. airports that have had the worst delays. I will tell you, I recently flew through Toronto. It was like, you hear so many horror stories there about people being stranded. A little terrifying. My delay was not as bad, but certainly some people who had to stay out there overnight because their flights were canceled.
Yeah, and a lot of the European airports also leading the list. I've heard anecdotally from friends who are traveling to Europe now that they're experiencing really nightmarish delays, having to stay at airports overnight, not being able to book new flights. I personally was at the airport in Paris about 6 weeks ago, and the line there was just, it took up so much time. Going through TSA was a nightmare. Really hitting there.
Yeah, I mean, staff shortages certainly playing into that as well. The U.S., we've seen some improvements on that front. Can we show the top 5 again? I was going to say, I'm a little surprised that Heathrow is not on that list, or maybe it was. Keep hearing about a lot of the delays.
Another interesting thing that I read was that apparently people are so worried about losing their luggage that they're taking liquids on to the flights with them, and that's worsening the delays because as they're going through the checks,
Yeah, I mean, this is also the busiest time of year to travel, the summer travel there. So certainly becoming less and less pleasant, I would say. All right, Alexandra Semenova, appreciate you joining me at the desk here. Coming up on the other side, monkeypox cases rising in the U.S. and across the world. We're going to break down everything you need to know on the other side. Well, monkeypox cases are on the rise with over 3,000 cases confirmed in the U.S. Regulators here and in Europe bolstering their response. Joining us with more is Yahoo Finance's Anjali Kamlani. And Anjali, it's been troubling to see those numbers tick up in the U.S. Already has one of the highest case counts in the world. What's your read, or what are you hearing in terms of how far, scientists, doctors are in terms of trying to control this?
Well, experts do believe that we still have a chance to really control the spread. Right now, we're looking at a spread in all but 4 states in the country. And we just saw the first case of a pregnant woman being infected, as well as the cases are now showing up in jails. So we're really seeing this concerning spread of this new disease. And that is, prompting a lot of discussion, especially at the federal government level, of what the correct sized response is. Internal estimates of the Biden administration, according to the Washington Post, could be $7 billion needed in order to mount a full attack against this. This is why, the World Health Organization really looking at that public health emergency. Meanwhile, over here, we're not quite at that level yet, but we are seeing, some states really pick up in what they're doing. The U.S. now leading with cases. Globally, we've seen, concerns about how it's spreading, why it's spreading. And what hasn't really been, I think, enforced enough is really who's at risk, because so far we've seen that it's sort of, the discussion has remained on how to discuss who is at risk. And it is still remaining men who have sex with men. But we've, of course, like I said, that pregnant woman getting infected, so you are able to get it with close contact with an individual, not necessarily just through sex. So it's a lot of discussion still happening about how to really make sure that the American public is aware and remains safe.
Yeah, the key here being, getting the messaging out in front before it spreads even further. You talked about the World Health Organization's declaration of public health emergency. What exactly are the implications?
So the implications are really ensuring that the emergency response, kind of like what we saw with COVID, right, is really put into effect. Now, Europe has done a really good job of now following suit. They're making sure that the vaccine doses are available across the countries, as well as ensuring that all public health measures are really being put in place. And what do those public health measures look like in terms of making sure people are safe, making sure that people are contact tracing or testing, and testing is available. Now, we do know that the CDC did and the FDA have expanded the manufacturing of the vaccine. We know that they've expanded testing as well to include the private sector. So all of that put together is really where we stand right now in that. But, in terms of declaring a public health emergency here in the country, as well as looking at broad-based at the, at a response, that's still in the works right now. So it's really prompting some critics to say that we're lagging once again in a response to an outbreak.
That begs the question, what are they waiting for?
I wish I knew the answer to that question.
Yeah, really quickly, it's always worth reminding, I think viewers who are still trying to get read up on this, what specifically, or what are the steps that can be done? What precautions should people be taking?
Still the same stuff that kind of applies to COVID too, which is, the point to be made, of course, is also that we're now have 2 outbreaks that the country is now focusing on. And they do have some similarities in terms of the symptoms that show up and how to avoid really close contact with people, make sure that you are, practicing safe distancing measures. Masking is still a very useful tactic as well. We know that there isn't as much known about respiratory, droplets or that kind of transmission, but exposure to respiratory secretions like mucus saliva, that's another thing to look out for. So all of this is still, a learning process for everyone. We know that it has been an endemic disease in parts of the world, but we're just seeing it for the first time spread this much across the country. So that's where, the focus is right now.
Yeah, troubling developments, certainly. Anjali Kamlani, appreciate you staying on top of that. Coming up on the other side, consumers buzzing over canned alcoholic drinks this summer. We'll hear from Drizzly CEO Corey Bayless on the other side of the break. Welcome back to Yahoo Finance Live. Well, here's a question for you. Can the can maintain its relevance? Consumers this year favoring pre-mixed canned cocktails when drinking at home. This is some newer generations considered sober, curious options. A look at the business of booze delivery. We've got Drizzly CEO Corey Reles, as well as our very own Brooke DePalma joining in on the conversation. Corey, I want to start big picture before we get into the canned drinks, though, because you are one of those businesses that saw huge gains during the pandemic. How much of that demand have you seen pull back since?
Well, it's actually been probably the most beneficial category from an awareness perspective, pre-COVID relative to post-COVID, in terms of, can I get alcohol online? Can I purchase anything online? So we haven't seen the pullback that we might have expected, even as consumers are going on-premise, wanting to travel, wanting to get out there. I think we've seen gains that have really solidified based on that awareness of being able to purchase legally online.
And Corey, lots of delivery services are getting pressure over delivery fees from consumers. I know that Drizzly has a $5 fee in most markets, but what exactly are you hearing from consumers about that fee? And do you have intentions to raise that fee?
No intentions to raise that fee. Actually, the fee is set by the retailers themselves. So this is an open marketplace. The retailers can decide how they want to participate in it. And it's actually highly variable depending on how far they're going, what they're selling, who they're selling to. So in fact, we actually see that fee declining over time, especially as inflation and some of the just overall price pressure takes hold. We're trying to find different ways to lower the overall cost of e-commerce for consumers.
So Corey, let's talk about what you are seeing in terms of what consumers are ordering. I'm personally curious about the non-alcoholic, because I'm not an alcoholic drinker, but we tease the canned mixed cocktails. So let's start there. How big of a demand on that front?
Well, this has been a huge change. And I think one thing that's really fun about the alcohol space right now is the pace of innovation. Canned cocktails were not a thing 4 or 5 years ago. And actually consumers saw hard seltzer, which is usually malt beverage, relative to cocktail-based cans, is sort of the same category. That has now been able to be split apart through education and merchandising. So that is growing significantly. It started on the beer side. Now it's moving to spirits and wine. This is one of the fastest growing segments for alcohol overall. And it's gone from effectively 0% market share to over 3% market share on Drizzly just in the last 18 months.
And earlier this year, we heard from Pernod Ricard executive that at-home cocktails were stirring up a resurgence here, that we're seeing a lot more people making drinks at home. Of course, earlier this year, the espresso martini getting lots of attention there. Where exactly are you seeing customers flock to right now? Are they still making those drinks at home?
Well, you reset this whole thing with COVID as more and more people started to embrace cocktail culture, wanting to try new things at home when you didn't have access to the bar and to the bar scene. All of a sudden, you started to see people trying new things. It's extended now into the ready-to-drink cocktails. I think tequila is the big winner here in the type of alcohol people are drinking at home. So it's slowed a little bit relative to the last 2 years, but overall, I think we've reset the ability for consumers to basically try to make cocktails at home relative to previously they would just go to the bar for that moment or that experience.
And Corey, we were showing the numbers earlier in terms of, who's really interested in these non-alcoholic drinks. We were talking about this earlier this morning. I know a younger demographic. I'm certainly not Gen Z. I haven't been drinking. How do you, as a platform that started with alcoholic drinks, how do you cash in on that trend?
Well, I actually think it very much fits our mission. And we want to be there for the moments that matter and the people who create them. That is a lot of times right now with non-alcoholic drinks. It started, again, more so on the beer side. And now it's moving towards wine and spirits as well. And I think there's great options. I think there's a lot of great innovation going here. You're talking about 25% of millennials and nearly 40% of Gen Z who are substituting some sort of non-alcoholic drink into those occasions. And it's really actually quite something to see how seamlessly it's done and how it isn't taking away from what was previously a very alcohol-forward moment. So a lot more innovation here. I don't see this one slowing down for a long time.
And one category I want to dive into quickly is hard seltzers. Last year, we saw Boston Beer Company throw away millions of cases of their truly hard seltzers. Gen Z is certainly getting influenced by other categories out there. So what exactly are some name brands that Drizzly customers are flocking to here?
Well, I think you're still seeing the big brands, obviously, Boston Beer making one of the top three there. But this is a little bit of a tough story, not because the deceleration has happened most recently, but this is, again, a category that went from 0 to over 3.5, nearly 4% of Drizzly, and then also on-premise sales over the last 2.5 years. It's just slowed down in the last 18 months. So I think it's created a new category. I don't think it's decelerating or actually decreasing as a total amount, but there is a little bit of a shift more from the hard seltzer to the ready to drink cocktails as consumers appreciate the difference between the two. So I think it's still a big category. The second derivative growth rate has definitely slowed down on it.
Yeah, well, alcohol or no alcohol, it all adds up to healthy revenue for your company. Drizzly CEO Corey Relis, always good to have you on the show. And our thanks to Brick De Palma as well. I want to get to some breaking news coming out of Washington, D.C. here. President Biden now delivering remarks from the Rose Garden after testing negative for COVID-19 and coming out of isolation. Certainly an opportunity for the president to address the nation on the government's progress against the virus. But again, the president making public remarks for the first time since testing positive for COVID days ago. He's obviously undergone treatment since then and is now coming out after testing negative. Coming up on the other side, Hilton's Q2 earnings boosted by strong travel demand. We're going to be joined by Hilton CFO Kevin Jacobs after the break. Well, the travel boom is boosting Hilton's earnings as it blew past estimates in the latest quarter. The company raising its full year guidance to the quarter's strong results, coupled with its confidence in continued recovery throughout the year. For more on the road ahead for Hilton, let's bring in Kevin Jacobs, Hilton CFO. We've also got Yahoo Finance's Brian Sazzi with me here at the desk. It's good to talk to you today. Certainly a very strong quarter for you. We're seeing a big bump in the stock on the back of the numbers. It's an interesting time to look at the travel rebound because you've certainly seen the pent-up demand from the last few years, but it comes at the same time that a lot of consumers are kind of assessing their options with higher costs. Talk to me about how you've been seeing that balance play out.
Yeah, first of all, thanks for having me. It's always great to be with you guys. And yeah, we did have an amazing quarter. And I think, look, the way right now we're not seeing people balancing that with higher costs, right? I think people are used to paying higher prices, for everything in their lives. And, you mentioned, Akiko, the pent up demand for travel. We're really seeing that as people shift their spending, particularly the U.S. consumer, but consumers all around the world shift their spending from goods, that they were buying a lot of, obviously during lockdowns and the pandemic, to services. There's a ton of pent up demand for travel. And our consumer is a strong consumer, right? We tend to skew more towards the higher end consumer that is still very, very robust in terms of their spending, and they're spending it on travel. And so we're having a record summer.
Kevin, is it fair to still be calling the demand you are seeing revenge travel?
I don't think so. I mean, I think there's still a fair amount of that where people, you've talked to anybody in your lives, right? I mean, on the personal side, on leisure travel, we all have things in our lives that sort of got delayed during COVID, whether it was a trip or a wedding or a social occasion. But we're seeing it in all segments, right? Our business transient, RevPAR in June was above 2019 levels, for example, and that continues into July. So we really see it across, and then, group, where people maybe think there isn't a robust demand for meetings, right? We're seeing group in the second quarter recovered to 85% of where it was in 2019. And we think by the end of the year, it'll be largely recovered. Our group position for the back half of the year is ahead of where it was in 2019, for example. And so I don't know if it really was ever fair to call it revenge travel. I think the way to think about it is there's a lot of pent up demand for travel, and there are a lot of factors, include, spending, Asia Pacific, for us, we're a global company, so Asia Pacific's behind. That'll be a tailwind for us. You've got an infrastructure spending that's coming down the line. And again, I mentioned the health of our consumers. So I think it's just fair to say that the demand environment for travel is just very robust right now.
Kevin, I want to lock in on three brands in particular you talked about in the earnings release. Embassy, Hilton Garden Inn, and Hampton. All three of those chains stood out to me because they had over 70% occupancy in the second quarter. What is it about those chains that is driving that strength?
Well, I think, look, all of our brands are doing well, and occupancy is recovering across the board. I think if you're talking about those brands, first of all, they have a lot of distribution. They're spread across the country, and they tend to cater to people that are seeking, value at that end of the spectrum. So I think that's part of their secret, is just that they deliver a high value. But we mentioned some brands, and you can look at the occupancy numbers and they may be a little bit different. But like I said, we're experiencing strong demand really across our brands, across our chain scales, and across geographies.
You mentioned that you raised your full year guidance. You said you're not necessarily seeing consumers look at this as a trade-off between travel and then costs at home, partly because you do cater to the higher end. I'm wondering what you're seeing going into year end, into travel around the holidays, for example. I know months ago we were talking about people planning way ahead. What does that look like for you right now?
Yeah, booking windows are still pretty short, so it's really hard for me to, for us really to have a lot of visibility around the travel season. I think it will all come down to, what's going on in the macro environment. We think, again, demand will be quite strong. We don't see any reason to believe that the travel season will be different, but we tend to, on the transient side, have sort of 30 to 45 days of visibility, even though, you might think that, for travel periods and for holidays, I would recommend people book in advance, but generally speaking, we don't really have that much visibility. But we do expect a strong, balance of the year, which is why we had the confidence to raise our guidance.
Kevin, I'll take one for the team here. How did you come about to develop this Paris Hilton marketing campaign, and how will you measure success?
Well, look, the second part's pretty easy. We have lots of ways to measure ROI in the marketing space. I'm not a marketeer, but we do have a lot of smart people that measure success. And there's all kinds of ways you can measure engagement through social media channels, and ultimately whether it turns into business. And how we came across, doing business with Paris. We've sort of always had somewhat of a relationship with her and her family. They're obviously a big part of our history. They're not directly involved in the business anymore. But Paris is great. I've spent some time with Paris as part of the work we've been doing with her lately. And she has a lot of pride in our business. Obviously, she shares a name with us and a history. And so it's actually been a lot of fun. I think our marketing teams have had a lot of fun working together with her. And it's early days, but we've had some good receptions to her ads and that she's done with us. And hopefully that will continue.
It certainly got us talking, right?
Got to get her on the earnings call next time, Kevin. Get her on the earnings call.
Maybe that's the next step. We'll bring her into finance.
Here.
We'll get her on the finance and IR team.
Embrace the history. And as you said, certainly they're not, part of the business now, but it got a lot of people talking about the Hilton brand.
Listen, she's very talented. She's an amazing marketer, and she moves the needle. So our social engagement and the things we've done with her and her husband Carter across their honeymoon were really, some of the best social engagement we've ever seen.
Kevin Jacobs, Hilton CFO, really appreciate you joining us today. And our thanks to Brian Sozzi as well for joining in on the conversation. Let's do a quick check of the markets as we count down to that very important Fed decision coming up in about 2 hours. We're looking at all three major indices in the green. The S&P 500 up about 1.5%. The Nasdaq, the big gainer today, up about 2.5% there. Obviously, we've been talking about Microsoft as well as Alphabet earnings, another big one on tap. Coming up this afternoon, Meta reporting their results. We're going to be watching that one closely. And of course, 2 o'clock this afternoon, live coverage of the Fed decision. Our very own Brian Chung is going to be out there covering that decision. We'll have live coverage of the press conference from Fed Chair Jay Powell at 2:30 today. Certainly a lot of investors going to be watching that one closely. We'll have it all covered for you right here on Yahoo Finance Live. Appreciate you joining us today. Keep it right here.
We've been talking all morning about Walmart's forecast cutting guidance for the second quarter and for the full year as well. It sent the shares tumbling. They're now down by about 8%, and they've been weighing heavily on the Dow, on the retail sector overall, on online retailers as well. There's quite a ripple effect. Joining us now with over 20 years of equity research experience, Jefferies retail analyst Stephanie Wissing. Steph, it's good to see you. Why did Walmart wait? This is the question that we've been talking about a little bit this morning. Target came out a couple times, kind of reset expectations. And the obvious question was, isn't the same thing happening at Walmart? And yet Walmart felt a little slow here to adjust expectations. Do you think that's the case? And if so, why?
Yeah, I think it's a reflection right now of just the contradictory data points that we're seeing out there. There isn't clarity in any step of the business right now. So I think part of it is waiting to have some degree of sensibility around just how deep the cut needed to be, and then recasting the back half expectations. I think for Walmart, to recall, they have a new CFO coming in. So the timing of that, I think, is also something to consider in the timing of the pre-release.
Stephanie, I think a lot of folks, and I'll count myself among them, think in times of economic stress, people trade down to Walmart. But that's not what this quarter or this pre-announcement says, right?
Yeah, I think you have to separate the headline from what lives beneath it. So at the headline level, that is true, that we are seeing particularly share gains in grocery. And for Walmart in particular, that's important because grocery is the lead category that drives customer acquisition. So I think we are seeing evidence of that in the top line figures. But it's what lies below it that was actually very surprising to me. And I don't know if you all felt the same, but this pre-release to me really humanized what's happening inside the household in terms of decision making. When we see consumers compromising wants to fund their needs because of inflation, that's a real human response. And that is what struck me about digging beneath the headline, is that there's this pivot happening from discretionary and general merchandise into necessities. And the household is having to make discriminate decisions every single week about funding that inflation. So less of those wants categories and more of those needs categories. And then overall, taking share, particularly within the grocery category.
And perhaps what about how much they're actually buying when they do make that purchase? Because Sam's Club, even within Walmart, is one area that if consumers are seeing pressure for themselves, they might start to lean towards buying in bulk. Is there anything to suggest that this is going to permeate across even the bulk buying categories in this broader retail industry?
Yeah, we're seeing in the club channel that the traffic has been remarkably resilient. And just as a side note on club, one of the strongest customer acquisition tools for them is gasoline. And when gas prices spike, that tends to be a net beneficiary to traffic to their pumps. So broadly, we would say club is still an outlier to the positive. Bulk buying can actually be a way to save. And I think even broader on the gasoline side, it's an area where you can almost value hack, regardless of what your consumer income profile looks like. We know that even the high income loves to find a way to value hack the system. And gas tends to be the way that the club channel does that.
When I think about Walmart in this situation, I'm reminded of that ship that got stuck in the Suez Canal, right? You're talking about an enormous, enormous operation that now has to pivot and turn until it gets out of this. With the company of this size, how long is it going to take to make these necessary adjustments?
Yeah, I think it's an excellent question. I mean, the supply chain is still not seamlessly smooth. So we do know that there's digestion happening in terms of excess inventory and the timing of that inventory. But the only way to remediate that is to clear through and use discounts to do so. So I think our back half expectations now assume some incremental discounting to clear through that inventory, but also order cuts. And we know that that's happening as well. So you need to kind of turn off the faucet into the bathtub and open up the valve at the bottom to release more of the water in order to recalibrate to consumer demand. So we know that that's happening. But you're absolutely right. This is a big organization, one of the biggest buyers of consumer goods in the world, and certainly in the US. And that is going to factor into how long it takes to digest through. One of the things that they shared, which I thought was really interesting, is even despite deep discounts on some of these general merchandise categories, the consumer is reticent to buy. So that might also be a signal of just how promotional the holiday period is going to have to be in order to convince consumers that it's worth the purchase, even at a discount, but also maybe even compromising some of those needs for a little bit to buy into the wants. It's taking a lot more to shift the consumer as well.
Stephanie, what are the aftershocks to this warning for some of the companies that you in fact cover, like a Mattel, like a Hasbro, so the toy makers, even the makeup companies? Now are they suddenly at risk of coming out warnings of their own?
Yeah, I think there's a really good exercise now to go through and look at general merchandise exposure to the mass channel broadly. Clearly, we see Walmart being more grocery indexed, so their exposure to general merchandise is much smaller than other companies like a Target. But we're having to go through and really stress test our models one more time around order cuts. And I remember this in 2000 and 2008, where the cuts weren't big enough the first time. And we had to go back and do remedial cuts again. And there were downstream cuts that happened. So anytime we hear a company of this size cutting orders, we have to go through and look at the big suppliers. And that would include the toy companies, electronics, soft home, hard home. Clearly apparel is an area where they're seeing some weakness. So I think broadly, we're taking a closer look at general merchandise estimates for the back half of the year and even into 23 at this point. I think it's smart now to start to look at this as the first stage of what might be a multi-quarter phase of reduction in inventory.
Steph, thanks so much for joining us here today. Always a pleasure to get your perspective and insight on all of these retail market players, but especially Walmart here on the day on this massive news from the company. That is Steph Wissink, who is the Jefferies Senior Research Analyst. Thanks so much.
Shares of McDonald's on the move this morning, up about 1.75% after reporting an earnings beat for the second quarter before the bell. You can see missed on the top line, but did beat on the bottom line. All of this happening as the rising cost of food and consumers trading down to value items due to surging inflation. For a little bit more on the breakdown from this morning's report, let's bring in BTIG's restaurant analyst, Peter Saleh, for more on the report. And also with us is Yahoo Finance's Brooke DePalma. Peter, give us the breakdown on what you saw in here. It's an interesting story where they're experiencing the higher cost of the inputs, but maybe people will be trading down to eat more at McDonald's in this recessionary environment. What did you see as the green shoots for this company?
Yeah, great. So thanks for having me on. Look, I think it's definitely better than feared. I mean, if you look at their same-store sales on a global basis, they improved sequentially on a 2-year stack basis and a 3-year stack basis from 1Q into 2Q. If you look at the U.S. number, you see that sequential acceleration on a 1, 2, and 3-year stack basis. So I think it relieves some fears that consumers were really slowing down. We were hearing going into the quarter that the U.S. comp was improving from March into April, into May, and into June. So I think it's rather healthy. And I think in this environment where we continue to hear record gas prices, record inflation, for them to have essentially flat traffic and a beat on same-store sales of 3.7%, I think that's really good news in this environment.
And Peter, to jump off of that, drive-through percentages are pretty much back to where they were pre-COVID. Delivery still a bit elevated to where it was pre-COVID. How much of an impact do you think that those fuel prices have on consumers getting out and, say, going to their local McDonald's?
Look, I think that we've looked at this in terms of fuel prices rising and the impact on traffic and same-store sales. We've looked at it every which way we could find. And historically, we've never been able to find any real correlation between rising gas prices or declining gas prices and same-store sales or traffic. I think it's really mostly correlated with income growth and job growth is what we've found historically. And right now, we continue to see more jobs being created. There's a shortage of labor, and incomes are rising, as is inflation. So I don't think that the inflation in fuel prices is going to have a long-term effect right now on the same-store sales, and we're not seeing it even near term.
So, Peter, let's talk about the impact to McDonald's when we talk about inflation. Obviously, they're having to deal with higher food costs, but also higher labor costs, too. I mean, it certainly doesn't feel like that's going away anytime soon. How does that cloud the outlook for the company? How do you see those factors weighing?
Yeah, look, it's true. I mean, we're seeing a lot of commodity inflation, call it low to mid-teens commodity inflation, double-digit labor inflation. It's across the entire industry. It's not just specific to McDonald's. Every restaurant is seeing it. But we're also seeing that at grocery store prices as well. They're going up. But the bottom line is the one real lever these restaurants have and McDonald's has is raising price. And they've been doing so. And it's all about timing and when you raise price. And prices have been going up. We're hearing, McDonald's 8 to 9%. In some cases, in other restaurants, it's a little bit higher. In some cases, it's a little bit lower. But that's what they got to do to offset this inflation. If you look at the margins actually improved from first quarter to second quarter, despite the fact that inflation accelerated. So overall, they're managing it well, despite the fact that we've got this record inflation, and that's really going to continue into the third quarter and before it moderates in 4Q and maybe into 2023.
And Peter, on the call this morning, executives used the buzzword of recession many times over, saying that they continue to hope to provide affordable options if that is the case. Now, for our audience of investors here, do you think should a recession happen that McDonald's could be a recession-proof stock?
So, historically, I think consumers cut spending of restaurants early before you go into a recession or right at the tip of a recession. So we're not seeing that, I guess, at this point. And look, I think for McDonald's specifically, I think, one franchisee put it best, in recessionary environments, they do well because people want to gravitate towards familiar brands that they trust, that are going to do right on the pricing and the value orientation. So I think, this is probably one where investors are, to a certain degree, hiding in the name because it does tend to perform a little bit better in downturns.
Peter, the labor story, very interesting as well. We know that was a big reason why margins are getting a little bit more difficult for these types of companies, but they're trying to do drive-through voice ordering. Now, this is a test thing, right? But do you think this is going to be pretty important for their automation efforts over at McDonald's?
So absolutely. I think the point of ordering in the drive-through is where the bottleneck is. It's not from the kitchen. So I think if you get the voice ordering down, the accuracy is improving every day, and the computer never forgets to try and upsell you. So they get that technology working. I think they can improve service times pretty meaningfully, and really with that you can improve same-store sales. So I think the technology is almost there. We're hearing some varying things about the accuracy. Some franchisees are telling us we're hearing 95% plus accuracy. Others are saying it's in the low 80s. We think once it gets up into the consistently up above 90%, 95% order accuracy, I think you'll see it deployed across the system more meaningfully.
Peter, you've got a $280 price target on the stock. Certainly a little upside to where we are right now. What do you think is going to be the biggest driver here, and how much of this is really contingent on McDonald's being able to keep up with those higher costs you alluded to by adjusting their prices?
Yeah, well, clearly the biggest driver is going to be same-store sales. I think the loyalty program is also working to drive new customers and feed them a lot more information about how their customers use their brand. So I think those two will be the drivers here to get us. But I also think, once we inflation is starting to peak. I think 3Q will look similar to 2Q. But once we get into fourth quarter, if inflation starts to come down, I think you can start to see the stock really move higher if same-store sales are holding up while inflation's coming down.
Okay, we'll be watching that one closely. Peter Saleh, restaurant analyst at BTIG. Always good to have you on the show. Appreciate your time. And our thanks to Brooke, too, for joining in on the conversation.
inflation is not just the domestic story, it's also part of the global growth story. Another news headline that crossed this morning, the International Monetary Fund painting a grim picture for 2022 as it again slashes its forecast, now projecting 3.2% growth this year. That's a noticeable downgrade from its previous projections. And the big reason, global inflation. The IMF expecting that prices this year will rise 6.6% in advanced economies and 9.5% in emerging market and developing economies. Here with more on that report is the IMF chief economist, Pierre-Olivier Gourinchas, joining us live on the program. Great to have you on the program. Just walk us through a little bit more exactly what the weight is of global inflation on the forecast, a noticeable downgrade from the last round of forecasts in April. How worried are you about global inflation tipping us into a global recession, perhaps?
Well, good morning. And you're right. I mean, pushing inflation has been one of the three factors we've highlighted behind the downward revision in our projection update. And the way inflation plays out here is that it's eroding purchasing power for consumers and households. And so that's leading to less demand. But it's also affecting their views on the outlook. It's creating uncertainty. It can increase their sense that maybe the future is less certain, is less secure. And it leads central banks, as we've seen the Fed doing in central banks around the world, really pretty much in every country maybe except China and Japan, to tighten monetary policy. And that tightening of monetary policy is also going to slow down economic activity. So that's one of the three main drivers of our revision.
So let's break down some of what we're seeing, where we're seeing that inflation come through from. Obviously, energy, a big one that we've been watching very closely. When you look at a place like Europe, there's still a lot of questions clouding the outlook there about what that supply is going to look like, both on oil as well as natural gas. How do you assess how significant a headwind that's likely to be as we look into next year?
Well, in the European context, this is where the second factor is playing out, and this is the impact, the continued impact of the Russian invasion of Ukraine and the impact it has on energy markets. And so we're revising down also our growth projections for the euro area, especially in 2023. In fact, in 2023, we are projecting that growth will slow down to about 1.2% for the euro area. But we're also flagging that there are important risks to the downside related to the supply of gas from Russia to the euro area. And if we were in a scenario where those Russian gas flows to Europe are fully shut down, then there would be another layer, if you want, in terms of the downward revision. And we're anticipating that it would knock off another roughly 0.8 percentage point of economic activity in the area. So this is sort of the second major factor that leads us to revise our projection is the slowdown we see in the euro area related to the impact of the war.
Well, as a follow-up, I want to ask about the central bank policies around all of these headwinds. And when we talk about, for example, the European Central Bank hiking rates last week, the Federal Reserve having an important meeting tomorrow where they're also expected to raise interest rates, that's all supposed to get prices down. But as you just outlined, a lot of the price increases are due to something that's completely out of the central bank control, which is what's happening over in Eastern Europe. So do you worry about a central bank policy mistake here and hard landings, not just in the United States, but in other parts of the world as well?
Well, look, there are different sources behind the inflation numbers that we're seeing right now. And certainly, there are things related to energy and high oil prices and gas prices, for instance. But there are also, and supply chain disruptions, there are also demand factors. The fact that a lot of households came out from the pandemic with excess savings, what we call excess savings. They may not be seen as excess savings from the perspective of these households. So we have a combination of factors. But let's step back and think about where we were in terms of monetary policy back at the end of 2021. Conditions were extremely accommodating because central banks were trying to support their economies during the pandemic. And so it's only natural that at the very least we remove that level of support when we're moving away from the pandemic. And at the same time, we're facing these extremely high levels of inflation. So central banks have to tighten. They don't really have a choice at this point, regardless of where inflation is coming from. And we actually look at what a number of them are doing, and we think that this is more or less appropriate given the environment.
So they don't really have a choice here. Now, does that mean that emerging market central banks also don't have a choice here? We're seeing a strong dollar weighing around the world. I mean, this is raising perhaps some chatter of, could we see a 1994 like Mexican peso crisis? Could we see a 1997 like Asian financial crisis again, as some of these countries maybe have difficulty dealing with a devaluing currency domestically? Do you see that as an issue as well?
We certainly see a lot of financial tightening around the world, and it is having a serious effect on emerging markets. We see, as you mentioned, we see the strength of the US dollar. That's actually implying more inflation in a number of countries because they import goods that are invoiced in dollars, and so they see higher prices for these goods. It makes it harder to service dollar debt. We're seeing capital flow out of these countries, emerging market economies in particular, and we're seeing spreads increase. So all of this is adding to the pressure. At the same time, we are not seeing disorderly market conditions right now in the EM space. What we are seeing is a number of countries that have actually improved their policy framework, the way they conduct their monetary policy, the way they manage their exchange rate, let it adjust when conditions change, as we've seen, the way they try to use their instruments that they have at their disposal to protect their financial sector, to prevent a banking meltdown and the financial sector panic. And so far, we haven't seen really any disorderly response in financial markets. So I want to say, yes, there is tightening. Yes, there is pressure. But as of now, we are not seeing anything like the taper tantrum of 2013 or the Asian financial crisis or even the Mexican crisis of 94, 95.
Let's talk specifically about China. You're projecting growth of 3.3%. That is well off the 5.5% that the government had set for itself this year. Obviously, the zero COVID policy playing into some of that as well. But I wonder, when you look at some of the headwinds, the risk factors in China, what concerns you the most? And we've been also watching what's been playing out in the property markets really closely. It sort of feels like the government is reversing its policy to really double down on some of that debt they were trying to slim back on because of where the economy is right now.
Yes, there's been that's the third sort of factor leading to our downward revision is China. And, when you put it all together, the U.S., the euro area, and China, the three largest economies in the world, being revised down. This is what leads us to our gloomy outlook, if you want. But on China specifically, we are projecting 3.1% growth in 2022. And just as a point of reference, this is the lowest growth number since 1976 in China outside of the pandemic. So this is really something that is big news. And it's on the back of, as you pointed out, the COVID-19 outbreaks and lockdowns that we've seen in the first and second quarter, and also the slowdown in terms of the real estate sector. So looking forward, the good news about China is that it has a lot of policy space and it's not facing very strong inflation pressures. So it can remain more accommodating in terms of its policy stance. And in particular, fiscal policy can play a role to try to support the economy, and in particular, vulnerable households that might be suffering in the current environment. So we're seeing that there's room for China's sort of rebound in the second half of the year and in 2023.
And if we shift over to the United States, I mean, they had a pretty swift downgrade in this report compared to the April projections. Does that imply that you see a higher risk of a hard landing here in the United States?
Well, the way we would characterize it is that under our baseline projections, there is a narrower path. The growth is, as you show on your screen, is projected at 2.3% in 2022. Then we're expecting a slowdown on the back of this tightening of monetary policy and also in the context of still elevated inflation to about 1%. But the Q4 on Q4 growth in 2023 for the U.S. is estimated at about 0.6% in our projections. And 0.6% is a low number. It wouldn't take much of a downside, a materialization of a downside risk to sort of knock off the U.S. from having positive growth. So we're seeing a very narrow path going forward, not necessarily a recession under the baseline, but certainly a very vulnerable situation.
Certainly a lot of layers to all of this. IMF Chief Economist Pierre-Olivier Gourinchas, it's good to have your time today. Appreciate you stopping by. Well, General Motors posting a steep drop in profit in the second quarter as the ongoing chip shortage continues to weigh on its supply chain. CEO Mary Barra emphasizing on the earnings call this morning the need for more chips to meet a healthy level of inventory. Take a listen.
If that, even as, or if I should say, if we get to a more normalized level that we don't have pent-up demand for full-size trucks, SUVs, and mid-size crossovers, we still have some work to do to get a healthy level of inventory, a very lean but healthy level of inventory. So that's what we're focused on, and frankly, we need more chips to do that. And as we move and continue to put more technology on vehicles, we need even more semiconductors.
Well, KPMG is out with a report this morning that says the semiconductor industry is on track for double-digit growth this year, despite some of those supply challenges. Joining us now is KPMG Global Automotive Sector Leader, Gary Silberg. Gary, it's good to talk to you today. I feel like every day some company is warning about the chip shortage. This has never been an issue about demand. The demand is clearly there, but the supply concerns continue to weigh on the sector. What do you see?
Yeah, absolutely, Akiko. And I listened to Mary. She's got it right. And unfortunately, I think there's more pain in the system for the next, 6 months and maybe even a year. So it's tough. And managing this, having the skills, the technology skills, the software skills, the industry is really struggling. And you can see it in their numbers. And I think you see it in other numbers when you'll see the earnings results. We at KPMG, and I think I was talking to you, I think it was you, back in late 2019, 2020, I don't want to brag, or we were somewhat prescient, but when we first announced our paper, we'll talk about today on the importance of the semiconductor industry, we walked through this issue. Little did we know we would have the supply. We didn't obviously predict that, but we are incredibly bullish long-term, just like Mary said, on this industry. It's going to be phenomenal going forward, but a lot of pain in the near term, unfortunately.
Hey, Gary, it's Brian Chung here. Well, it's fantastic then that we have you back on the show again. So give us a projection of what you see going forward so that we can bring you back on again in a few years to make sure that you were right here. But look, at the end of the day, what's becoming clear is that it's not just a supply chain story. The demand for these chips as cars get smarter is going to be just higher going forward. And the amount of plants, the amount of companies out there, enough to supply that over the next, say, 5 to 10 years.
Spot on, Brian. And when we talked, I think the last time about this in late 2019, early 2020, I like to keep it simple. 3 things. One, I call it the sexy electronics. So imagine, we're in 2025, 2030, 2035. You walk up to your car and it sees you, right? Facial recognition, or you put your hand up on the car and it recognizes your fingers. These are all chips and software that you're going to have to know it's your car. You'll sit in the chair like I'm doing here. It will recognize your body. It will move the seat. Those are all chips. You'll push the little button to start the vehicle if you're even driving it, and that will take off. And you haven't even started driving. And think of all the computer chips that I call it the sexy fun stuff that you haven't even started the vehicle. And, going forward, I can tell you there will be a world, and I'm talking with startups, like your windows going forward will be just data and information. You'll be able to perhaps even stream movies and, let alone what we're doing today. So it's quite a bullish outlook, at least in the 3 areas. We think the sexy electronics, safety, and even powertrain I want to talk to you about. These are massive growth opportunities for the semiconductor industry and for automotive.
Well, and it's worth noting, we've got a chart here that shows where the biggest growth driver expectations are. Cars have really moved up the ladder on that front, although wireless communications, phones still number one. We've seen, we're talking in a week where we're likely to see the CHIPS Act, or CHIPS Plus, I guess is what we're calling it, move through the Senate. You've also got aggressive incentives being introduced in places like Europe. I mean, clearly people see the demand. They're all jumping in, but this is a multi-year story. How big of a risk is there for overcapacity on the other end?
Great question, Akiko. So before that was announced, just in the United States today, you have Intel Corporation in the Chandler area, in the Phoenix Land area. I think they're building 4 fabs. They have over, I think, $20 billion in investment going up, something like that. You have TSMC, who's building now I think $12 billion worth of fabs in the Phoenix land area. Samsung has announced already building in the Austin land area of Texas. I don't know if that's $10 billion. These are massive bets that are being placed right now. And like you said, Akiko, this is for the future. And with this act, you're going to have more and more investment. So yes, there will be demand, but we all understand when supply and demand get into disequilibrium, especially with these billion-dollar bets, you could have unintended consequences. Let's just put it like that. And that could be what you just described is overcapacity.
Gary, and I want to ask, it's not just automotive. Obviously, wireless telecommunications with 5G coming online is very much a big part of this story as well. Is there a concern that, given the supply issues that we've just talked about, that, that might crowd out where the chips are going?
Well, it's an interesting point. So the high tech, the 4 nanometer, I guess they're at, and they're going lower. Those typically go on your faster consumer electronic products. Automotive, you design a vehicle, and it takes 3 years to really get to production. So you're sometimes not in the most cutting edge chips. So there will be this delay and where these chips might go going forward. But if there is overcapacity, then you're going to see prices come down, as which we've historically seen. What I find fascinating also about the demand side of this is if you look at the safety and the amount of safety going on in the cars these days, from ADAS, where the cameras around your car that can save your life. I was listening, I don't know if you heard the Tesla earnings call, but their car, they said on their call that their cars will be able to see, if they can see now, but they're able to anticipate accidents, and they're actually going to have your safety belt tighten up before you have an accident. I mean, the amount of cool safety, I talked about the sexy electronics, but the amount of cool safety things where the car drives you and can save your life, I just think the demand side, we don't really understand how big this is. KPMG, we think it will be a $250 billion automotive market by 2040, but who knows? It could even be more. I don't know. It's just going to be a future that will be fantastic for the consumer. We'll see where the supply demand end up.
Gary, finally, we're coming off of several years where the trend in the sector has been to go fabless. You mentioned a name like Intel. They are doubling down on manufacturing. TSMC is doing the same. As we look ahead to the kind of demand you're anticipating, are all these chip makers, the designers especially, are they going to have to go back to manufacturing to be able to meet this kind of demand? Is the pendulum swinging back?
Well, I think as you get into the more technical, I'm a wannabe quantum physicist. So, these are 100 trillion operations that go back in a second. That's just mind blowing. So having the skills to do that for the semiconductor players, I think that's something Intel thinks needs to be core to them. NVIDIA at the moment doesn't, and others, and Qualcomm. It'll be interesting to play out. It'll be interesting who takes what strategy going forward. I'm more biased just as I watch manufacturers like the Teslas of the world, where they vertically integrate and bring the core manufacturing to themselves as an advantage. But, these are billion-dollar bets, and I can completely understand why they don't want to do that at the same time also, Kiko.
Yeah, big bets, certainly. KPMG Global Auto Sector Leader Gary Silberg, thank you so much for joining us. Really appreciate it.
Well, crypto also tracking the equity market declines today. We saw Bitcoin falling below 21,000, still in that holding pattern of the low 20s. But one name that keeps popping up as we see consolidation in this space, and that's FTX. Well, FTX founder and CEO Sam Bankman-Fried is joining us now, along with Yahoo Finance's very own Dave Hollerith. So, Sam, you seem to be on a tear lately when it comes to deal making, most recently with South Korea's BitHum. And of course, media reports link you to any crypto exchange that appears to be struggling. So, first, what's the strategy with BitHum, and what's the criteria that you're using when you're picking your acquisitions right now?
So, when we're looking at the acquisitions, there are a few different, theories behind them. Some of these, and I think that you can look at the borrowed lending platforms that we interface with, are primarily about bailouts, or primarily about kind of buttressing the capital that these places have in order to protect consumers and to make sure there isn't contagion spreading through the ecosystem. That was certainly the reason that we started looking at Celsius, at BlockFi, at Voyager, and ultimately the reason we ended up sort of moving forward with Voyager, with BlockFi rather, on that respect, was because they had good risk management processes that had put them in a place where they were able, with a bit more cash on their balance sheet, to move forward in a strong direction. That's sort of one type. The other type that we look at is about expanding what our business is. And we tend to not view these as tech acquisitions so much. Some of these are looking at the regulatory side, some of these are looking at the customer base side, and some of these are really international expansion sides. And then, of course, there's Storybook for All, Good Luck Games, which is a little bit of a different story, which was a totally new industry that we wanted to explore interfacing with.
Yeah, Sam, I wanted to get on sort of the other side of that, which is the Voyager joint proposal that FTX and company put out on Friday, and it's since been rejected. But I was just curious, what was the idea behind that proposal, and is the deal dead?
So, yeah, it's a good question. And, the deal isn't necessarily dead. Like, ultimately, shareholders will get to decide what they want to move forward with. And I don't think we've seen sort of the final story on that side. We don't know for sure what will end up happening. But the philosophy behind it basically was, look, like, bankruptcy proceedings suck. They suck for everyone. They're really unpleasant. And customers end up getting screwed. In a number of ways. One is just like, by the time bankruptcy is over, a lot has been drained from the funds in the first place by the legal process. A second is that it just takes forever for customers to actually get their funds back. And a third, to sort of pile on to all of that, is that, in the end, you just don't actually have what you think you have sometimes coming out of these bankruptcy proceedings, where, if the asset prices move, customers can be exposed to that and actually end up with whichever is worse, what it was trading at the beginning and it was trading at the end of the bankruptcy proceedings. Those are all reasons that these can be a really unpleasant process for customers. And the core thing that we were thinking about is, how can we just make this as clean as possible for users and just not worry so much about trying to make money off of it or anything like that. That was explicitly something we were trying to avoid. With our offer, it was just like, what's the cleanest, quickest thing we can do here for customers? And that was basically, look, all the assets that remain with Voyager, we'll give them out to the customers pro rata, no nonsense. And we'll do that as soon as possible. We're just like ready to move on that, if and when the proposal would get accepted. And we even just made it non-binding. So if customers, even if that proposal were in general accepted, proposals could, customers could decide they don't want to do this. They want to go through, the longer bankruptcy process. And look, if that's what they want, that's fine with us. We don't want to be prescriptive about this, but we wanted to give them a more direct option.
Hey, Sam, with these recent acquisitions, you, FTX, are getting more and more control of this industry. I think it's a troubling thought for some people out there when they look at and they believe in the decentralization of crypto. And that's one of the most attractive parts of this industry to them. What do you say to that? Some of the critics out there that are saying, hey, you're simply getting a bit too big, or you're getting a little bit too large here for this space for just to have FTX to control.
My basic response is, look, on a lot of these deals, a lot of these bailouts, we reached out to everyone we could in the industry and said, hey, do you want to come in this with us? Do you want to do it yourself? Like, we'd love someone else to take this on. And we don't want to be the only ones doing this. We want this to be a broader, industry effort. In the end, the response we got from sort of other investors was basically, wait a minute, some of these companies look like they might have some financial troubles. And we're sort of like, yes, that's correct. That's why they need help right now. Like, I don't know what you're expecting. But most people just didn't want to move on it because of that. It wasn't what they viewed, their role in the ecosystem to be. They wanted to do like really safe, sound, high upside investments and not sort of like, investments that might lose. So we would love there to be more people involved in this. I think that would be great. We'd love other people to step up. That sort of didn't happen very much. And we think the single most important thing is that we do backstop the industry, and that is paramount. And, we'll do what it takes to do that. But yeah, ideally, other people would be joining in that with us.
So Sam, though, at least for right now, you do seem to be considered the sort of the bank of last resort for a lot of these struggling crypto companies. But how long can that last? How long can you keep bailing out some of these companies in terms of how much funding there is available to really keep propping the industry up?
Yeah, it's a good question. We obviously have to be conscious of that, right? And sometimes when we end up passing on one of these, right, when we end up deciding there's not really much we can do, a lot of the context often is, we know we don't have infinite ammo, right? We have to be like smart about how we use it, and we don't want to flush billions down the drain on one hopeless endeavor. Like a few billion is ballpark the amount that, we have to operate with here. And so, we can't bail out an infinite amount here, but we can do a non-trivial amount. We have done some, and we're making sure to keep enough in reserve that we could do more. If there, came a point where it was really valuable and important, and or urgent to do so. But yeah, it's not infinite. And, we would really love other people to come in and sort of like, help add to this pool of resources.
And Sam, obviously, it's a huge week in business. We have, big tech earnings, the FOMC, and then obviously the GDP coming out. And I'm just curious, in terms of what seems like the most impactful thing for the crypto market, like what are you paying attention to this week?
It's a good question. And part of the answer, honestly, is that things have become pretty correlated in a lot of ways. And, I don't necessarily want to say that's a great thing, but it is, I think, a true thing. And, more specifically on that, we've seen, the market get to a position where really what's driving all of this is, expectations about future inflation or lack thereof, right? And when you see market movements, a lot of what's happening is that there's been a shift in sentiment about whether monetary supply is going to be increasing or decreasing. And that's all coming from how will the Fed respond to these numbers coming out. So there's a first order impact of like how are earnings, and that will matter. But what's going to matter much more, frankly, is the read through from those earnings and from FOMC and other things to expectations about whether fiscal and monetary policy is going to continue tightening or is going to start signaling that it has done everything it needs to do and that, they're in a more stable place going forward. That's what I'm looking for the most is the Fed's reaction and, frankly, Congress's reaction to these earnings rather than the earnings themselves.
So Sam, say tomorrow we do get a 75 basis point hike. That's largely what is expected on the street, but inflation doesn't get under control and the Fed is forced to be a bit more aggressive than we maybe initially thought in the fall. What does that mean for crypto?
I mean, that's going to be a decrease in all risk asset prices, including crypto, most likely. Obviously not investment advice, and who knows for sure exactly what's going to happen. But, my strong suspicion there is that you're going to look at everything that's being priced versus the US dollar right now, and that includes crypto. That also includes stocks. And you're going to see those prices fall versus the dollar, or really what you're going to see is the dollar rise against risk asset prices on the expectation that monetary supply will further tighten because of the Fed feeling like they have to further reduce monetary supply in response to persistent inflation. On the flip side, if you see inflation look like it's starting to fall, you may see the Fed start to back off a little bit and say that they don't need to tighten more. That would signal a relative increase in monetary supply, decrease in the value of the dollar, and increase in risk asset prices, including crypto.
Yeah, on that note, just outside of the macro, cryptocurrency, for a lot of cryptocurrency advocates and investors, they want to see more usage, obviously, of it not just necessarily of Bitcoin, not just trading like a tech stock or something like that. So what kind of events are you paying attention to in the near future? I mean, the Ethereum merge seems like an obvious one, but for usage.
Yeah, it's a really good point. And right now we're seeing high correlations because a lot of what's happening is, things coming out of the Fed is, information about expected interest rates and US dollar supply, and those are dollar moves. But things that are going to be most important long-term are, the underlying technology and use cases. And, what's sort of like biggest and most important there, I think basically what we're looking at is where is this going to see adoption first? I think the ETH merge is going to matter. I think more generally, blockchain scaling matters a lot, right? Do the fastest blockchain succeed in getting to a million transactions per second? That's going to be a key thing to watch, because if they do, they're at the point where they could support global payments networks, global social media networks, global markets. If they fail to scale, that's going to limit the amount of adoption that they could get. That's going to be one thing. And then whether we start to see enough adoption that payments could plausibly happen over it, that both the buyer and the seller in a transaction might be using crypto. That's the second thing. And the third thing that I'll say is regulatory clarity in the United States. Huge thing for the industry, huge thing for protecting customers, and also a huge thing for allowing the industry to move onshore. And I expect updates on that over the next 6 months as well, and I'm optimistic about that.
Certainly lots to watch, and hopefully some of those transaction fees end up going down as well. A big thank you to Sam Bankman-Fried and our very own Dave Hollerith. Thank you both so much.
Welcome back. I'm Rhonda Lee. Everyone understands that home equity creates generational wealth. However, for Black and Latinx Americans, homeownership doesn't render the same result. Joining me now is Secretary of Housing and HUD Development, Marcia Flood. Thank you for being here, Secretary Fudge. So one of the things I want to jump into is the Tate versus Miller. I think most Americans have heard the story. It was in the task force action plan of the Black homeowners in Marine City. They had their home appraised. It was a low value. They had it reappraised, and it came back $500,000 more. You guys use them as an example, as a reason for the task force. So can you go a little bit into what this is and why appraisal bias is on the radar for PAVE?
Well, I would say to you that we did not use them as a reason for the task force. The task force was actually an idea of the president's when we went to Tulsa, Oklahoma, for their 100th for the 100th anniversary of the massacre. And so the president came up with the idea of let's try to find ways to create and build institutional wealth for people of color. The biggest thing we do in our society, in our culture to build wealth is home ownership. So if we start to devalue the homes of people of color and poor people, then we have taken away the opportunity to build wealth. I tell this to people all the time. I live 2 doors from an all-white community. I live in an all-black community. My home is valued at $25,000 less than the house 2 doors from me. My house is bigger. My lot is bigger. So I am losing equity and wealth every single year at an amount of $25,000 a year. So what we know is that in order for us to really be able to pass down to the generations that follow us the wealth that we should have, is we've got to make the process fair. We have to take redlining out of the process because we still look at certain neighborhoods as neighborhoods that are not valued. We have to take away the inherent bias that homes of Black and brown people are worth less. And so this whole concept of appraisal and valuation and equity is something that we know can only make things better for people of color.
Secretary Fudge, one of the things that I noticed in the action plan was that you mentioned, well, it mentions that appraisal bias was not included in the Fair Housing Act until 1988. So I think most people had just assumed that when the Fair Housing Act came out, that appraisals were included in that. But it wasn't until 1988 that appraisal bias, appraisers were included in the coverage of fair housing. So it wasn't until recently, in the past 30 years, that there has been a focus on, no, you cannot discriminate in undervaluing homes. And the Brookings Institute just came out with their study that showed that homes in Black neighborhoods are undervalued by $48,000 per year, accumulating to like a loss of $156 billion for Black homeowners. So when it comes to Black homeowners and they're trying to tap into that equity for college for their children, to refi, what kind of resolutions is the administration looking for to provide them?
Well, we've already started to see some, because right now DOJ is saying to people, it is a violation, it is discrimination if you unfairly appraise properties based upon people's skin color or the location. So we know that DOJ, CFPB, all of the agencies that look at fairness in our system have said it is discriminatory. Even though the Fair Housing Act pulls some of it out, we're saying across the board, if you discriminate, it is a violation of law. The other thing we're saying to people is that now what we want is more accountability and more oversight of the people who appraise. You have to understand, Ms. Lee, if you have a system where 97% of all the people who appraise properties are white, they have no concept of some of the biases that are inherent within with the system itself. So now we're saying to people, not only do we want oversight and accountability, but we also are telling people what their options are. You see, most people think if they get a low evaluation, they have no options, but they do. So we're teaching them about their options, and we are saying to the agencies that oversee it that you've got to do some things, and they are. So we are making some progress, slow but sure, but we are making progress because the light is so bright on the appraisal process today that people have to take account of what they have done historically, and they pretty much admitted that there is bias built into their system.
Secretary Fudge, one of the things that came from the housing pandemic boom was most people refi, and this is where appraisal bias really hurts homeowners. And the studies have shown that most Black homeowners did not or weren't able to take advantage of the pandemic refi boom. And the percentages that were denied refis were double that of white homeowners. So, like I said, this housing pandemic where everybody basically went and refied at lower rates, this was something that most Black homeowners were not able to take advantage of. How do we course correct that? Because at this point, rates are higher. They've missed out on the whole point of getting the equity.
Well, I do believe it's who you have your mortgage insured by. If you have an FHA insured mortgage, we are making sure that we contact the people that we know qualify for these mortgages. Now, I can't say the same thing for all of the lending institutions, but we are also looking at the fact that they too cannot discriminate. We are saying to them that if you have programs that are specifically set aside to assist underserved communities, there is nothing wrong with that. It is within the confines of the law. It is not discriminatory. So we are encouraging all of our lenders, and mind you, FHA, which comes under HUD, finances pretty much 80% of all of the new home buyers in the United States. And so we can get to them very quickly. And our people are saying to the lenders, this is our expectation of you. Yes, some of them missed out. There's no question about it. But since we have been here since last year, we have made sure that everybody that wanted to could.
In this episode of Influencers, Gina Raimondo, U.S. Secretary of Commerce.
The president has been very clear with us. We have to use every tool in our toolbox to help the American people and reduce inflation. We can't make nothing in America. You know, it's just, we have to, the balance is out of whack. We've taken our eye off the ball. To be a strong, vibrant global power, we need a strong, vibrant, advanced manufacturing industry in the United States of America. I really believe 20, 30 years from now, when we look back, or maybe even 10 years from now, when we look back at COVID and we look at what are all the lasting negative impacts, the biggest one will be what happened to our kids.
Hello, everyone, and welcome to Influencers. I'm Andy Serwer, and welcome to our guest, U.S. Secretary of Commerce, Gina Raimondo, here at the Department of Commerce. Secretary Raimondo, great to see you. Thanks so much for taking the time to speak with us.
Thank you. Happy New Year.
Happy New Year to you. I want to jump right in and ask you about chips and the semiconductor shortage. I know this is top of mind for you, and understand where things are, but also to sort of ask you about the connection between the shortages of chips and these reports of very high inflation that we've seen lately.
Oh, yeah. Thank you. So there's a direct correlation. I mean, the inflation numbers came out yesterday, and higher, I think, than anybody would want to see. But if you get under the covers of the numbers, you realize that a third of the increase in inflation is due to car prices. Which is stunning. A third is due to car prices. Why is that? Because last year, auto production of cars was down by almost 8 million cars, 7.7 million cars. So supply is down, prices of cars are up 20%, and the reason, like the single reason or biggest reason that car production is down so much is because car companies can't get their hands on enough chips. And they will tell you that. If you go to production facilities of cars and trucks, by the way, you will see many, many cars fully assembled, but for chips. So it's pretty simple supply and demand. I'm thinking back to EC 10, which I took 30 years ago. It's like we need to increase the supply of cars, so prices will come down. And in order to do that, we need increase in semiconductor chips. So there's really a direct link between the two, and we need Congress to act so they can fix the problem.
And so there is the CHIPS Act out there, and I'm wondering where that stands right now and then how that would address this problem.
Yeah, so it's kind of stalled in Congress, to be very honest. The Senate worked hard, got the CHIPS Act passed, I think last summer, and it's been a little bit stuck in the House. Speaker says she's for it. I mean, she does support it, but we need to move it. And so why does it matter? It is essentially it's incentives that the Commerce Department could provide to chips manufacturers so they will make chips in America. If you ever, have time for kind of a really scary read, you should learn more about how dependent the United States is on other countries, especially Taiwan, for our supply of semiconductors. Like right now in the United States, we make none of the most sophisticated semiconductor chips, none of them. And we get the majority from Taiwan. So apart from the fact that we need to make chips in America so we can make more cars, reduce inflation, create jobs, it's a national security issue as well. We cannot be a secure nation economically or nationally secure if we get 60-70% of all of our chips from a single company in Taiwan. So in any event, Congress needs to move. They need to take action now. It'll send money to the Commerce Department. We'll set up a program here where we work in partnership with semiconductor companies, asking them to set up shop in America, making chips in America.
And so would this bill then prospectively help NVIDIA, AMD, Intel, Micron, those U.S. companies set up fabs here in the United States, which cost $1 billion? They're very expensive.
Yeah.
And also, would there be money for foreign companies as well, say like Taiwan Semiconductor, to build facilities here?
Yeah. So yes and yes.
Mm-hmm.
Yes and yes. We need. They cost many billions of dollars, as you said.
I'm dating myself. I remember when they cost $1 billion. It cost a lot more than that. Right? Yeah.
It's multiple billions of dollars. And look, these companies could be building more fabs, or fab is just a word for a semiconductor facility where they make chips. They could build them now in Malaysia, Taiwan, lower cost settings. We want them and need them to build them in America, hiring Americans to make this stuff on our shores. And by the way, yes, we hope that once Congress does its job and gets us the money, we hope, Samsung, TSMC, companies that are not American, but in allied countries, will be eligible if they put their facility in the United States of America.
And just one more question about that. I mean, do you think companies really get it that the supply chain, which was optimized for cost, needs to be optimized for other factors as well, like security?
Yeah, I think they get it now. As you say, so well said by you, I mean, there's been an obsession for decades with just in time, obsession with efficiency. And we're realizing that in a world of severe climate change events where storms can take out a manufacturing facility, or pandemics or other kind of disruptions, you need redundancy, you need resilience. Quite frankly, you need stuff near you and near your customers, not all of it in Asia. So I think that absolutely they've learned a very painful lesson. I mean, if you talk to folks who run auto companies or trucking companies, it's been a really brutal year. I mean, like I said, their production is down so significantly. They've had to lay off workers. They have whole facilities filled with half-built cars and trucks. They can't finish them just because they can't get chips. So, yeah, it's been a huge wake-up call for the private sector around how to build in resiliency, redundancy, just in case, to their supply chain.
Does all that speak to a decline in globalism? And you're the U.S. Commerce Secretary, and I don't know what your thinking is on that. I mean, obviously you have China on your mind as well, and there are the political considerations that impact supply chain. So what is your thinking on that?
Yeah, I don't think it does. Listen, I think globalism is and should be alive and well. In fact, you speak of China. I mean, the president's very clear on this. We have to work with our allies as we confront the threat and competition from China. And we have to actually do a better job of that, working with our allies in the Indo-Pacific, with our allies in Europe. That being said, look, we have, the United States, over decades, has just watched our manufacturing base wither. I mean, quite literally just wither. We've lost, I think, 30% of small and medium-sized manufacturers in America, gone out of business in the past few decades. So, there is a balance. We need to work with our allies. These supply chains are enormously sophisticated and global, and they should be. I was in Malaysia at the end of last year, and I visited the semiconductor packaging facility of an American company. It's sophisticated, it's huge, thousands of Malaysians work there. That is a good thing, but we can't make nothing in America. You know, it's just, we have to, it's the balance is out of whack. We've taken our eye off the ball. To be a strong, vibrant global power, we need a strong, vibrant, advanced manufacturing industry in the United States of America with the workforce who can do those jobs. And that is a critical element.
I want to shift gears and ask you about Omicron and the disruptions that that's causing. And I'm curious whether the business leaders that you talk to consider this to be a long-term problem, a short-term problem. How are they seeing things?
It's a very, very good question. I think, look, everybody's done with COVID. You know, everybody is willing to be done with it, ready to be done with it, excuse me. I think they see it as short-term. Recently, in fact, just this week, I've been doing a round of check-ins with business leaders beginning in the new year. Folks are beginning to say it feels like we are peaking and going to start to come down the other side of the curve. It's anyone's guess how long it will take. Also, we're all hoping that there's not yet another variant. But I think there's a general view of optimism that these vaccines really do work. We have to get everybody vaccinated. There is increasing frustration from everyone, including business leaders, like why people still won't get vaccinated. But I think there's a view it's temporary.
And the labor shortages, I know I should maybe be asking Marty Walsh this question, but I'll ask you. How do you see those right now? Getting worse, getting better? And what are business leaders saying to you about that as well?
Getting better, but still a significant issue. I would say getting better, but still a real issue.
And the CDC reduced its quarantine guidance from 10 days to 5 days. Is that helping, do you think?
I think so. Yes, I think so.
Okay.
But still, folks got to get vaccinated.
Right. I want to go back a little bit to inflation, Secretary Raimondo, and ask you, beyond chips, are there other factors, and why is this difficult to address, perhaps? Or what is the best way to address it besides the chip situation?
Yeah. So, obviously the primary lever with respect to inflation is held by the Fed. So Chairman Powell and his colleagues have their work cut out for them, and I trust that they will do the right thing and use the tools in their toolbox to combat inflation. That being said, the president has been very clear with us. We have to use every tool in our toolbox to help the American people and reduce inflation. So some of that is getting all these supply chain disruptions behind us. The ports, congestion at the ports has been a huge issue. We've leaned into it. It is much better. The shelves were full for Christmas. But, we have to put that behind us. Anything that relates to supply, so again, back to Econ 101, supply of goods has to go up to meet demand so prices can come down. So whether that is the actions the president took around meat processing, to increase supply, of meat, whether that's chips, ports, anything we're doing to increase the supply of goods will fundamentally help to dampen inflation. Also, look, there are provisions in the president's Build Back Better package that will increase the labor supply. You asked about labor before. We have to get more folks into the workforce. Women will be able to get back to work if they have affordable child care, if they have affordable care for their elderly loved ones. Now, that's longer term. Build Back Better is kind of investing now for the future. But the supply matters. Supply side matters. We get more folks working. We got to increase the supply of goods so prices come down.
You sound like you're using a lot of your econ knowledge from undergraduate days. Were you an econ major?
I was
an
econ major,
yeah. Going back.
Yeah, exactly.
And sometimes they ask you, does any of this stuff, do you ever really use it in the real world?
Yeah, well,
you do.
I went on to study, I wound up getting a doctorate, so I come back to it frequently in this job.
Right, absolutely. You talked about Build Back Better. Are you optimistic about it?
I am optimistic. I am realistic. Mm-hmm. I am optimistic. It's going to get. It has to get done. It will get done. It'll look different. Whatever the president signs, this is a prediction I'm willing to make. The final bill the president signs, will look different than what he proposed. Will look different than what came out of the House. But fundamentally, it will be transformative. It will make these investments in climate, in workforce, in bringing down healthcare costs that we need. And yes, I think it gets done.
Can I ask you about broadband and expanding access to broadband? And you've kind of got two fronts there. People in urban populations who can't afford it, don't have access, and then the rural populations where it's an abomination, quite frankly.
Yeah.
Where do you stand? I know that's part of your remit as well, right?
It is. That's a huge piece of business here at the Department of Commerce. The bipartisan infrastructure law sent tens of billions of dollars to the Department of Commerce. Our job is to use that to make sure every American has broadband, rural, tribal, urban. Mm-hmm. You're exactly right. The issues are different. In urban areas, it's less about access and more about affordability. I was the governor of Rhode Island. There's no rural Rhode Island. It's urban. It's densely populated. There's fiber everywhere, but it's not affordable everywhere. So in those places, we have to work harder on affordability. Also on providing digital literacy to folks. In the rural areas and tribal areas, we have to lay fiber. And we have to use other technologies. Right now, it's so heartbreaking, Andy, to spend time, as I've done, in rural America. There is no broadband for miles, hundreds of miles. which means you can't work from home. You can't visit the doctor, with telemedicine. Your kids can't have virtual school. In tribal lands out west, teachers would literally drive worksheets once a week to their students so the kids could do the work on paper and then, mail it back or drive it back to the school. So anyway, yeah, we have to do it. We will do it. We'll do it in partnership with the providers. At the end of this mission, every single American ought to have high-speed, affordable broadband.
Also want to ask you about tech companies, big U.S. tech companies, and their struggles with the EU, and my understanding enlisting your help or asking for help from you.
Yeah.
Google, Facebook in particular. Where does that stand?
Yeah. So I think everybody recognizes that there is a need for changes in the way we regulate tech companies. That being said, some of the provisions being debated in the EU feel discriminatory. They're specifically designed to only affect 3 or 4 companies in the United States of America. And that, that doesn't feel right. And so what I'm saying is, yes, of course, update regulations, change regulations, be pro-competition, be pro-transparency, be pro-privacy, but don't just specifically take aim at 4 companies in the world, and also just have an open ear to some of the legitimate concerns of American and American business.
That must be a tricky balance to strike. I mean, they're not just 4 ordinary companies, right?
Yeah,
I mean,
exactly.
they're pretty remarkable with huge
Yes.
amounts of power. And then there's people like Lina Khan who have very, perhaps different perspectives, perhaps, but certainly a mandate that would suggest that their power is maybe too large.
Yeah.
And so how do you factor that in?
Yeah, and by the way, that's true.
Mhm.
You know, the president's been very clear about this. Like, we are pro-competition. We do believe there's legislation working its way through the House and the Senate in America right now dealing with that. That being said, some of the provisions of what the EU is considering is, you know, as I said, there's not taking into account some of the very real concerns related to cybersecurity and privacy and security that American companies have, and we're asking the EU to have an open ear to that.
Right. What part of your portfolio are people not aware of, Secretary Raimondo?
Yeah, it's a big portfolio. Maybe everything we have to do with oceans and climate. So 40% of the Commerce Department is related to the ocean and the atmosphere.
40%?
Yeah, it's big. It's a big piece of business, what we do here. And that's all, of course, related to climate. So I spend a fair bit of my time. I was the governor of the Ocean State in Rhode Island.
The Ocean State, that's right.
Ocean State. I love this. I really love it.
See it on the license plates?
You see, exactly. It's
Right.
the Ocean State. I grew up going to the beach. I grew up clamming. I feel we have to preserve the treasure of our coastal lands and our oceans. So in any event, I think people probably don't realize how much the Department of Commerce has to do with resiliency, climate, oceans, undersea efforts.
You talk about being governor of Rhode Island. How is this job different from that job?
Yeah, it's pretty different. You know, Rhode Island's a small place, and you can make things happen quickly when you're the governor. So this is obviously, you know, just the building where we're sitting is gigantic, and we have almost 60,000 employees just in the Commerce Department. So I'd say that is different. In many ways, though, leadership is leadership. You know, you set a vision, you manage your team, you drive to results. So those, in that way, it's very familiar. Working with the legislature is also very familiar for me.
Right.
I enjoy it. I like it. It's part of the job. I did that as governor. I'm doing that here.
Right. When you were governor of Rhode Island, you were out front back then saying that schools should stay open. I know you're not education secretary, but what is your thoughts on what's going on with our schools right now with the pandemic?
I still feel kids need to be in school. You know, these vaccines are safe. There has to be safety. Obviously, we have to keep our teachers safe and our kids safe. No doubt about it. That means good protocols, more testing. Everyone has to be vaccinated. But with those precautions, kids ought to be in school. I really believe 20, 30 years from now, when we look back, or maybe even 10 years from now, when we look back at COVID and we look at what are all the lasting negative impacts, the biggest one will be what happened to our kids. The mental health issues, how they have fallen behind in their education. And of course, this again will contribute to the lack of equity in America, because it'll be the children who didn't have broadband, whose parents couldn't stay home to teach them, who were already a little bit behind, who are just so much further behind. So I have religion on this topic. I also have 2 teenagers, and I see it. We got to get kids in school.
There's a recent article out there talking about your future and being a bright light in the Democratic Party. I wonder what your ambitions are, Secretary Raimondo.
To get through the week. I mean, like, I have a big job here. We just touched on it. So this is what I'm focused on.
All right, and finally, a sort of related question, but a little different, I hope, is what do you see as your legacy here and maybe personally?
Gosh. Wow. Here, I think the broadband that we talked about will be, if I do it right, my legacy. This is fundamental. You know, this done properly, it will be comparable to any of the biggest infrastructure implementations in our nation's history. And as I look towards like the economy and the digital divide and how that plays into the economic and opportunity divide, there's a huge sense of urgency around getting broadband to everyone. So I think in this job, that'll be a big portion of it.
Focus on that.
Yeah.
All right. U.S. Commerce Secretary Gina Raimondo, thank you so much for your time.
Thank you.
You've been watching Influencers. I'm Andy Serwer. We'll see you next time.
And last but not least, I'll toss this one in here. That is PayPal Chairman John Donahoe. He's the current CEO of Nike. Interesting, he was the CEO of eBay from 2008 to 2015. eBay was attacked by Elliott in 2019. So you have an Elliott team, of course, that is after John Donahoe left that job at eBay, but still Elliott, you would have to imagine, is very familiar with the work that John Donahoe did and perhaps didn't do at eBay. Now, Elliott ultimately got a successful spin-off of the StubHub business and the classified business for eBay and over in 2019. Overall, here's my take. I do think you'll probably see speculation start to increase about a deal between Pinterest and PayPal. It makes a lot of sense. Now, this is not going to come overnight. No. A deal of this size and logistical challenges would take a while, but still, you see Elliott, I think, positioning for trying to get something done here.
There's a lot of synergy that could take place here, I think, from end to end, and you laid it out extremely well. The only thing I'll add here is that for Pinterest and some of the ability for them not just to continue to see increased time spent on the platform, it's going out to advertisers in environment like this and getting them to spend more on the platform in this interim period of time while you're waiting for more of that monetizable active usership to really permeate throughout the experience within that platform of Pinterest that doesn't want to be called a social media company.
You have to make money. You can't just sit on Pinterest nowadays and look up recipes. They have to make money.
They got some good recipes, though.
They do.
Guys, coming up, we're going to discuss what's next for the CHIPS Act with Siemens USA CEO Barbara Humpton. That's up next.
Welcome back to Yahoo Finance Live. I'm Brian Sozzi alongside Brad Smith. Julie Hyman will be back tomorrow. We're only a few hours away from the Federal Reserve's decision on interest rates. The Fed is widely expected to raise rates by 75 basis points to get red-hot inflation under control. Right now, markets are taking all of this in stride. We're seeing the Dow, S&P 500, and Nasdaq in the green. Here's what else we're watching at this moment. Chips, please. The CHIPS Act has passed another key hurdle in Washington, D.C. We'll chat with Siemens U.S. CEO Barbara Humpton on why the bill is so critical to the country and the bottom lines of corporate America. And a state of financial stress. A new Yahoo Finance Morning Consult poll reveals how badly inflation is hurting American households. Yahoo Finance senior columnist Rick Newman will bring us exclusive analysis on the poll's findings. And the future of crypto. Tron founder Justin Sun stops by for a chat on crypto you will not want to miss. Now let's go over to Inez Ferre at the Wi-Fi Interactive. Inez.
Yeah, Brian, and taking a look at the markets, we are seeing the Nasdaq, which is outperforming out of the major averages. And we're looking at technology on our Wi-Fi Interactive board, communications services, consumer discretionary. Those are the ones that are seeing gains. Those are the sectors that yesterday were losing. Taking a look at the Dow, we're watching Microsoft, Salesforce, Boeing. Those are the leaders there. And over on the Nasdaq 100, the left-hand side of your screen, the mega caps, the tech names, those are the leaders. We're watching Microsoft up more than 4.5%. Alphabet up more than 5%. You've got Amazon, which yesterday was in the red, today up 3.5%. I do want to take a look at the home builders because we have some pending home sales data that just came out month over month. Pending home sales were down 8.6% in June. The expectation was a decline of 1%, so quite a bit more than expected. Year over year, pending home sales were down 19.8%. The expectation was for them to be down 12%. So definitely those soaring mortgage rates impacting pending home sales. Also, mortgage applications fell last week 1.8%. The prior week, it had fallen 6.3%. I just want to point out a trending ticker since we're talking about home sales, et cetera. Sherwin-Williams, this is a paint maker. Now, they service the professional industry, the do-it-yourself home industry as well for paint. A big miss for the quarter on the top and on the bottom line. The weak spots for them was Europe, Asia because of those China lockdowns, and also the do-it-yourself segment in North America, guys.
Wow. All right. We're going to continue to keep a close eye on shares of Sherwin-Williams, as we know you will as well, Inez. Thanks so much for breaking all that down for us here this morning. Yahoo Finance's own Inez Ferre. And on Tuesday, everyone, the Senate voted to advance the CHIPS Act, which aims to boost the U.S. semiconductor manufacturing industry. Democrats hope to pass the legislation before August recess. And with more on this, we've got Yahoo Finance contributor Kevin Cirilli. So, Kevin, where do things stand on this right now?
We're anticipating a vote in the Senate later today, and then it would head to the House. And candidly, I'm expecting that there will be a vote in the House of Representatives sometime next week. Now, President Biden, for his part, speaking yesterday with Commerce Secretary Gina Raimondo, saying that this is a national security imperative to advance this legislation, which would provide $52 billion worth of investment in the semiconductor chip manufacturing space, as well as additional financial investment across the country in various different tech, fab, center, foundry, manufacturing plants and hubs, creating hubs in the United States in order to do this. President Biden tweeting out, quote, "America invented the semiconductor. It's time to bring manufacturing and the jobs that come with it home." And Senate Majority Leader Chuck Schumer speaking yesterday on the Senate floor in support of the bill and saying that this would help to increase competition against the Chinese Communist Party. Take a listen.
As a percentage of GDP, we spend less than half as much as the Chinese Communist Party on basic research. Less than half, which is even more devastating given China has spent decades stealing America's intellectual property. With this bill, that's finally going to change.
And I pulled some research on Yahoo Plus, and the Congressional Research Service says that in 2019, nearly 4/5 of global fab capacity was in Asia, think about this, 28% coming from South Korea, Taiwan 22%, of course TSMC located there, Japan 16%, and China 12%. The remaining 22% has been elsewhere. Now, back in the 1960s, the United States produced about something like 40% of semiconductor chips in terms of global production. So a massive shift that has occurred over the last several decades, but no doubt there's optimism, bipartisan optimism, by the likes of Senator Todd Young, a Republican from Indiana, that this type of investment in critical high-tech manufacturing infrastructure would be able to provide a national security boost and also an economic one as well.
All right, really excellent breakdown of where this all stands and what's coming next on this. Kevin Cirilli, thanks so much. Let's continue this conversation now with Barbara Humpton, who is the president and CEO of Siemens USA. This obviously a massive effort in order to move forward the broader chips and semiconductor industry. What are your expectations in terms of not just what we'll see next, but what kind of capacity and production may be unlocked if this fully goes through?
Yeah, Brad, first of all, we're thrilled to see the CHIPS Act moving. This is something we've been supporting for quite some time now, with the recognition that this technology is key to America's future leadership in the world economy. You see, we're entering a new era for manufacturing, and it's taking shape right here in America, where manufacturing is more digital than ever, and where advanced manufacturing technology makes everything possible. We think about digital twins, automation, virtual reality, augmented reality. All of these technologies go into the electric vehicles, the smart buildings, and even, as we heard from Chipotle, the chip machines that we'll be using in our everyday life. So truly, global innovation is essential, but making things locally is now key to our overall security and our productivity. The disrupted supply chains we've seen really show the need to establish local production and be resilient against future disruptions. So the CHIPS Act, both in its the investment it will make in new manufacturing capacity, as well as the investment it will make in research and development, are both going to be essential to establishing America's leadership position for this next decade.
Barbara, fortunately, there has been no shortage in Chipotle salad bowls because I just want to be in a good mood. So I'm glad that has not happened. But look, over the past year, looking back on the chip shortage, how has that impacted your business and what has it prevented you from doing?
Well, I think all businesses have been really struggling with the semiconductor supply because, as we say, it's in everything. An EV uses some 2,000 chips. And in order to build an electric vehicle, manufacturers are looking to automation that Siemens provides. They're looking to the electric vehicle charging stations that Siemens provide, both of which use semiconductors. And so what we've done, our heroes in supply chain management here in the corporation have been using analytical tools, market tools to look out and use intelligence to understand where there may be pinch points in the supply chain. One of the key tools they've been using is transparency into our own operations, aggregating our need across businesses, making sure that when we communicate with semiconductor providers, they can trust us, that we have a real need and that we will be using all of the supplies they make available to us. What we're moving into now is the ability to actually use predictive tools to be able to look into the future. So with all that, I guess the underlying message, Brian, is the ability to use technology that is readily available to us today, get into that digital realm itself, and use that to help us manage the flow of product to where it can be best used.
What are you hearing from your customers in terms of how they're going to be navigating, even in the absence of a CHIPS Act in this interim period where it's looking to go through fully and where there is more capacity that's looking to come online? How are they navigating just this interim period and what are they asking more from Siemens?
Yeah, in this interim period, what we've known is that we need to be in very close contact with our customers, because what a lot of people don't understand is that we at Siemens are in all parts of the semiconductor supply chain. When Intel chooses to build a new location, then we could well be the providers of the electricity that will make their production possible. We provide automation that's used within the production factory itself. We also provide the design tools, the software that helps their engineers envision and then ultimately design and ready for production the semiconductors themselves. And as I say, ultimately, we are end users of the product. So the most important thing for all of us in this moment of disruption is clear communication. And as you know, this has been a very competitive field where people have been reluctant to share too much about what their requirements are and what their plans are for the future. The disruption, and particularly with the leadership of the Department of Commerce, we've seen unprecedented communication about where the needs are and how we drive through the bottlenecks today.
Barbara, a lot of manufacturing executives have told us recently they have dusted off their recession playbook. Do you have one of those, and how are you preparing for the slowdown?
Yeah, I think we're all recognizing that, what we're entering right now is a very difficult period, especially with the disruption due to war in Europe, the effects that's having on global energy supply. People are characterizing what we're entering as a global energy crisis. I will tell you that here in the US, my perspective is that we have relative energy security, we have relative health. While many parts of the world are still dealing with pandemic shutdowns, et cetera. So we actually have an obligation to outperform. I was just on a call this morning with Siemens global leaders, regions from around the world gathered, and this message of let's overdrive right now in order to be sure we'll be well prepared for this coming winter. And then one piece of good news is that backlogs are strong at Siemens. And so the number one thing we have to be focused on is relieving those delivery cycle times so that other customers of ours who are going to be critical throughout a long, tough winter are going to be able to perform well.
Some good news. We'll take it. Barbara Humpton, President and CEO of Siemens USA. Always good to see you. We'll talk to you soon. Okay, before we head to break, let's check back with General Motors. After a mixed quarter on Tuesday, today's Citi analyst Itay McCally is out saying General Motors remains his top pick. His price target of $87 assumes 160% of upside to GM stock price. That's not a typo. That's what he wrote in his note. It says McCally, quote, the second quarter was a bit noisier than expected, but delivered a number of reassuring updates, such as good results in key segments, a reasonably confident guidance confirmation, indications of easing commodity pressures into 2023, and a reassuring update on Cruise. Big call by the Citi team on GM. Coming up, Credit Suisse has ousted its CEO and replaced him with someone that may be slashing expenses at all costs. Brad is back with more on that shakeup and a look at other top headlines next.
Opioid maker Teva reached a settlement agreement with the U.S. government for $4.25 billion. The deal came after multiple trials and lawsuits taking aim at the drug maker's role in the ongoing opioid epidemic. Under the deal, Teva will make payments over 13 years to state, local, and tribal programs to help ease the crisis. The Israeli-based company's opioid production dwarfed that of Johnson & Johnson, we should note, and Purdue Pharma at the height of the opioid crisis as well. Taking a look at Teva shares, they are higher on the day by about 23%. We'll keep a close eye on that. As well here, Credit Suisse is making changes in the C-suite, naming Ulrich Körner as its new CEO. The latest effort by the embattled lender to repair its reputation after a series of scandals and financial troubles. Credit Suisse also announced that it was launching a strategic review to reassess spending and cut costs. Deutsche Bank also out with earnings today. The bank beat profit expectations for the second quarter, but warned of souring economic conditions for the second half of the year. In response, the German bank also cut its cost target for the full year and struck a cautious tone when it came to full year profit. And Twitter announced that it is holding a shareholder meeting in September to vote on the $44 billion Elon Musk merger. That will take place September 18th. Now, the company's board has urged shareholders to approve the deal. This is ahead of Musk and Twitter's trial in October over the billionaire's attempt to pull out of the deal. Well, switching gears here and checking in on the world of crypto. As more and more firms file for bankruptcy, our next guest says he's ready to help those financially distressed crypto companies get back into the fray. And joining us now, we've got Justin Sun, Tron founder and ambassador of Granada to the World Trade Organization, as well as Yahoo Finance's David Hollerith joining in on the chat. Justin, thanks so much for taking the time here with us today. First and foremost, when we think about helping out and what that looks like for some of the other distressed crypto platforms and operations, what does that look like from your perspective?
First of all, I think recent crypto downturn really destroy lots of the balance sheet of crypto enterprise. I think one of the biggest reason is because all the platform use a very big leverage in their daily operation. So that's why when Bitcoin, Ethereum goes down, for example, 30%, for those companies has used a very large leverage, it probably means even 50, even 70% down. So lots of the assets got liquidated. That's why we have seen even like big companies with $10 billion in their balance sheet even get liquidated in a very short period of time. Probably like around 2 to 3 weeks, just like what happened in the financial crisis.
Justin, I want to go back to May when Tron issued its algorithmic stablecoin USDD. Yes. Now, this is around the same time that Terra's algorithmic stablecoin famously collapsed, and this is one of the major events that sort of sparked the downtrend and the deleveraging we've seen across the crypto market. So I was curious, could you sort of explain what's going on with USD? It has about a $700 million market cap at this point, and it looks like it had depegged and has got back to that crucial $1 mark as of now. But what's sort of going to define whether the value arc of this stablecoin is going to be any different than Terra?
Yes, sure. USDD use different mode compared to USD and Luna. I will see USDD is a hybrid mode. So first of all, we have over-collateralized stablecoin reserve. So basically, right now, the reserve ratio is more than 300%. I will say even more than 110% will be quite safe for USDD holders. In the reserve, currently we have TRX, BTC, USDT, USDC. So basically it's hybrid Bitcoin, other cryptocurrency like TRX, and also USDC and USDT as a stable coin. So Tron reserve will gradually change those collateral ratio, depend on the market situation. Of course, I think back in May, the market seems to be super panicked. So that's why even for USDD, we see it's over collateralized. That's why we also have, I think, maximum has around 5 to 7% dip in the market crisis. But in a very short period of time, the peg go back, I think, because of the market back to normal. I think that's the first thing. And the second thing, USDD has a very active custodian Dow reserve, which we use different monetary policies to maintain the USDD peg. So basically, when market is in the downturn, we will buy USDD and buy crypto from the markets. And when market back to normal, we will issue more USDD and also sell some of the crypto reserve in our Dow reserve to fiat to prepare for any market volatility. And also, I think the most important thing for Dow reserve is guaranteed the decentralization of USDD. One of the most important difference between USDD to USDC, USDT, all the regulatory stablecoin is USDD don't rely on any banking rail. So basically, we don't collect any users' information. So you get maximum user privacy. At the same time, you can enjoy a decentralized blockchain infrastructure. That's why we have a completely decentralized, but also safe mechanism to guarantee the stable of the stablecoin itself. Different from Luna. Luna only have one mechanism to basically protect the stable of UST. Basically is Luna as a token itself, but it's very easy to fall into death spiral if the market feel super panic in May. Of course, I think the Luna and the UST price going down the same time. So we will see UST will never go back to $1. At the same time, it's minting a limited amount of the Luna token, which crushed the Luna to zero, as we see what happened in the market. But USDD is very strong because we back by all the different collateral, including all different kind of the stable coin in the Dow reserve, and we grow in a very...
To Yahoo Finance Live this Wednesday, July 27th. I'm Shauna Smith along with Dave Briggs and Rochelle Akufo. Well, we've got a jam-packed couple of hours for you. We are moments away from the Fed's decision on interest rates. Now, Wall Street is widely expecting a 75 basis point hike and also big earnings results on deck. Meta, Qualcomm, Ford, all set to report after the bell. Let's take a look at where things stand ahead of these results. We have the Dow up just around 0.3%, S&P up just over 1%, getting closer to that 4,000 mark. Nasdaq is the outperformer this afternoon, up just around 2.5%. Digging inside the Nasdaq, a big reason why we're seeing leadership here is because of the results that we got from Microsoft and Alphabet after the bell yesterday. You see Google up just over 6%, Microsoft up about 5%. The results were at least enough for the street. Real quick, I also want to bring up some of the semiconductors. The Senate passing a bill that includes funding for chip makers. We're seeing the reaction across the board today. It's a sea of green for a lot of these semiconductor stocks. Rochelle?
And Shauna, I'm going to be taking a look at treasuries, obviously something that's usually closely watched as people try and assess what the Fed is doing, as well as what we might see in the economy later down the road. So let's get you those boards up right now for the treasury yields. We'll start with the 10-year, as we can see some movement there. We can see some movement there to the downside for all three, the 5, the 10, and the 30-year yield, all relatively flat, but in negative territory, especially if you look at the 10-year that people obviously look at, especially when they're thinking what's going to happen with mortgage rates. So we'll see what happens after that Fed decision next. Dave?
Yeah, very quick look at commodities. And of course, inflation has been largely a commodity story. Almost half attributed to energy. And you see WTI crude a pop today of more than 2.5%. Gold, you've seen really plummet in this tightening cycle and will continue to as we continue to raise rates. By the way, a strange pullback in natural gas, down more than 4% on the day, though it's been through the roof. Brian Chung is outside the Fed awaiting the decision from Jerome Powell, which we expect, Brian, a 75-point hike.
Yes, Dave. Well, the Federal Reserve just making that announcement. The Federal Reserve has officially raised interest rates by 0.75%. That was largely as expected. Again, markets pricing in a chance of about 75% chance of that happening. Now, when it comes to changes to the statement itself, really not much change when you talk about recent indicators of spending and production have softened. That's the only new sentence in the statement. Again, I'll read that one more time. Recent indicators of spending and production have softened. That might be the closest that we'll get to the Federal Reserve acknowledging that perhaps there is a slowdown happening in the economy, not en masse, but interesting to note that language is in the statement. But beyond that, really nothing else in here. The Fed continuing to point to Russia's war against Ukraine as one element to upward price pressures. Of course, the Fed sees a demand side of that as also part of the picture, which is the reason why it feels it has to continue to raise interest rates. Keep in mind, the Fed is now targeting interest rates between 2.25% and 2.5%. And they say, quote, they anticipate that ongoing increases in the target range will be appropriate. Translation, bus doesn't stop here. That language was the same as we had seen from the Fed in June. But beyond that, the Fed continuing to acknowledge food and energy prices are high. Job gains do remain robust. So the Fed's balancing act as it tries to raise interest rates without triggering any sort of job losses does remain. But again, the big headline today, 0.75 percentage point increase from the Fed, second in a row. Decision was unanimous. Guys?
Brian, just talk to us about the unprecedented action here from the Fed. It's been quite some time since we've seen the Fed get so aggressive. And then, of course, just your perspective on what this means that we will likely see heading into the fall, because inflation is still at its highest level that we've seen in about 40 years.
Yeah, well, when we talk about just the inflationary reaction, we have to remember that the Federal Reserve has been pretty insistent that it can't just simply stop raising interest rates here. For what it's worth, where we're at right now at about 2.25 to 2.5% is roughly the estimate of where economists say is neutral, meaning that any further interest rate hikes past this point could have more bite into inflation, which is going to be very important when you consider that the last read we got on inflation on CPI was 9.1% on a year-over-year basis. That hasn't shown signs of letting up quite yet. However, what we don't know is what is the Federal Reserve going to do next? There's nothing in this statement that says, well, in the next meeting, which, by the way, is going to happen at the end of September, is it going to be 50 or 75 or 1 percentage point? We don't know. And that's why all eyes are going to be on the Fed chairman's press conference at 2:30. What will Jay Powell tell us? Will he give us guidance on what happens next? That's going to be very important to see how he can shape inflation expectations with these recessionary worries out there.
And we know that before, when we got that CPI data that came out, people were wondering, look, could it be 100 basis points? But obviously closer to this decision, we did see that 10%. But it's interesting to see that this was a unanimous decision. Was that surprising to you?
Well, it was surprising when you consider that you actually had one member dissenting from the last decision. So in June, when the Fed made the abrupt change last minute to go from 50 basis points to 75 basis points, you actually saw Esther George, the president of the Federal Reserve Bank of Kansas City, dissent against that. She wanted a smaller rate hike of the half a percentage point that markets were expecting prior to that meeting, which, by the way, was a bit of a surprise because those Fed watchers have noted for some time that she has tended to favor larger interest rate increases as opposed to smaller ones. But in this decision, which, by the way, she's still a voter, she did go along with what the Federal Reserve ultimately went with, which was that 0.75 percentage point increase. So again, everyone's on board. Keep in mind, we also have a few new members of the Federal Reserve Board, Michael S. Barr, and then also Susan Collins from the Boston Fed joining the committee between June and July. So they were also in line when it comes to that. Of course, we'll have to hear all the Fed commentary after this meeting to see if the other non-voting members of the committee also supported this decision.
Yeah, really surprising given the amount, Brian, of business leaders and analysts who wanted a 100-point hike. So I expect the name Janet Yellen to pop up in this press conference, in particular when defining a recession. How do you expect the Fed chair to tap dance around the actual definition of a recession given the GDP number coming tomorrow?
Well, Dave, we'll have to see in about, 12 27 minutes or so. When we talk about Jay Powell's approach to all of this, though, you would probably expect him to say what he's already been saying, which is the Fed is going to do its part to try to land this plane without any issues. Of course, that seems to be a picture that's getting a little bit gloomier and shows that the job of actually a smooth landing is going to be a lot harder than the Fed had projected perhaps earlier in the year. Now, of course, the Fed is going to say, at least for right now, it is going to continue to raise interest rates. But again, who knows how long and persistent the war in Ukraine is going to be on energy prices? Who knows what the inflation expectations are going to look like as Americans continue to talk about the R word? How does that shape in any sort of behavior when it comes to consumption or businesses when it comes to investment? So I think the Fed chairman in a few minutes is probably going to say something to the effect of, look, as far as their knitting, they stick to interest rate increases. And we know that up until today, monetary policy was still very, very largely accommodated because it was below that 2.4% that people estimate as still stimulative to the economy. After today, that might now start to be restrictive. So that's probably going to be a talking point. And again, we'll have to listen in about 25 minutes or so.
Yeah, and Brian, it's also a tough balancing act here with the Fed because the other question out there is how much hiking can the economy absorb at this point? Because the Fed still very aggressive as we see very high inflation, but the economy is slowing down a little bit. So it'll be interesting, I guess, to see how Jay Powell is able to walk that line as well, because he doesn't want to get too aggressive in the fact that then that could potentially spook the markets.
And that is exactly the reason why the Fed didn't just instantly raise interest rates to say 3.5% or 4% already, because the markets are not quite ready for that. And in fact, one big difference between this meeting and the last meeting is that for the first time, you're starting to see the 10-year yield price in the chance of a Fed cut at some point. Now, some of this may have been natural because, the Fed couldn't raise interest rates forever. But as of the last meeting, you still saw the continued rip up in the 10-year. And essentially, over the last 6 weeks, you have seen the 10-year fall down by about 75 basis points. I'd be interested to see, I don't have a computer right in front of me, of what the 10-year is doing right now. But of course, with that action over the last 6 weeks, that is bond market traders pricing in a high likelihood that at some point the Fed's going to have to do a U-turn on all of this. How abrupt is that going to be? I think that turn is going to depend on how hard we go into a recession if that does end up happening. You have a lot on Wall Street saying, well, maybe in the second half of next year is when that U-turn happens. But look, I'm starting to see some reports and some analysts that are saying, hey, it's possible that they're going to start to pull that call up to maybe the first half of next year.
You're seeing a bit of a reaction here in the 10-year as we pull that up. It's still not a heck of a lot of movement, at least just yet. I don't think you can save off just about 2.7%. All right, Brian Chung, thanks so much. We're going to check back in with you in just a little bit after the press conference. But for more on this, let's bring in the Fed's decision. We want to bring in Federated Hermes Senior Portfolio Manager RJ Gallo and Principal Global Investors Chief Global Strategist Seema Shah. It's great to have you both. Seema, first to you. Let's start with the equity reaction that we're seeing. Yes, adding to some of the earlier gains. Dow now up nearly 100 points, I believe, if we can pull that up right now. You can see the Dow up 71 points. S&P up just about 1.2%. The Nasdaq giving up actually some of its earlier gains. What's your reaction to what we heard from the Fed, the 75 basis point hike?
Well, look, I think the 75 basis point was fully expected by the market, although there had been, of course, that speculation after the CPI number of a slightly bigger 100 basis point hike. They have become very, very clear in what to expect for this month. Now, of course, for the press conference, it's all going to be about how is the Federal Reserve thinking about the slight slowdown in growth coming, and how quickly do they think they're going to get to the kind of the next restrictive territory. I expect there will be questions about recession and potential rate cuts, but I don't think it would be in Powell's interest to almost give a full answer to those questions.
And RJ, your reaction to it being a 75 basis point hike and what you're hoping to hear in the press conference from Jay Powell.
75 was fully anticipated. The brief flirting with 100 basis points, was very brief. So I don't think there's anything surprising at all in the 75. I would echo the sentiment that Chairman Powell faces an interesting task. The bond market is pricing in easing basically by summer of next year. It's pretty unusual in the history of Fed hiking cycles for the market to price in and ease so quickly after the expected peak in the Fed funds rate from the tightening cycle, which should be like in January or February of next year. The market has gotten very convinced that a Fed that was slow to fight inflation is now fighting it with all of its talons out, and the inflation will come down. Market might be a little too optimistic on that front in pricing in and ease that quickly, and it'll be interesting to see how Powell answers those questions. I bet he'll talk about data dependency and that inflation is still much too high. sort of subtly pushing back against the argument that an ease is coming by next summer.
Seema, of course, prior to last month, the last 75-point hike was 1994. We forget the context on just how much Fed tightening is doing, and you have some numbers on that, just how much they're doing in such a short period of time, historically speaking.
Yeah, it's very interesting. In the space of 4 months, so since they started hiking back in March, in the space of 4 months, they have hiked just as much as they did through the entire 3-year period of 2015 to 2018. So this is turning out to be one of the steepest hiking cycles that we have seen in recent Fed history. And I think it goes very far to show the kind of fight that they are on. They have to, as was just heard, they have to put everything they have into bringing down this inflation rate. And I agree. I think this is going to be very painful. It's going to be extremely slow. And the market might be a little bit too optimistic if they're expecting rate cuts as soon as next summer.
Well, Seema, exactly how painful do you see it potentially getting?
So we are expecting a recession to hit the US economy in the first half of next year, probably the first quarter of next year. We are actually expecting the Federal Reserve to continue hiking in the beginning of 2023. So we're expecting a peak rate of 4.25%. That is above market expectations. And unfortunately, with that kind of tightening on the way, it's going to be very difficult for the US economy to avoid recession.
And so, RJ, in terms of the factors that are outside of the Fed's control, what are you watching most closely?
Well, the supply shock that is apparent in many sectors of the economy, the supply chain problems, whether it be offloading at ports, whether it be the fossil fuel complex, which was certainly aggravated by the terrible events that are going on in Ukraine. The Fed can't control those things. They can't unkink the supply chain. They can't suddenly come up with more natural gas to flow to Europe. Or more oil on world markets. But I think what's important to realize is the Fed knows it can't affect those things. They're watching them too. What they can affect with interest rate policy, with monetary policy, is the level of aggregate demand and where that aggregate demand meets that attenuated supply. So I think they're acting in the correct manner. The policy error that was transitory is in the past. And the Fed is now focused very much to prevent the inflation problem, which is acute, highest inflation in over 40 years, working to prevent that from becoming endemic in the economy where inflation expectations become much too high and the Fed has to absolutely tank the economy to address them. We do think a recession is a real risk. It's not quite our base case. We think we might skirt by the recession. It's an extraordinary time. The unemployment rate is also at about the lowest in 50 years. So we have a lot of economic strength coming into this that can suggest that the economy could decelerate just enough to allow this inflation. I still think no ease is coming by June of next year, but I don't know that our base case is a recession either.
Seema, we eagerly await the words from Jay Powell, and certainly he'll be asked about the coming GDP number, which many expect to be negative, therefore the technical definition of a recession. How do you expect him to walk that tightrope of whether we in or whether we're not in a recession?
I mean, I think he will just point to the labor market. We know that it's an extremely strong labor market. And when you're seeing payrolls averaging at about 375,000 per quarter, that is not the official definition of recession. You need to see weakness on consumer spending, retail sales, and certainly the labor market as well. And we're not quite reaching that. So although this would be, as you said, two quarters of negative growth, to them, that won't quite qualify as a recession.
Seema Shah, RJ Gallo, great to have you both on this all-important Fed day. Thank you both. All right, let's take a look now at how markets are reacting to the news of a 75-point hike. Yahoo Finance's Jared Blickry here with the numbers behind that.
I got to tell you guys, not a whole lot of movement yet, but that's what we expect. What's unusual about today is how much we drifted up. In fact, we shot up ahead of this announcement, I think a tribute to the volatility. But this is it. That's all we have so far. Of course, the real fireworks, they start at 2:30, and we're going to be covering that as well. Want to check in on the sector action for the day, and we are seeing in the lead now, it's still the mega cap sectors. We got communication services, that's XLC, that's up 3%, XLK, XLY, that's tech and consumer discretionary. Each of those up more than 2%. But I want to take a look at the bond market. This is a 10-year T-note yield, really not doing much, down about 3 basis points. But let's check out that red line statement. This is the latest announcements compared to the June announcement, and we see recent indicators of spending and production have softened nonetheless. And so they are downgrading their growth expectations. Neil Dutta over at Renaissance Capital, he was writing about this. We didn't really learn much, but we have that pressure. So 75 and 75 plus lowering their growth expectations. I did get some movement in some other sectors here. Want to check out the euro. That is still roughly at parity with the dollars. Check out a chart here. Not a lot of whole lot of movement. Also taking a look at some of the commodities, which don't always track the Fed decision, but WTI has been on the move, and you can see just a little bit of movement here. It did shoot up earlier today on an inventories report. And here's the most hilarious part of the day for me, Bitcoin. Bitcoin is a big leader in all of this. Shot up on the statement. Why? Why not?
I was going to say, it's hard to make sense of anything that happens in the crypto market. Jay, real quick before you go, the spread between the 2 and the 10-year, we know that was in focus with these results. We haven't seen a heck of a lot of reaction in the bond markets. Is that similar to because of what we're seeing play out in equities is largely priced in? It's
priced in, but what's not priced in is what Powell is going to say. I think he's going to try to toe the line. He's done this before many times. Early on in his career as Fed chair, he kind of fumbled a little bit, and he's learned from that. So I think he's going to stay the course. But the real reaction in the bond market, Shauna, that is definitely going to happen in the presser. If there is any, who knows?
We'll have to see. As you mentioned there, why not? All right, well, let's check in with the Conference Board Chief Economist, Dana Peterson, to break down some of this action that we're seeing today. And Dana, in your notes, you were also expecting this 75 basis point hike. But what does this mean for people and their mortgages? What should they be taking from all of this?
Well, I think it means that mortgage rates are going to continue to rise and that we're going to see some pullback in the housing market. We're already seeing starts and permits come off and sales, and that's a function of, yes, very elevated prices, that's affecting affordability, but also rising interest rates. And we think that's going to definitely show through in the GDP data that's coming up. And also when we look at our own confidence measures, people are saying that they're pulling back on their expectations for home buying.
And some more data on home sales today. Pending home sales plummeting 20% year over year as mortgage rates continue to climb, to your point. Is this cooling of the housing sector saying that the Fed's job is working a bit?
I think so. This is what the Fed wants to see, a calming in domestic demand, and certainly housing is a big part of that. Housing activity spiked during the pandemic as interest rates fell to historical lows. Also, many people were looking to upgrade in terms of their space and moving out of big cities and into suburbs and smaller cities to get more room. And then you also have millennials. They're all turning 40 and they have families and they're looking for that next upgrade in housing. And so all those things are demand that the Fed wants to tamp down on.
Dana, the second 75 basis point hike that we just got this afternoon, is it enough to help or to get inflation to begin to moderate?
It's probably not enough. We expect the Fed will continue to raise interest rates. Whether they go 50 or 75 basis points in September doesn't really matter. The point is that the Fed is going to be raising interest rates into what we think will be restrictive territory, anything above 3%. And they'll probably get close to 4%, maybe a little bit over that by early next year. And we think that that action, that very aggressive stance against inflation, will actually induce a recession, probably starting an actual recession that the NBER would agree that it is one, probably starting in the fourth quarter of this year.
And so how key is it going to be when we do get that GDP data, given the other strengths that we see in the economy with employment, how should we be viewing this? What lens should we be viewing this recession through?
Sure. I think, just thinking about tomorrow when we get second quarter GDP, it could be slightly positive, it could be slightly negative. But again, domestic demand is probably going to be strong. That's consumer spending and business investment and even still housing. And then we look at the labor market, that's still quite powerful. We have 11.3 million job vacancies. The unemployment rate's at near historic lows. So I think moving forward, we're really going to have to look at not just GDP prints, but what's happening with respect to domestic demand, with respect to income, whether incomes start to come off, and certainly if the labor market worsens with higher jobless claims and fewer payrolls and an uptick in the unemployment rate. We have to look at all the indicators in order to determine whether or not the U.S. is actually in recession.
Interesting, Dana. This was a unanimous decision from the Fed. What do you make of the Elizabeth Warren argument just the other day in the Wall Street Journal that more aggressive interest rate hikes, this whole plan the Fed is following, will cost millions of jobs and won't actually address the cause of high prices?
Well, there are a couple of things in there. I think that, yes, there will be some job losses. Will it be millions? Probably not. Again, as I mentioned, there are 11.3 million job vacancies. So the first thing businesses are going to do is pull back on hiring intentions. And so you have to get through all of that. And then we're still going to have a labor shortage, right? And so many businesses are probably going to be reluctant to get rid of the workers that they've just bid up and paid higher benefits and wages to keep them. And some businesses will continue to need to attract workers. So we don't think there necessarily will be millions and millions of job losses. There may be some uptick in the unemployment rate, but we're coming in from a position of strength here. And I think that's very important.
Dana, I want to point out what we got in that FOMC statement. They acknowledged, quote, spending and production have softened, yet at the same time they affirmed the fact that, quote, job gains have been robust in recent months. Do you think we'll start to see the jobs picture, the employment picture pull back a bit?
Well, we were expecting this even before the Fed was going to hike interest rates, and that's basically because we're at full employment. We reached full employment probably late last year, early this year. And so if you think of employment, labor market as a giant bathtub, you have some water going down the drain, but you also have water pouring in. So if you're at the top of the bathtub, you don't need as much to pour in. So we were expecting that payroll gains are going to be slimmer. They're still pretty robust, but we could start seeing very thin payroll gains and some negative prints here. But again, we're coming from a position of strength in the labor market.
Excellent analogy. Dana Peterson, thanks so much. Appreciate that. All right, let's bring in Yahoo Finance's Nyse Ferre. Nyse, how are stocks reacting to the decision and the words from the Fed?
Well, Dave, holding on to earlier gains, we had seen after that decision came out, we saw stocks move even higher a bit. So we just take a look right now at our Wi-Fi interactive board. You can see the movement after that decision. Keep in mind, these are just initial movements. We really tend to see more movements during the presser. Looking at the Nasdaq composite we're watching right now, the Nasdaq up 2.6%, the S&P 500 up 1.44%. Again, a little bit higher even than where we started right after that decision came out. Taking a look at the bond yield market, we are seeing that bonds have remained pretty steady. We're looking at the 10-year Treasury note down 2 basis points at 2.77, the same level that it was at before that decision came out. That spread between the 2 and the 10-year still staying deeply negative at minus 30 basis points. Also looking at the U.S. dollar index, a tiny bit of movement that we saw here initially. And then looking at Bitcoin, we saw that Bitcoin is actually up about $300 above where we were at earlier. In fact, Bitcoin just surpassing the $22,000 level. This is the movement that we saw when that decision came out. Looking at equities, we are watching the sectors, communication services, technology, consumer discretionary. These have been the leaders throughout the day. And if we take a look at the Nasdaq 100, a lot of the movement that we've seen with the mega caps, these mega caps holding on to the gains from earlier today. Microsoft up more than 5%, Alphabet up more than 6% after they reported their quarterly results. But again, any fireworks that we may see could come during the presser, guys.
All right, Nyse, thanks so much. We want to bring in Dennis Lockhart, a former president of the Federal Reserve Bank of Atlanta, to get his take on what we're hearing from the Fed. 75 basis point hike here for the second month in a row. Dennis, what's your reaction to that? Is it aggressive enough from the Fed?
I think it's pretty aggressive. They've managed to front end the removal of accommodation that was needed to try to bring inflation under control. They're now in the zone of what they consider to be neutral, the estimates of neutral. And in all likelihood, we'll see more rate hikes in the fall. So I think this is quite aggressive, actually, and 75 basis points was widely expected. As your reporters have pointed out, the market reaction so far, at least, is not severe.
Widely expected and unanimous. What do you want to hear from Jerome Powell, Dennis?
Well, let me tell you what I expect to hear from Jay Powell. I expect him to emphasize the resolve of the committee to bring inflation under control and move it toward target. I think he'll also mention, as he always does, the uncertainty environment in which they're operating. There are some questions out there about the potency of the Fed's tools, given some of the causes of inflation. I think he's going to be optimistic about that. He's going to say something to the effect that the tools are designed to bring down aggregate demand, and they can do that with rising supply and bring supply and demand into greater balance.
And obviously, this is coming on the heels of a lot of mixed data that we're seeing. They mentioned in that statement some softening of production, also on the consumer, but consumer spending still going strong when it comes to employment as well. How should the Fed really digest all of this when they're trying to plot their next move?
Well, you're absolutely right. It's a hard synthesis at the moment because you have some mixed signals, it seems to me, that are being thrown off by the economy, and putting the total picture together isn't so easy. I took a look at the statement that came out at 2 p.m. It's sort of a minimalist statement in the first paragraph, where they typically characterize their view of the economy. And that may be the best posture to take at the moment, because it's hard to add all of this up. I think in the press conference, Powell he'll get some distance from the view that we are in a recession now. I don't think he's going to support that point of view. But at the same time, he's going to say this is an economy that has both positives and negatives at work. And for my part, it's hard to add it all up.
Dennis, how much hiking can the economy absorb at this point?
Well, given the employment market situation, which is really very strong, one of your earlier guests commented on that, I think the economy can absorb higher interest rates. And this is me speaking, you'll never hear this from a Fed official, can absorb a modest recession in order to get inflation under control. A lot will depend upon how the employment picture evolves. But right now, the Fed has got a lot of air cover from a very strong employment picture.
Yeah, a position of strength, as we discussed earlier. Look at that unemployment rate, historically low, 3.6%. So with the exception of the housing market, which is certainly begin to showing some signs of cooling, are you seeing any signs that the Fed is actually winning, that they are bringing down inflation? And when will we see that number start to go down?
Well, so far the data, which of course you're looking at with a lag,
sure,
don't show much that's very encouraging. The headline number last month for the CPI, or a few days ago for the CPI, was pretty awful. And the core numbers were sort of flat for the last 3 months. I do think that the next cycle of inflation numbers will show a decline in at least the headline because of the gasoline prices and energy prices coming down. They'll take some encouragement from that, not too much because it's a volatile element, but I think there are signs that maybe at least in the near term we'll see somewhat better numbers that will help the psychology around inflation. But so far, not a lot of indications of prices declining or the rate of inflation declining.
And Dennis, obviously, rate hikes, one part of the picture, but also the Fed tightening its balance sheet. Do we expect to hear anything about that, or what are your expectations in that regard?
Well, I think this question will come up in the press conference. At this stage, it's still very early. It's only been, 7 weeks of the quantitative tightening policy being in force. So I don't think the committee has any desire to change the policy in the near term. And they've said several times over the past few months that they really want to put this in the background, that the primary tool is the federal funds rate. I don't think they're going to come off of that in the near term. Maybe at an upcoming meeting, they'll sort of review how the program has worked so far and make some adjustments later, conceivably later in the year. But for now, it's on autopilot.
Dennis, real quick, we only have about 30 seconds here until Fed Chair Jay Powell's press conference gets underway. But when do you expect to see inflation moderate a bit?
Well, as I said, you'll get a little better number, I think, in the headline number in the next cycle, whether that's this Friday or a month later or in the middle of August with the CPI. I think you'll probably see a better headline number. That's not something I think the Fed can take to the bank because it's just a volatile element, and there are a lot of geopolitical risks that could create another energy spike in the coming weeks or in coming months. I think it's going to take a while. I am concerned that the longer and more persistent.
Dennis, apologies for
inflation
jumping in here, but we have Fed Chair Jay Powell taking the stand. Let's listen in.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down to our 2% goal if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight, and inflation is much too high. Against this backdrop, today the FOMC raised its policy interest rate by 0.75 percentage point and anticipates that ongoing increases in the target range for the federal funds rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet. And I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. Recent indicators of spending and production have softened. Growth in consumer spending has slowed significantly, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened, in part reflecting higher mortgage rates. And after a strong increase in the first quarter, business fixed investment also looks to have declined in the second quarter. Despite these developments, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 375,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. Overall, the continued strength of the labor market suggests that underlying aggregate demand remains solid. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in May, total PCE prices rose 6.3%, excluding the volatile food and energy categories. Core PCE prices rose 4.7%. In June, the 12-month change in the Consumer Price Index came in above expectations at 9.1%, and the change in the core CPI was 5.9%. Notwithstanding the recent slowdown in overall economic activity, aggregate demand appears to remain strong. Supply constraints have been larger and longer lasting than anticipated, and price pressures are evident across a broad range of goods and services. Although prices for some commodities have turned down recently, the earlier surge in prices of crude oil and other commodities that resulted from Russia's war on Ukraine has boosted prices for gasoline and food, creating additional upward pressure on inflation. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, bringing the target range to 2.25% to 2.5%. And we're continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and evolving outlook for the economy. Today's increase in the target range is the second 75 basis point increase in as many meetings. While another unusually large increase could be appropriate at our next meeting, that is a decision that will depend on the data we get between now and then. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. As the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. Our overarching focus is using our tools to bring demand into better balance with supply in order to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty in what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined to take the measures necessary to return inflation to our 2% longer-run goal. This process is likely to involve a period of below-trend economic growth and some softening in labor market conditions. But such outcomes are likely necessary to restore price stability and to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Rachel. Hi, Chair Powell. Thanks for taking our questions. Rachel Siegel from The Washington Post. I'm wondering if you can walk us through your thinking around the decision not to go for a full percentage point increase. We saw a ramp up after the May CPI report came in hotter than usual, and then obviously the June figure did too. Was there any discussion of a stronger hike at this meeting? Thank you.
Sure. So we did judge that a 75 basis point increase was the right magnitude in light of the data and in the context of the ongoing increases in the policy rate that we've been making. I'd say that we wouldn't hesitate to make an even larger move than we did today if the committee were to conclude that were appropriate. That was not the case at this meeting. There was very broad support for the move that we made. You mentioned the June meeting. We had said many times that we were prepared to move more aggressively if inflation continued to disappoint. And that's why we did move to a more aggressive pace at the June meeting, as we said we would do. At this meeting, we continued at that more aggressive pace as inflation has continued to disappoint in the form of the June CPI reading.
Thank you so much for taking our questions. Colby Smith with the Financial Times. As the committee considers the policy path forward, how will it weigh the expected decline in headline inflation, which might come as a result of the drop in commodity prices, against the fact that we are likely to see some persistence in core readings in particular? And given that potential tension and signs of any kind of activity weakening here, how has the committee's thinking changed on how far into restrictive territory rates might need to go?
So I guess I'd start by saying we've been saying we would move expeditiously to get to the range of neutral, and I think we've done that now. We're at 225 to 2.5, and that's right in the range of what we think is neutral. So the question is, how are we thinking about the path forward? So one thing that hasn't changed is that it won't change is that our focus is going to continue to be on using our tools to bring demand back into better balance with supply in order to bring inflation back down. That'll continue to be our overarching focus. We also said that we expect ongoing rate hikes will be appropriate and that we'll make decisions meeting by meeting. So what are we going to be looking at? We'll be looking at the incoming data, as I mentioned, and that'll start with economic activity. Are we seeing the slowdown in economic activity that we think we need? And there's some evidence that we are at this time. Of course, we'll be looking at labor market conditions, and we'll be asking whether we see the alignment between supply and demand getting better, getting closer. Of course, we'll be looking closely at inflation. You mentioned headline and core. Our mandate is for headline. Of course, it's not for core, but we look at core because core is actually a better indicator of headline and of all inflation going forward. So we'll be looking at both, and we'll be looking at them at those both really for what they're saying about the outlook rather than just simply for what they say. But we'll be asking, do we see inflationary pressures declining? Do we see actual readings of inflation coming down? So in light of all that data, the question we'll be asking is whether the stance of policy we have is sufficiently restrictive to bring inflation back down to our 2% target. And it's also worth noting that these rate hikes have been large and they've come quickly, and it's likely that their full effect has not been felt by the economy. So there's probably some additional tightening, significant additional tightening in the pipeline. So where are we going with this? I think the committee broadly feels that we need to get policy to at least to a moderately restrictive level. And maybe the best data point for that would be what we wrote down in our SEP at the June meeting. So I think the median for the end of this year, the median would have been between 3.25 and 3.5. And then people wrote down 50 basis points higher than that for 2023. So that's, even though that's now 6 weeks old, I guess, that's the most recent reading. Of course, we'll update that reading at the September meeting in 8 weeks. So that's how we're thinking about it. As I mentioned, as it relates to September, I said that another unusually large increase could be appropriate, but that's not a decision we're making now. It's one that we'll make based on the data we see, and we're going to be making decisions meeting by meeting. We think it's time to just go to a meeting by meeting basis and not provide the kind of clear guidance that we had provided on the way to neutral.
Nick Timmerosa, The Wall Street Journal. Chair Powell, you've said that your policy works through influencing expectations and that policy needs to be at least moderately restrictive, which means you need financial conditions to stay tight. Futures market pricing currently implies you will raise rates this year along the lines of your June SEP, but then lower them a few months later next year. Are these expectations consistent with the need to keep financial conditions tight in order to moderate purchasing power and bring inflation back to 2%?
So I'm going to start by pointing out that it's very hard to say with any confidence in normal times what the economy is going to be doing in 6 or 12 months. And so to try to predict what the appropriate monetary policy response would be, I mean, of course, we do that in the SEP, but nonetheless, you've got to take any estimates of what rates will be next year with a grain of salt, because there's so much uncertainty. These are not normal times. There's significantly more uncertainty now about the path ahead than I think there ordinarily is, and ordinarily it's quite high. So again, the only data point I have for you really is the June SEP, which I think is just the most recent thing that the committee's done. Since then, inflation has come in higher, economic activity has come in weaker than expected. But at the same time, I would say that's probably the best estimate of where the committee's thinking is still, which is that we would get to a moderately restrictive level by the end of this year, by which I mean somewhere between 3 and 3.5%, and that the committee sees further rate increases in 2023. As I mentioned, we'll update that, of course, at the September meeting, but that's really the best I can do on that.
You said inflation had been a little bit hotter than anticipated. Has your view of the terminal rate changed since June?
So I wouldn't say it was. I think we didn't expect a good reading, but this one was even worse than expected, I would say. I don't talk about my own personal estimate of what the terminal rate would be. I will write down that it's going to evolve. It's obviously it has evolved over the course. I think for all participants, it has evolved over the course of the year as we learn how persistent inflation is going to be. And by the time of the September meeting, we will have seen 2 more CPI readings and 2 more labor market readings, and significant amount of readings about economic activity and perhaps geopolitical developments. Who knows? It'll be a lot. It's an 8-week intermeeting period, so I think we'll see quite a lot of data, and we'll make our decision at that meeting based on that data.
Gina. Hi, Jarrell. Thanks for taking our questions. Gina Smile with New York Times. You kind of alluded to this earlier, but I wonder, in the event that you see several months of very weak headline inflation numbers because oil prices are coming down so much, but core inflation continues to be strong or even picks up, I wonder how you would think about that.
So it's hard to deal with hypotheticals, but I just would say this: we would look at both. And we'd be asking ourselves, are we confident that inflation is on a path down to 2%? That's really the question. And we'll be making, our policy stance will be set at a level, ultimately, at which we are confident that inflation is going to be moving down to 2%. So it would depend on a lot of things. Of course, as I mentioned, core inflation is a better predictor of inflation going forward. Headline inflation tends to be volatile. So in ordinary times, you look through volatile moves in commodities. The problem with the current situation is that if you have a sustained period of supply shocks, those can actually start to undermine or to work on de-anchoring inflation expectations. The public doesn't distinguish between core and headline inflation in their thinking. So it's something we have to take into consideration in our policymaking, even though our tools don't really work on some aspects of this, which are the supply side issues.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. Earlier this week, the president said we are not going to be in a recession. So I have 2 questions off of that. Do you share the president's confidence in not being in a recession? And second, how would or would not a recession change policy? Is it a bright line, sir, where contraction of the economy would be a turning point in policy, or is there some amount of contraction of the economy the committee would be willing to abide in its effort to reduce inflation?
So as I mentioned, we think it's necessary to have growth slow down, and growth is going to be slowing down this year for a couple of reasons. One of which is that you're coming off of the very high growth of the reopening year of 2021. You're also seeing tighter monetary policy, and you should see some slowing. We actually think we need a period of growth below potential in order to create some slack so that the supply side can catch up. We also think that there will be, in all likelihood, some softening in labor market conditions. And those are things that we expect and we think that they're probably necessary if we were to have to get inflation, if we were to be able to get inflation back down on a path to 2% and ultimately get there.
The question was whether you see a recession coming and how that might or might not change policy. Thanks.
So we're going to be focused on getting inflation back down. And we, as I've said on other occasions, price stability is really the bedrock of the economy, and nothing works in the economy without price stability. We can't have a strong labor market without price stability for an extended period of time. We all want to get back to the kind of labor market we had before the pandemic, where differences between racial and gender differences and that kind of thing were at historic minimums, where participation was high, where inflation was low. We want to get back to that. But that's not happening. That's not going to happen without restoring price stability. So that's something we see as something that we simply must do. And we think that we don't see it as a trade-off with with the employment mandate, we see it as a way to facilitate the sustained achievement of the employment mandate in the longer term.
Howard Schneider with Reuters. Particularly in regard to expectations, it's been said the last few months that the risks of doing too little outweighed the risks of doing too much. Does that remain the bias?
So we're trying to do just the right amount, right? We're not trying to have a recession, and we don't think we have to. We think that there's a path for us to be able to bring inflation down while sustaining a strong labor market. As I mentioned, along with, in all likelihood, some softening in labor market conditions. So that's what we're trying to achieve, and we continue to think that there's a path to that. We know that the path has clearly narrowed, really based on events that are outside of our control, and it may narrow further. So, you know, I do think, as I said just now, that restoring price stability is just something that we have to do. There isn't an option to fail to do that, because that is the thing that enables you to have a strong labor market over time. Without restoring price stability, you won't be able to, over the medium and longer term, to actually have a sustained period of very strong labor market conditions. So, of course, we serve both sides of the dual mandate, but we actually see them as well aligned on this.
But as a follow-on to that, given the uncertainty and the sort of paradoxical flow of data you've been getting, if you're going to make a mistake, would you rather make the mistake on doing too much, raising too much, than raising too little?
Yeah, we're trying not to make a mistake. Let me put it this way. We do see that there are two-sided risks. There would be the risk of doing too much and imposing more of a downturn on the economy than was necessary. But the risk of doing too little and leaving the economy with this entrenched inflation, it only raises the cost. If you fail to deal with it in the near term, it only raises the cost of dealing with it later. To the extent people start to see it as just part of their economic lives, they start to factor high inflation into their decisions, when that, on a sustained basis, when that starts to really happen, and we don't think that's happened yet, but when that starts to happen, it just gets that much harder, and the pain will be that much greater. So I really do think that it's important that we address this now and get it done.
Thanks, Chair Powell. Neil Irwin from Axios. To build a little bit on what Steve was asking, do you believe the United States is currently in a recession? Will the GDP reading tomorrow affect that judgment one way or the other? And has your assessment of the risk of recession changed any in recent weeks?
So I do not think the U.S. is currently in a recession. And the reason is there are just too many areas of the economy that are performing too well. And of course, I would point to the labor market in particular. As I mentioned, it's true that growth is slowing, and for reasons that we understand. Really, the growth was extraordinarily high last year, 5.5%. We would have expected growth to slow. There's also more slowing going on now. But if you look at the labor market, you've got growth. I think payroll jobs averaging 450,000 per month. That's a remarkably strong level for this state of affairs. The unemployment rate at near a 50-year low at 3.6%. All of the wage measures that we track are running very strong. So this is a very strong labor market, and it's just not consistent with 2.7 million people hired in the first half of the year. It doesn't make sense that the economy would be in recession with this kind of thing happening. So I don't think the U.S. economy is in recession right now. Haven't seen it, and we'll just have to see what it says. I don't. I would say generally the GDP numbers do have a tendency to be revised pretty significantly. It's very hard to accumulate U.S. GDP. It's a large economy, and a lot of work and judgment goes into that. But you tend to take first GDP reports, I think, with a grain of salt. But of course, it's something we'll be looking at.
Hi, Chair Powell. Victoria Guida with Politico. I wanted to ask about the new conflict of interest rules that you all rolled out. Some senators have written asking for those rules to have more teeth and to have sort of more transparency about the Fed officials' financial activity. I was wondering if you could speak to that and whether you intend on toughening those rules in any way.
So those are the toughest rules in place, at any comparable institution that I'm aware of. we think, we thought about this carefully, and we put them in place, and we're building the infrastructure so that the enforcement will be tight, that actually you won't be able to make trades unless they're pre-cleared. And the amount of trades you make will be, they'll have to be 45 days or more before any FOMC meeting. It's just, I think we've really created a very strong and robust set of rules that will support public trust in the institution. And again, we're just now, the system is just now up and running, and I'm proud of what we did.
Hi, Katerina Saraiva, Bloomberg News. I wanted to ask a little bit more about the 75 basis points versus 50 versus 25. Can you talk a little bit about what kind of goes into your thinking for, making the decision on how much to raise rates, and, just talking about a very large amount that you alluded to, could that possibly be 100 basis points? And then kind of along those lines, is there any sort of weakness in the economy outside of inflation measures that would lead you to slow your hiking pace?
So I'm going to take that as a question about the next meeting and thereafter. So as I mentioned, we're going to be looking at all of those things: activity, labor market, inflation, and we're going to be thinking about our policy stance and where does it really need to be. And I also mentioned that as this process, now that we're at neutral, as the process goes on, at some point, it will be appropriate to slow down. And we haven't made a decision when that point is, but intuitively that makes sense, right? We've been front-end loading these very large rate increases, and now we're getting closer to where we need to be. So that's how we're thinking about it. And we're, in terms of September, we're going to watch the data and the evolving outlook very carefully, and factor in everything and make a decision in September about what to do. And I'm not really going to provide any specific guidance about what that might be. But I mentioned that we might do another unusually large rate increase, but that's not a decision that we've made at all. So we are, we're going to be guided by the data. And I think you can still think of the destination as broadly in line with the June SEP, because it's only 6 weeks old, and sometimes SEPs can get old really quick. I think in this one I would say is probably the best guide we have as to where the committee thinks it needs to get at the end of the year and then into next year. So I would point you to that.
Chris.
Hi, thank you. Chris Rugaber at Associated Press. I wanted to ask about, right now there is a sort of growing gap between the Fed's preferred measure of inflation, the PCE index, and the one that's followed by the public, the CPI, of course. How do you expect to handle this divergence if the PCE starts to come down enough for you to consider slowing rate hikes, even if the public is still seeing much higher CPI ratings? Thank you.
So it's an interesting situation. Of course, we've long used PCE because we think it's just better at capturing the inflation that people actually face in their lives. And I think that view is pretty widely understood. That said, the public really reads about CPI. And the difference really is because the CPI has higher weights on things like food, gasoline, motor vehicles, and housing than the PCE index does. And so that accounts for a lot of the difference. However, over time, they tend to come together. We were given the importance in the public eye of CPI. We are calling it out and noticing it and everything like that. But remember, we do target PCE. That is because we think it's a better measure. They will come together eventually. The typical gap was really about 25 basis points for a very long time. And if it got to 40 basis points, that would be very noticeable. Now it's much larger than that because of the things I mentioned. So we'll be watching both, but again, the one that we think is the best measure always has been PCE, at least since I think we, some 20 plus years ago, moved to PCE.
Michael McKee.
I'd like to weave a couple of things together, Mr. Chairman. Michael McKee from Bloomberg TV and Radio. You said that the destination pretty much remains the same in terms of your end of the year target, but where are you in the journey? We've now seen the federal stimulus programs end. You mentioned consumer spending, business investment have slowed. Are they moving at a pace you would expect, or is demand still greater than supply, too much greater than supply, that you need to do significantly more? And I ask because there are lags in the impact of monetary policy, as you mentioned, and a lot of this might hit in 2023. The strong dollar effect may hit in 2023 when the economy might be weak. How do you know where you are and where you think you need to get to?
Well, just talking about demand for a second, as I mentioned in my remarks, I think you pretty clearly do see a slowing now in demand in the second quarter. Consumer spending, business fixed investment, housing, places like that. I think, people widely looked at the first quarter numbers and thought they didn't make sense and might have been misleading in terms of the overall direction of the economy. Not true of the second quarter. But at the same time, you have this labor market. So there are plenty of experiences where GDP has been reported as weak and the labor market is strong and the economy has gone right through that and been fine. So that's happened many times. And it used to happen, if you remember, in the first quarter of every year for several years in a row, GDP was negative and the labor market was moving along just fine, and it turned out to just be measurement error. It was called residual seasonality. We don't know the situation. The truth is, though, we think that demand is moderating. We do. How much is it moderating? We're not sure. We're going to have to watch the data carefully. There is a great deal of money on people's balance sheets that they can spend. The unemployment rate is very low. The labor market's very hot. There are many, many job openings. Wages are high. So it's the kind of thing where you think that the economy should actually be doing pretty well in the second half of the year. But we'll have to see. We don't know that because you do see a marked slowing in the second quarter that is fairly broad. So we'll be watching that. We'll be watching that. Of course, as I mentioned, we do want to see demand running below potential for a sustained period to create slack and give inflation a chance to come down.
Nicole. Hi, thank you, Chairman. Nicole Goodkind, CNN Business. When does the committee expect to see a meaningful slowdown in the labor market, and how much weakness will it accept with regard to slower job growth and higher unemployment before it pauses or begins to think about cutting rates?
So I think you're already seeing, you've seen in the labor market, what you've seen is a decline from very high levels of job creation last year and earlier this year to modestly slower job creation. Still quite robust, as I mentioned. So you're seeing that. You're seeing some increase in initial claims for uninsurance, although that may actually have to do with seasonal adjustments. We're not sure that that's actually real. There's some evidence that wages, if you look at average hourly earnings, they appear to be moderating. Not so yet from the other wage measures, and we'll be getting the Employment Compensation Index measurement, I think, on Friday, I guess. And that's a very important one because it adjusts for composition. So I'd say you and also anecdotally, you hear much, the sort of level of concern on the part of businesses that they simply can't find workers is probably down a little bit from what it was, say, for example, late in the latter parts of last year. So there's a feeling that the labor market is moving back into balance. If you look at job openings or quits, you see them moving sideways or perhaps a little bit down. But it's only the beginning of an adjustment. But I think most also, if you look at, once you start citing these things, you can't stop. If you look at the household survey, you see much lower job creation, and the household survey can be quite volatile, but it has no jobs created in the last 3 months. So that might be a signal that job creation is actually a little bit slower than we're seeing in the establishment survey. So, executive summary, I would say there's some evidence that labor demand may be slowing a bit. Labor supply, not so much. We have been disappointed that labor force participation really hasn't moved up since January. That may be related to yet another big wave of COVID, and there's evidence that that's the case. But so we're not seeing much in the way of labor supply. Nonetheless, I would say some progress on demand and supply getting back in alignment.
How much weakness would you be willing to accept before you think about pausing rate cuts?
So I think we're going to be looking at inflation as well. We as I mentioned, we need to see inflation coming down. We need to be confident that inflation is going to get back down to mandate consistent levels. That's not something we can avoid doing. That really needs to happen. But we do think, though, that the labor market can adjust because of the huge overhang of job openings, of excess demand, really. There should be able to be an adjustment that would have perhaps lower than expected increases in unemployment, lower than would be expected in the ordinary course of events, because the ratio of vacancies to unemployed is just out of keeping with historical experience, and that suggests that this time could be different.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So you said the path may be narrowed to avoiding a recession. So how close are we to a recession? And then how do forecasts of possible recessions from banks and economists, how does that make a soft landing you've talked about more difficult?
So as I mentioned, it doesn't seem that the U.S. economy is in recession right now. And I think you do see weakening, some slowdown, let's put it that way, in growth, and you see it across some of the categories that I mentioned, but there's also just the very strong data coming out of the labor market still. So overall, you would say that in all probability, demand is still strong, and the economy is still on track to continue to grow this year. But the slowdown in the second quarter is notable, and we're going to be watching that carefully. Sorry, what was a lot?
Forecasts. How do bank forecasts of possible recessions, economists? Does that affect the soft landing?
Well, we've said since the beginning, I think, that having a soft landing is what we're aiming for. Of course, that has to be our goal. It is our goal, and we'll keep trying to achieve it. I do think events. At the beginning, we said it was not going to be easy. It was going to be quite challenging to do that. It's unusual. It's an unusual event. It's not a typical event, given where we are. If there is a path to it, and we think there is, it is the one I mentioned, that the labor market actually has such a large amount of surplus demand that you could see that demand coming down in a way that didn't translate into a big increase in unemployment, as you would expect in the ordinary course, because frankly the imbalance is so much greater. But we don't know that. I mean, this is a case of first impression. So anyone who is really sure that it's impossible or really sure that it will happen is probably underestimating the level of uncertainty. And so I would certainly say it's an uncertain thing. Nonetheless, it's our goal to achieve it, and we'll keep trying to do that.
Thank you, Mr. Chairman. Jean Young with Market News. I wanted to ask about the balance sheet reduction program. It's been working for a couple months now and in a different environment than the last time the Fed did it. What are you learning about how it's working and how markets are reacting? And is reaching the minimum level of reserves needed in the system still several years away at the current pace?
So we think it's working fine. As you know, we tapered up into it, and in September we'll go to a full strength, and the markets seem to have accepted it. By all assessments, the markets should be able to absorb this, and we expect that'll be the case. So I would say the plan is broadly on track. It's a little bit slow to get going because some of these trades don't settle until for a bit of time, but it'll be picking up steam. And I guess your second question was getting, the process of getting back down to the new equilibrium will take a while, and that time, it's hard to be precise, but the model would suggest that it could be between 2.5 years, that kind of thing. And this is a much faster pace than the last time. Balance sheet's much bigger than it was, but we looked at this carefully, and we thought that this was a sensible pace, and we have no reason to think it's not.
Hi, Chairman Powell. Brian Chung, Yahoo Finance. Looking at
financial conditions, it seems like the tightening has slowed as of late with the 10-year coming down, 30-year fixed mortgage rates also going a bit sideways when we talk about a hot housing market still. Just wondering if you find financial conditions tight enough, especially as you continue to raise rates.
So a big piece of that is inflation expectations, break-evens coming down, which, is a good thing. It's a good thing that markets do seem to have confidence in the committee's commitment to getting inflation back down to 2%. So we'd like to see market-based, readings of inflation expectations come down. Broader financial conditions have tightened a good bit. I mean, the way this works is we set our policy, and financial conditions react, and then financial conditions are what affects the economy. So, and we don't control that second step. We're just going to do what we think needs to be done. We're going to get our policy rate to a level where we're confident that inflation will be moving back down to 2%. Confident. So that's how we're going to take it. And of course, we'll be watching financial conditions to see that they are appropriately tight and that they're having the effect that we would hope they're having, which is to see demand moderate and inflationary pressures recede and ultimately inflation come down.
Greg. Thank you, Chair Powell. Greg Robb from MarketWatch. I wonder if you can go back a little bit in time to before there was this outbreak of inflation, when the committee put in place forward guidance on tapering asset purchases. I think it was December 2020. There's a recent speech by Fed Governor Waller talking about that and saying that maybe that was too tight, that kind of condition, and it put you a little bit behind. Not his words, but maybe, we're kind of late to react to some of that inflation. So could you talk about that decision, and have you looked at it in hindsight at all? Thank you.
So, yeah, we said that we wouldn't lift off until we had basically achieved our dual mandate goals. And the reason we did it in real time was that the first look at the new framework that we'd rolled out, plenty of people were saying, oh, it's not credible, you'll never get inflation to 2%. Some of our critics now who say inflation is too high were the same ones who were saying you'll never get to 2%. Well, but anyway, that's what happened. So we thought we needed to really make a strong statement with that. It wasn't part of the framework. The December 20 guidance was not part of our overall new framework. It was just guidance that we put in place. So I would say two things. One, I don't think that has materially changed the situation. But I have to admit, I don't think I would do that again. I don't think I would do that again. Ultimately, the situation evolved in a highly unexpected way for all of us. And, maybe the learning is that leave a little more flexibility than that. But did it matter in the end? If you look at, I really don't think it did. I'm not sure it would have mattered if we'd been raising rates 3 months earlier. Does anybody think that would have made a big difference? I mean, lots of central banks were raising rates 3 months earlier, and it didn't matter. I mean, this is a global phenomenon that's happening now. Admittedly, different in the United States, but anyway.
Nancy. I'm sorry about that, Greg. Just a lot of people talk about that time, and they talk about a taper tantrum that I know you haven't talked about it too much, but that you were worried at the time about repeating that taper tantrum that you had experienced as a governor. So was that part of that? Where did that fit into all those decisions? Thank you.
So I think we learned there have been multiple taper tantrums, right? So there was the famous one in 2013. There's what happened at the December 18 meeting where markets can ignore developments around the balance sheet for years on end and then suddenly react very sharply. So we just had developed a practice of moving predictably and doing it in steps and things like that. It was just like that's how we did it. And so we did it that way this time. We were careful to take steps and communicate and all that kind of thing. We were trying to avoid a tantrum because they can be quite destructive. They can tighten financial conditions and knock the economy off kilter. And when it happens, you have to really in both 13 and 18 really had consequences for the real economy, 2, 3, 4 months later. So we were trying to avoid that. That was part of it. Again, I don't think that's the real issue of 2020 and 21 was just trying to understand what was happening with the reopening economy. That was where the big uncertainty was. And our view was that these supply side issues would get better, that people would go back to work, that labor force participation would come back, everyone would get vaccinated, schools would open, kids would be in school, and labor force participation would jump back up. That was very broadly thought to be the case. These supply side issues would get solved reasonably quickly, and they just haven't. They still haven't. So that's really the learning, I think, is around how complicated these supply side issues can be. We haven't seen this before in a long, long time, and so that's really what accounts for the pace at which we moved. And we did when inflation changed direction really in October. We've moved quickly since then. I think people would agree. But before then, inflation was coming down month by month, and we kind of thought we had the story, probably had the story right. But then I think in October you started to see a range of data that said, no, this is a much stronger economy and much higher inflation than we've been thinking. And again, we pivoted, and here we are.
Nancy Marshall-Genzer with Marketplace. Chair Powell, I just want to pin you down a little bit more on the issue of recession. So if we get a negative GDP number tomorrow for the second quarter, would the Fed consider the U.S. in a recession? And just remind us, what is your definition for the start of a recession?
So the Fed doesn't make a judgment on that. We're focused on the dual mandate and using our tools to achieve maximum employment and price stability. We don't say there is now a recession and that kind of thing. So that wouldn't be something we do. We would look at the data tomorrow, and no doubt we'll look at it very carefully and draw whatever implications we can. As I mentioned, though, if you think about what a recession really is, it's a broad-based decline across many industries that that's sustained for more than a couple of months, and there are a bunch of specific tests in it, and it just doesn't seem like that now. What we have right now doesn't seem like that, and the real reason is that the labor market is just sending such a signal of economic strength that it makes you really question the GDP data. But again, that's not a decision that we make, and we won't reach a conclusion one way or another on that.
Thank you very much. Simon Rabinovich with The Economist. You've said that some softening in the labor market is needed. Within the Fed, there are staff economists who've argued that NIRU, the non-inflationary rate of unemployment, might be as high as 5 to 6% right now, which obviously is a lot higher than the current rate of 3.6. What's your assessment of NIRU? Is that something that came up in discussion with the committee?
So I think broadly, a lot of economists think that the natural rate of unemployment will have moved up to some significant extent above where we think it was before. And the reason is it's the usual matching issue where matching has become less effective and that kind of thing when you have the kind of turbulent downturn and the big switches in demand from services to goods and all that. So it could be higher, and my own instinct is that the natural rate of unemployment is higher. Of course, I would add that we don't know it. We can never know where these star variables are in real time with any confidence, but I would say it must have moved up materially. But the other side of that is as all these jobs get created and people go back to work and unemployment is so low, I think you could, in principle, you could see it coming back down pretty significantly. And that would also, by the way, take pressure off of inflation, because it's that gap. It's the gap between actual unemployment and the natural rate that really is relevant for, the negative slack we have in the economy by the overtight labor market. So if you wouldn't observe this. It's an unobservable, but you could actually be seeing inflationary pressures coming down if that does happen. And we don't control that, but that's something that logically. If the pandemic and the disorder in the labor market cause the natural rate to move up, then as the labor market settles down, in principle, you should see it move back down.
Thank you, Chair Powell. Jeff Cox from CNBC.com. Just a question about, hate to keep banging the drum about recession, but most of the polls that we're seeing now from the public, people believe that we're already in a recession or heading for one. Economists pretty much the same thing. They're being told by folks like you and in the administration that we're not in a recession, we're not heading for a recession. Frankly, coming from the same people who told them that inflation was transitory, telling them now that we're not heading for a recession. So what would you tell the public to reassure them now that you feel confident in your forecast going forward and the Fed is ready to respond to a potential downturn in the economy?
No, all I've really said is I don't think it's likely that the U.S. economy is in a recession now, and I've explained why that is the case. It's because you do see a very strong labor market, and I think the public will see that as well. You know, going forward, what we've seen is a slowing in spending, as I mentioned. We've seen the very beginnings of perhaps a slight lessening in the tightness of the labor market, but it would only be the beginnings. So, and I mentioned that I also said that our goal is to bring inflation down and have a so-called soft landing, by which I mean a landing that doesn't require a significant increase, a really significant increase in unemployment. We're trying to achieve that. I've said on many occasions that we understand that's going to be quite challenging and that it's gotten more challenging over recent months.
Thanks, Chair Powell. Kyle Campbell with American Banker. The FOMC has historically tried to avoid the kind of rapid monetary policy tightening that has happened so far this year. How concerned are you that the rate hikes that we've seen thus far might increase risks to financial stability, not just domestically, but globally?
I mean, there are precedents for the FOMC moving very quickly. For example, 1994, 1980, even more so. So we've been known to do that when it's the appropriate thing to do, and this year it clearly is. I would say that given how quickly we've moved, I'm gratified that while that basically markets have been working, they've been orderly. There's been some volatility, but that's only to be expected. From a financial stability perspective, you know, asset values are down, which in some sense lowers vulnerabilities. It's when they're really high that you would worry that they're vulnerable to a fall. Actually, many asset values have come down. I think you've got a well-capitalized banking system. I think you have households are generally in about as strong financial shape as they've been in a very long time, or perhaps ever, given what the money that's on people's balance sheets, and so you have a pretty, from a financial stability standpoint, you have a pretty decent picture. Now, the macroeconomic, there are plenty of macroeconomic issues that don't rise to the level of financial stability concerns. By financial stability, you know, we think of that as things that might undermine the working of the financial system, so big, serious things. That's not to say that people at the lower end of the income spectrum aren't suffering, because they are. They're suffering from high inflation. They're going to the grocery store and finding that you know, in many cases their paycheck, it doesn't cover the food they're accustomed to buying. We're seeing actual, you know, real declines in food consumption, and you know, it's very concerning. It's very unfortunate, and that's why we're really committed to bringing down inflation. One of the reasons.
Go to Mark for the last question.
Thank you, Mr. Chairman. Mark Hamrick with Bankrate. I can remember when you held your first news conference and you vowed to be a very plain-spoken chairman, and we're thinking today about the impacts of Fed policy on individuals as well. What would you say to individuals or households who may yet lose their jobs in this tightening cycle in the fight against inflation as they try to translate what Fed policy means to them in this complicated economic landscape?
Yeah.
Thank you.
So I guess the first thing I would say to every household is that we know that inflation is too high. We understand how painful it is, particularly for people who are living paycheck to paycheck and spend most of that paycheck on necessities such as food and gas and heating their homes and clothing and things like that. We do understand that those people suffer the most. Middle class and better off people have some resources where they can absorb these things, but many people don't have those resources. So it is our job, it is our institutional role. We are assigned uniquely and unconditionally the obligation of providing price stability to the American people, and we're going to use our tools to do that. As I mentioned, there will be in all likelihood, some softening in labor market conditions. We need growth to slow to below potential growth. We don't want to, we don't want this to be bigger than it needs to be. But ultimately, if you think about the medium and longer term, price stability is the thing that makes the whole economy work. It's what can give us a strong labor market and wages that aren't being eaten up by high inflation. If you talk to people, again, people who are making wages, relatively low wages, they're the ones who are suffering the most from inflation. So it's all the more reason why we need to move on this. Thank you very much.
That was Fed Chair Jay Powell wrapping up his news conference after the Fed raised rates by 75 basis points. Let's take a look at the stock reaction, because you can see in the intraday charts, are really right on your screen right now, Dow up 495 points, S&P and Nasdaq adding to earlier gains. Look at that. The Nasdaq up just over 4%. We initially saw that boost when Fed Chair Jay Powell was talking, after he said that it will likely be appropriate to slow pace of increases as rates get more restrictive. Now, Powell went on to say that the Fed wants to see, quote, compelling evidence that inflation is moving down, stressing once again the need to be nimble. He also added about the pace of future increases, saying that it will depend on incoming data and evolving outlook for the economy. He did, though, leave another potential large rate hike on the table, saying that another unusually large increase could be appropriate at the next meeting, depending on that data that he referenced numerous times during the press conference. Dave, you and I were giggling a little bit here in studio because the reporters kept trying to press him about whether or not we are in a recession, what that would potentially look like. He did say he doesn't think that we are in a recession right now, but the question is whether or not Wall Street investors are buying it.
Yeah, Jay Powell got worn out because Steve Leishman tried to get him to define that recession. And look, we're going to hear that we're in a technical recession tomorrow, when in all likelihood we get that negative GDP number, therefore 2 contracting quarters in a row, and for many, a definition of a recession. But he also couched that, Shauna, by saying, we're going to take those first GDP reports with a grain of salt. So not only did he take 4 times to really define a recession, which he did not do other than to say we are not in one. He is seeing some cooling in the housing sector. He is seeing some cooling in terms of business investment and in consumer spending. But of course, in the face of that, the Visa earnings yesterday said I'm seeing unconstrained consumer spending. So to his point, there are all sorts of reads on this economy. What struck you, Rochelle?
Well, as you mentioned there, obviously we heard the recession come up multiple times. He really wasn't getting baited into saying, whether or not he thought his decision would change based on GDP. And he did keep referring back to the strong labor market, saying it's not consistent with the recession, saying it doesn't make sense. So obviously they were asked at what point, what is that red line that does happen with the labor market that might change that? Obviously, this is a very data-dependent Fed, so they're not about to sort of jump into anything. But as you mentioned, they're not taking that very high rate hike of 100 points off the table, but still keeping it in that 75 basis point range. They do seem to be staying the course. And they did say that he said that markets have confidence in the committee's commitment. Now, obviously, we've seen the Dow, the S&P, and the Nasdaq, especially the Dow and the Nasdaq, really take off after those comments from Powell. So perhaps that's consistent. Perhaps the markets do have confidence in that commitment.
All right, let's check in with Yahoo Finance's Brian Chung, who was just in the room moments ago with Powell. Brian, what stuck out to you from the conference?
Yeah, well, a bit of a roller coaster of a conference that wrapped up just now. But the key takeaway is essentially that the Federal Reserve doesn't have any sort of forward guidance on what its next steps might be. Keep in mind, there are 3 more meetings through the end of this year. And the last few meetings, we got some guidance that, well, it might be 50, it might be 75. It's probably going to be this, it's probably going to be that. Not the case for the next meeting at the end of September in about 8 weeks. Now, what also caught our attention, and probably the attention of a lot of Americans as well, was the Fed chairman's commentary on him not thinking that the U.S. is in a recession right right now. He was saying there's just too many areas in the economy that are performing well, pointing to the labor market where the unemployment rate is at 3.6%. But, one important thing is that as we talk about what's going to happen next, right? Could the Fed trigger its own recession if it tightens too fast? Well, one place where you can look for that answer is in financial markets. When you take a look at the 10-year, they were getting the message that the Fed was going to raise interest rates, so they raised kind of their expectations, rising to almost 3.5% as of the last meeting in June. But those conditions have come back down. You see the 10-year around 275 right now. You also see the 30-year mortgage going sideways. So what does that tell the Fed about how they are reading their reaction function? Take a listen to what Fed Chairman Jay Powell said when I asked him that exact question.
A big piece of that is inflation expectations, break-evens coming down, which, is a good thing. It's a good thing that markets do seem to have confidence in the committee's commitment to getting inflation back down to 2%. So we like to see market-based, readings of inflation expectations come down. Broader financial conditions have tightened a good bit. I mean, the way this works is we set our policy, and financial conditions react, and then financial conditions are what affects the economy. And we don't control that second step. We're just going to do what we think needs to be done. We're going to get our policy rate to a level where we're confident that inflation will be moving back down to 2%. Confident. So that's how we're going to take it. And of course, we'll be watching financial conditions to see that they are appropriately tight and that they're having the effect that we would hope they're having, which is to see demand moderate and inflationary pressures recede and ultimately inflation come down.
So obviously, when it comes to the conditions that the Federal Reserve faces right now, he's really not saying that he's concerned about anything right now, at least when it comes to those conditions coming back down, even though 30-year mortgage rates haven't continued to rise further, which could be more helpful to depressing some of the hot demand in the housing market. The Fed chairman saying he's comfortable with where financial markets are right now. So a wide-ranging commentary from the Federal Reserve as they again did another 75 basis points this afternoon.
An honest assessment that the inflation print was, quote, worse than we expected. But Brian, what do you make of the markets bouncing on the obvious statement, the expected statement that at some point it will be appropriate to slow down? Everyone expected that. Why did the markets bounce so significantly in your estimation?
Yeah, well, I mean, this is because maybe the Federal Reserve was a bit more dovish than the markets had been expecting prior to 2:30 p.m. Now, when it comes to, of course, reading market reactions, it's a bit of a fool's errand to attribute any reaction to one single reading of what happened. But essentially, we have to remember here that the Federal Reserve also cautioned the other side of things. They could get even more aggressive if they wanted to. Earlier in the press conference, Fed Chairman Jay Powell saying that they could deliver another unusually large rate hike, kind of essentially reminding the markets, hey, we don't usually do this type of thing, but that leaves on the table, certainly, the case for something larger than 75 basis points. Now, whether or not they get more aggressive on the rate hikes or at some point they start cutting rates, it's all about the data. Again, that underscores how important it is that the Fed essentially saying forward guidance, it's not a thing anymore. So RIP forward guidance, born earlier this year, dead officially now.
Goodness. Well, thank you for keeping us up to speed on all the goings on at the Fed there today. Brian Chung, thank you so much. All right, well, now let's bring in Milton Ezrati, Vested Chief Economist, to weigh in on Powell's comments and the Fed decision. So, Milton, that 75 basis point hike, how is it in terms of, is it enough? Is it too little? And what did you pass through in terms of the comments that you heard from Powell?
Well, it was certainly easier to listen to Powell now than it was last year. He's talking straight. He refuses to say that there won't be a recession. He's hopeful about the soft landing. He's playing it very close to the chest about how much rates are going to have to go up. I think he's soft pedaling. I think that unless we get very lucky with the inflation, and that would be very lucky, he's going to have to raise rates a good deal more, and I think the market will be disappointed if they think that this is the end or close to the end. Keep in mind that even with these rate increases, you're still paying less on your loan than the lender is losing on inflation. So effectively, you're making real return for the use of someone else's money. The Fed has to change that to say that financial conditions are really tight, and it needs to make them tight to beat the inflation. So my own assessment is that he's going to have a very hard time, in fact, a nearly impossible time, giving us the soft landing. He has to soft pedal that now, not because he's hiding anything, but because he's going to look at the data. If we get lucky on inflation, we may avoid this, but that would be very good luck.
Milton, it sounds like you're expecting we would likely be headed towards a recession if we're not already in one. How deep of a recession do you think we'd likely see?
Well, that's an interesting question. I think if the Fed does its job and raises rates enough and tightens financial conditions enough to avoid a recession, to stop the inflation, or at least start us on the road to stopping the inflation, then we would have a relatively short recession and come back from it relatively quickly. If the Fed loses its nerve and doesn't do enough, and the inflation itself causes the recession, which is entirely possible, inflation causes a great many economic dislocations, then it could be a long, painful recession. So in this sense, I'm applauding Chairman Powell's repeated statement that the most important thing is that the Fed do what is necessary to stop the inflation. I don't think they've done enough yet, but they have to go cautiously. I think they're going to have to do a lot more.
Despite what he calls
at least a short recession. Sorry.
No problem. Despite what he says is robust job growth, more than 400,000 jobs created per month on average, he does say, Powell, that he's seeing some signs of housing, business investment, consumer spending shrinking. Do you see signs that the Fed is succeeding? And between now and September, do you think that 9.1% print will begin to come down?
That would be good luck. Because inflation moves at a lag, and it's responding to years of money creation, as well as the supply constraints and the more immediate effects. So, yes, I think we could see lower numbers, but we're not going to see acceptable numbers for quite some time. And I don't think there's any way to avoid that. This is built into the system, and I'm not going to join the transitory crowd, or neither am I ready to forecast that we've done enough. So I think we may see the numbers come down a little bit. We may see it fall considerably. Maybe it's 7.5% or 7% inflation. That is still unconscionably high. So the Fed's going to have to continue to keep the pressure on to do its job. I do see the mix that Chairman Powell talked about, and I would be loath to say that we're in a recession now, but this is a definition game. I think the important thing to realize is the economy is weak and weakening, and if the Fed does its job, or if the inflation gets worse, then it's going to get weaker sooner. So by September, by the end of the year, I think we will be talking about recession without the reservations that Chairman Powell expressed earlier in the day.
And was there anything that you hoped that Chair Powell would go into more detail on in his comments?
I would love for him to tell us what the Fed really thinks, because they have their deliberations, and clearly there's a number of forecasts. No one can see the future, but I know he can't do that. And I was actually delighted to see his reluctance to do forward guidance. It's as much as saying that we don't know exactly where we are, and we're going to have to go with the data, which was honesty that we haven't seen from Washington in a while.
Milton, the reaction that we're seeing in the bond markets today, the reaction that we're seeing in the equity markets, I know you're focused on the economy, but just your reaction to this, because I think a lot of people thought that largely what we heard from Jay Powell today had already been priced in.
Well, I think we had priced the equity market has been discounting a recession of some sort for quite some time. So bouncing a little bit in this environment, particularly with the Fed soft pedaling things, particularly with the fact that the Fed didn't raise rates any faster than the market long expected, it's not surprising that the market would show a little optimism. But I think if it's hoping that this is it, it's going to be disappointed.
Don't hold your breath, indeed. Thank you very much, Milton Ezrati. Appreciate your insights here.
Pleasure.
All right, the Senate voted earlier today to pass the CHIPS and Science Act, with 64 voting for and 33 against. Now, the bill will be sent to the House, where Speaker Nancy Pelosi has promised quick action. The bill includes over $52 billion for U.S. companies producing chips domestically, as well as tax credits to encourage investment in chip manufacturing. We will speak with the President, CEO of Jobs Ohio, about the passage in just a bit. Coming up, our next guest says that as the Fed raises rates, investors are favoring one specific type of ETF. Find out what and why next.
The Federal Reserve moves markets at the moment with its 75 basis point hike. As we can see, the strongest performers, the Nasdaq and the Dow. The Dow up more than 520 points there. The S&P 500 up almost 3%. But look at the tech-heavy Nasdaq up about 500 points, about 4 1/3%. Well, let's break some of this down with Verify Head of Research's Todd Rosenbluth. He's here to discuss how the Fed's moves impact ETFs for this week's ETF report, brought to you by Invesco QQQ. So good to have you on. In this sort of environment, where are investors pouring into with ETFs?
So we're seeing a rotation. We've seen money moving out of fixed income mutual funds. About $300 billion has flowed out of bond mutual funds in the last 7 months. And we've seen $90 billion flow into bond ETFs. Investors are taking advantage through tax loss harvesting. They're taking advantage of the lower costs, and they're taking advantage of the ability to shift their exposure towards the less interest rate sensitive sides of the marketplace, as well as taking on some credit risk with high yield. And so we saw just yesterday an ETF SLQD. SLQD is the shorter term version of the more popular investment grade corporate bond ETF, LQD, and that ETF, SLQD, saw its biggest day of inflows in its history, according to our data at Verify. Investors wanting to protect against the downside of the higher interest rates that we're talking about today, but also getting some of that income through investment grade corporate bonds. So that's one of the areas we've seen strong interest, as well as high yield.
And what's the impact, Todd, on the bond ETFs, given the 75-point hike, and as well as what we heard from Jay Powell today?
So I think what's encouraging from the comments from Jay Powell is his expectations, and hopefully others as well, that we are going to avoid a recession. And if we're going to avoid a recession, then higher yield bond ETFs can make more sense within the portfolio. They invest in companies that have more credit risk overall, and you find that investors are wanting to take on additional income. We did a survey recently of advisors at Verify, and high yield is where they've been searching. And we saw some interest in a couple of ETFs that are a little bit under the radar. So HYDW is an X-Trackers low beta high yield ETF, and we also saw interest in HYGV. So let me go with HYDW since that's on the screen. This is a lower risk way of getting high yield exposure, and HYGV is a more value-oriented version of the high yield bond market. So these are some of the smaller but yet growing ETFs that we're seeing within the high yield market that's gaining attention with our advisors.
Todd, I want to switch gears real quick. Another big story of the day is the tech earnings, or really I should say this week, because we had Alphabet and Microsoft after the bell yesterday, Meta out today, Apple and Amazon tomorrow. From an ETF perspective, what have you seen interest-wise in some of these technology-focused ETFs, and what do you expect during this earnings season?
So we're seeing that the bar is relatively low. I think Alphabet having strong stock performance today, despite having relatively weak and weakness overall. I think there's expectations that Meta is going to have a revenue decline. But I do want to clarify, in the ETF world, the sector classification really matters. So Alphabet and Meta are communication services stocks, according to the GICS framework. And so you'd find that in XLC, that's the communication services sector ETF, whereas companies like Apple and Microsoft and Qualcomm, that's reporting later on today, is what you'd find within the technology sector ETF like XLK or Vanguard's information technology ETF VGT. So if you're a sector ETF buyer, it really matters to know what's inside the portfolio instead of just assuming these are all technology companies. We call them technology companies, but from an index perspective, it really is the devil in the details.
It's important to make that distinction. Todd Rosenbluth of Verify, thanks so much for joining us. The Biden administration says it has offered the exchange of Russian convicted arms trafficker Victor Bout as part of a deal to secure the release of WNBA player Brittany Griner and security professional Paul Whelan, according to a new report from CNN. Now, Whelan has been imprisoned in Russia for alleged espionage since 2018, and Griner was arrested for drug possession in February. Griner pleaded guilty to bringing cannabis into the country earlier this month and faces 10 years in prison as a result. Her trial is ongoing, and according to U.S. officials, will need to conclude before negotiations for her release can move forward. Bout, a former Soviet military officer, is currently serving a 25-year prison sentence in the U.S. on charges of conspiring to kill Americans, acquire and export anti-aircraft missiles, and providing support to a terrorist organization. Well, coming up, investors are jamming out to Spotify during today's session. The stock moving to the upside on the heels of earnings. You can see the reaction there, up just over 12%. More on that when we come back.
Welcome back. Triple Play is on deck, and my pick is Berkshire Hathaway, but it's based on some news. Trident Mortgage Company, a division of Berkshire's Home Services of America, getting hit with the second largest redlining settlement in history. That's according to the Justice Department. Now, redlining is a discriminatory practice of deliberately putting services, including loans and mortgages, out of reach for residents of certain areas based on race or ethnicity. Now, Trident was accused of doing that in minority-majority neighborhoods in Philadelphia, New Jersey, and Delaware. The $22 million deal includes a $4 million fine going to the Consumer Financial Protection Bureau, as well as funding an $18.4 million loan subsidy program, and that's to increase mortgage credit access primarily in those underserved neighborhoods. Now, the stock not moving much today, but the optics and reputational impact not good.
Certainly is not good, Rochelle. We had HUD Secretary Marcia Fudge on the show yesterday talking about discrimination in the housing sector and why it's a priority for the Biden administration. Certainly the fact that it is prevalent, especially at a time like this. And I also want to read a quote from CFPB Director Rohit Chopra. He said that, quote, with housing costs so high, we've been talking about the fact that housing prices still are up just about 20% than they were a year ago. He said, with housing costs so high, it is critical that illegal discrimination does not put home ownership even further out of reach. So certainly we will be looking for a commentary from Berkshire Hathaway. We know that Warren Buffett, at least, has not spoken out on this issue yet. All right, my play today is Spotify, doubling down on podcasts in an effort to get an edge in the streaming landscape. Revenue topping the street's estimates while posting a wider than expected loss. Total monthly active users, 433 million. That's up 19% from just a year ago. Premium subscribers growing 14% from a year ago to 188 million. On the earnings call, CEO Daniel Ek saying that Spotify is, quote, preparing as if things can get worse, but he did add that there has been no material impact on user growth amid the economic slowdown. You can see the reaction in the stock today. Shares up just about 12%, Dave, up just over $116 a share. So for Spotify, at least, they're not seeing a slowdown just yet.
There's a lot here to unpack. To your point, to hear the CEO say it's hard to reconcile a dark and gloomy macro environment with what we're seeing because the everyday story is very positive. I don't know if that's entirely true, if theirs is indicative of that shift from spending on goods to services, right, which of course Spotify is. But just more on this, a remarkable increase in podcasts inside of this. 400,000 more podcasts added in the quarter than there were before. So we're at 4.4 million podcasts on Spotify alone. I had no concept. Do you know what the number one is now? It is past Joe Rogan in many markets. I had not heard of it. It was a little quiz to see if you knew it. I didn't know it.
I would have guessed Joe Rogan.
Batman Unburied is become the number one podcast nationwide in many markets. It's a flip on the whole script about Bruce Wayne doesn't actually remember being Batman, and he's a forensic pathologist. Just wondered if you had heard this.
I hadn't, but maybe I need to check it out if it's that popular.
I really dug into the story.
It doesn't really seem up my alley, but you never know.
But one last thing on Spotify. They were down 55% year to date before this, so it was easy to leap over that ladder. All right, my play is Chipotle. Shares of the burrito chain on pace for their largest percentage increase since March of 2020. Chipotle said revenue increased 17% in the quarter, with same-store sales up 10%. Higher prices boosted margins, and the company said another increase is coming in August. That's right, your burrito is going to cost more, but they say still a deal. Chipotle CFO Jack Hartung told Yahoo Finance this morning they've seen lower income customers begin to pull back on spending, but he also raised a few eyebrows on the earnings call, saying this.
College students go back home and they tend to eat less. I don't know if that's more mom's home cooking, but when we track the individual customers, they tend to visit Chipotle to a lesser degree when they're away from college than at college.
Okay, shares are up about 15% on a mixed earnings report yesterday. They are on fire again, largest percentage gain in a couple of years. But Rochelle, bottom line is here. Mom is at fault. Mom cooking for college kids is really holding back the burrito growth.
Well, excuse us for trying to save a little money and make sure our kids are okay. And I don't know if you could just put all the blame on mums. I don't really find that particularly fair.
And they're not.
I mean,
They're not
people could be
entirely.
getting their food from anywhere, you know. So no.
And what
It's
about
not
the
us, it's not
dads?
us.
Dads cook too. That
Right.
was my big takeaway. Why is it
Oh,
just moms?
I did-
Dads should be cooking as
All the
well.
blame on us.
Yes,
I
all about
didn't even
equality.
see that spin. You're right. There
Really?
was a little bit of maybe a
Definitely
pinch of
was.
sexism
I
in
know.
there.
Yes, I think they're definitely. I know. Well, this is maybe you need to start cooking a little bit more.
I
at
do
home.
not. I do grill.
There you go.
And
that's very
cereal.
helpful.
Does your husband cook?
He does the grill.
Okay.
And cereal. You guys are very much on the same page with that.
Yeah. You see, the reason a cliche becomes a
guess.
cliche? Us.
I don't know.
Yeah. All right. Coming up, we're counting down to the closing bell on Wall Street. Stay with us right here on Yahoo Finance Live.
All right, we're just minutes away from the closing bell on this big Fed announcement day. Our very own Jared Blakely is breaking down the market action for us. Jared, what are you watching?
I'm watching the Nasdaq having its best day in 2 years. That would be the pandemic lows. And let's see if we can get some price action on the chart today. This is a 2-day look, and you can see it clawing back those losses. But let's take a look at the 3-year and enjoy the fact that we haven't seen a day like this in that time. But is everything okay? Is it the all clear? I don't know, but I'm thinking bear market rally is a possibility. But just let's consider that the Fed day has been reversed on the following day several prior times this year. Taking a look at the bond market, this settled at 3 p.m. We can see the 10-year T-note yield is down 5 basis points at a potential support line. Big implications there. We're going to be talking about that tomorrow morning around the opening bell. And now we have XLK, that's the tech sector, that's up 4.4%, followed by communication services. That's where Facebook and Verizon and Meta live. Well, I guess Facebook is Meta. Also consumer discretionary. Those are the leaders today. Even utilities pulling in the rear, up 13 basis points. Not going to see any losses there. Here's our leaders index. ARC, that is up 6.5%, best day in a while. We got TAN, FDN, SOX. That it would be the semiconductors. A lot of these markets, especially the chip stocks, have been weak because of cyclical growth scares. Also taking a look at the software space, we got Microsoft up over 6%. That's after earnings. And we got to take a look at travel. as well. So here we have Booking that's up 4%, AB&B up 5%, Southwest up 3%, Expedia up 6%. Going to be hard to find some I think it'd be hard to find some red on your screen today. We got to look at some of the fringe sectors. Here's Estee Lauder, that's up 4%. Don't often look at beauty, but we see that up as well. Ulta up 2.8%. And retail, which got absolutely smashed this week, showing some signs of life. Here's Shopify, an earnings story. That is up 11.5%. And here is your closing bell on Wall Street.
There you have it, your closing bell for July 27th, also known as Fed Day. We saw the markets really taking off after those comments from Jay Powell. As we see there, the Dow there ending up more than 400 points. The S&P 500 up more than 2.5%. They're at a 102-point gain. And look at the Nasdaq. As you can see there, as Jared was saying there, the biggest growth we've seen since pre-pandemic at 469 points, gaining more than 4% on the day. Well, joining us now for more on the markets is our panel, Lenore Hawkins, Callett Advisors Partner, and Lisa Erickson, US Bank Senior Vice President and Head of Public Markets Group. So, Lisa, I want to first start with you. What are your biggest takeaways from the movements that you're seeing from the markets, given that we have seen markets sort of reverse this stance the following day after we hear these Fed comments?
Well, for today, Rochelle, I think to your point, really what's going on is a little bit of a relief rally. We've had some difficult news really over the past few weeks, but as we've gone into earnings season, we've had lowered bar and people have really been able to respond positively to results that weren't as bad as feared. And then if you move to the today, we had, I think, a very similar reaction where people were a little edge about what could have been by Chair Powell. Found was he was really reiterating much of the message that he's had before, which is vigilant on inflation, labor market provides some room for continued tightening. And so really what we saw was the markets reacting positively to that message.
Lenore, what do you think of today's rally? Because like Lisa was just saying, a lot of this has to do with what we heard from Powell, the fact that maybe the pace of rate hikes will potentially slow in the future if we do see inflation come back a bit. Was this jump justified?
What we've seen, as I think you guys just mentioned, that we've seen often the day of the FOMC minutes are released, the market goes up, and then the day after it reverses that. Because I think if you dig into the details of their statement, it was really interesting to see that they were actually more negative on the economy than we've seen in a while. They pretty much admitted that the economy is in a different position than they expected it would be at this point. And yeah, they raised the full 75 basis points, but they'd already promised they were going to do that, so I don't really read much into that. What I do find interesting is that they're commenting on the economy slowing, but the job market is still strong. Well, it's interesting to see that initial jobless claims are up over 50% from the lows, and that's traditionally been a very strong recessionary signal. And I would also tell people to keep an eye out for any downward revisions to prior non-farm payroll reports, because we tend to see that when the economy is shifting direction. And I would expect to see some of those downward revisions.
Lisa, no fewer than 5 reporters tried to get Jerome Powell to weigh in on the definition of a recession. While he punted on that, he did acknowledge that he does not think we can be in a recession with this robust job growth, as Lenore said, north of 400,000 jobs per month. Do you agree with that assessment? And could tomorrow change that pending that GDP number?
We are concerned really about where we are headed with growth overall and whether we end up in a technical recession or not. If you look across indicators, what you see is the economy has been slowing. And while the labor market remains quite strong across a number of other sectors, we've been seeing the trends in both top-down indicators as well as corporate earnings moving in a decreasing trend. And so we are cautious moving forward because of that. And on top of that, again, while the markets reacted well to Chair Powell's message today, the Fed is nonetheless tightening, and that provides another headwind to the stock market.
So, Lenore, when we do get that GDP print tomorrow, how do you expect the markets to react?
If it comes in where I expect it to come in, I think the market is going to get really nervous, because typically when we've seen this kind of movement, both in the market and what we're seeing in the economy, the only way that this turns around is if the Fed reverses course, stops tightening, and actually starts to loosen. Because we're really in uncharted territory. We've never had an economy contracting. We've never had so many indicators going negative while the Fed is actually tightening. So it's tough to say just exactly how this is going to pan out. But if we get a bad print tomorrow, the market is probably going to be nervous, and it ought to be nervous. You know, we're seeing home prices falling down significantly. Consumer sentiment is pretty grim. Capacity utilization is falling. That tells us that's a deflationary thing. And while supply chain problems are actually getting worked out, we're seeing those inventory levels building up. And like we heard from Walmart and Target, they have to start cutting prices. All of those are all warning signals.
Lenore and Lisa, hang on one second. We want to get to Ali Garfinkel. We have Qualcomm out with its earnings report, stock off after hours. Ali, what can you tell us?
Shauna, with Qualcomm, we have mixed results today. Revenue top line, we have a beat of $10.93 billion versus $10.87 billion expected. Adjusted earnings per share, bottom line, $2.96 versus $2.86 expected. So looks pretty good, but shares are actually falling at Qualcomm based on the guidance for Q4. So not what people were expecting. It's worth noting also that Qualcomm, as it extends its partnership with Samsung, is reporting actually at the backdrop of a global chip shortage, inflation, rising interest rates, which can affect corporate purchases, and of course the tech route. Qualcomm's been trying to diversify, so kind of a mixed story over here for Qualcomm today.
Certainly looks like that. Again, the shares off just over 3% after hours. Ali, thanks so much. Lisa, let me get your reaction to what we're seeing so far from the tech sector and some of these semiconductors. So Qualcomm falling here, a lot of that has to do with guidance. The earnings that we got from Microsoft and Alphabet yesterday was enough to satisfy the street, but they weren't great. We're awaiting Meta. They're going to be out any minute. What do you make of where things stand, more broadly speaking, in the tech sector?
Has seen a more difficult season would have been anticipated a few quarters ago. And I think what we're really seeing in the earnings reports is the fact that there really was a pull forward during the initial start of the COVID pandemic. People thought that those could continue on, that there wasn't necessarily going to be a diminishing of the demand, but we are seeing some economic normalization where people are going back to more in-person experiences as opposed to just online. So that remains to be seen as we continue to report out if those trends continue. But again, I think the big picture here is that we are seeing, while maybe a secular tailwind to continued use of technology, some slowdown in the demand here in the intermediate term.
And Lenore, if you have a reaction to Qualcomm, please add to it. But I want to ask you also about, to Shauna's point, Microsoft and Alphabet. Disappointing, they missed on the top and the bottom of the line. And look at their stocks today, right? Microsoft up nearly 7%, Alphabet up nearly 8%. I've tried my whole life to set the bar low. It's easy to leap over it. Maybe that's the strategy now on Wall Street. But what do you make of those two stocks bouncing on misses?
Obviously, the expectations were that it was going to be even worse than it ended up being. And I think what we are seeing is a real readjustment in expectations, because let's face it, I mean, tech stock pricing really got just into the ridiculous stratosphere during the pandemic. We had a crazy situation where people are suddenly, the economy is massively adjusted, and then a ton of money is thrown at it in the form of all that federal spending, the stimulus. And we also had monetary policy go crazy. So there's just a ton of money gets thrown at people while they're stuck at home. And you got a lot of buying that was really out of whack with what would have normally happened. So now all that's trying to readjust. But when you look at a company like Qualcomm, keep in mind that the Senate just voted 2-1 in favor of a package that's going to subsidize research and funding on U.S. chip and advanced tech sectors, because there's all this concern with onshoring, bringing that technology back into the domestic market. Keep in mind that in the 60s, the U.S. produced around 40% of the world's chips. And today, about 80% are produced in China, with the remaining 20 just across the rest of the world. So there's a really great tailwind for domestic companies like Qualcomm.
Lenore Hawkins, Lisa Erickson, thanks so much for joining us. We have some more breaking news. Meta out with its earnings report. Dan Howley has that for us. Dan.
That's right. We have a slight miss here by Meta. They came in with revenue of $28.8 billion. That's versus $28.9 billion, which was expected. And they saw earnings per share of $2.46. That's versus expectations of $2.54. Now, what's interesting is despite prior expectations, Facebook actually added more users than expected, daily active users to the platform. They came in with 1.97 billion versus 1.94 billion. But the big problem here, and the reason why you're seeing it down more than 4%, is because they whiffed on the Q3 revenue forecast. They're expecting between $26 billion and $28.6 billion in revenue for the quarter. Wall Street, though, was looking for $30.32 billion, so nowhere near the range that Meta had put forward. This also, by the way, comes just after the FTC announced that they're seeking an injunction against Facebook's acquisition of the company Within. They make a virtual reality fitness app called Supernatural. They're basically saying that Facebook is trying to purchase rather than innovate its way into the VR space. And again, this comes against the larger backdrop of Facebook trying to get into the metaverse and VR as it tries to right the ship with its advertising revenue.
All right, Dan, thanks so much again. The stock off after hours following that weaker than expected guidance coming for third quarter revenue. For the latest quarter, second quarter revenue coming in at $28.82 billion. The estimate was for $28.93 billion. Facebook daily active users, like Dan was just saying, actually beat 1.97 billion. We were expecting a slight drop to 1.95 billion. Monthly active users, though, for Facebook, 2.93 billion. The estimate was for 2.95 billion, so a bit light there. And Rochelle, we're also getting some news about the CFO transition and Chief Strategy Officer appointment there. Mark Zuckerberg naming two key roles in this report. We know that this is something that the street had been expecting for quite some time. Susan Li has now been promoted and will serve as Meta's Chief Financial Officer. David Wenner will now take over the new role as Meta's first Chief Strategy Officer.
I mean, obviously Meta has a lot going on right now. I mean, when you look at where the shares are, they've lost about half their value since the beginning of the year. A lot of investors worrying not just about the health of the core business when you look at some of these other up-and-coming companies, when you look at the rise of TikTok, when you look at the rise of some of these other companies, but also what we're seeing with ad spending also taking a bite. We reported earlier this year about, for the first time, Facebook Meta losing on its ad business side, a lot of investors pulling out of that side. So a lot of this not adding up to much for Meta. And then when you think of this big, huge Met, right there in the name, Meta, betting on the metaverse, something we've still yet to see materialize. It's understandable that we're seeing Meta struggle right now. As you mentioned, look at Meta shares in after hours, losing about 4% there, Dave.
I expected a lot worse. I mean, Sean and I were talking about a dumpster fire here this morning. I thought it would be an absolute disaster for Meta. This is not great. This is not as bad as many thought it would be, in particular that daily active user number. A real surprise given their lack of relevance today. They are hanging on by a thread because, of course, of Instagram keeping them in the game. But look, this is a weird time. You could call it an existential crisis for Meta, really, in terms of, yes, you talk about the metaverse. We're a decade away from realizing any profits from that whatsoever. I think it's still a good bet Mark Zuckerberg is making, but it's hard to visualize. It's so far down the road. In the meantime, it's going to be emulating TikTok, something we'll talk about later on in the program, that they are getting heavily criticized for the most influential people on that platform. But talk about some of the things Mark Zuckerberg said last time they reported, that this is a downturn unlike he's seen in recent history. And a lot of people, there's a bunch of people at this company that don't belong here. So expect some major layoffs coming down the road. Let's get back to Dan Howley, our tech reporter. Dan, anything really jump out as a big surprise to you from this earnings report?
Yeah, I really do think it has to do with the Facebook daily active users. That was something that we've been watching. They had seen their first decline ever a few quarters back, and that was a big blow to Facebook, the actual Facebook app itself. And now you notice that Facebook has been, Meta rather, has been moving more of the emphasis to Instagram. And, we'll discuss, as you said, those kind of the blowback that it's seeing as a result of not really putting itself forward as a photo sharing app, really moving towards the ability to share videos similar to what we're seeing with TikTok. But I think that number on Facebook is really interesting just to see that continue to grow, though obviously it's not by leaps and bounds that it used to be.
And we really want to hear more later on, Dan, about have they figured out those privacy changes from Apple? Still not entirely clear if they've figured out how to navigate those changes in terms of the ad buy. But Dan Howley, good stuff. We will talk more Meta later on, but it's a busy day here. Ford has now posted its second quarter earnings after the bell. Let's bring in Pras Subramanian, our senior autos reporter, to break those down. Pras, what are we seeing?
Hey, man, yeah, Ford shares jumping big time here after hours, both a top and bottom line beat. Let's do the numbers right here. The revenue came in at $40.2 billion. That topped estimates of $34.78 billion. Adjusted EPS of 68 cents, topping estimates of 45 cents there. They affirmed their full year adjusted EBIT guidance, profit guidance there, to $11.5 billion to $12.5 billion. That's up 15 to 25% from 2021. Also, starting next year, Ford's going to operate and report financial results in 3 business units. That's Ford Blue, the traditional ICE business, Ford Model E, the electric business, and also Ford Pro, their commercial line and of operations. Ford's board also declaring a dividend here of 15 cents a share for outstanding shares. Now, it's not all good news. I talk about inflation in the report, saying other inflationary pressures continuing to affect a broad range of costs, now expected to total $3 billion for the year, up roughly $1 billion from what the company envisioned a quarter ago. And lastly, production-wise, they are reaffirming their electric vehicle annual production capacity of 600,000 by 2023, and that they also will be making around 2 million units by 2026. This is reaffirming what they said last week about how they secure materials to make these products. Once again, Ford shares jumping here around 5% after hours. Back to you guys.
And that's interesting, Pras. I mean, we saw adjusted operating income more than triple from a year ago. I'm wondering how this is impacting them and what this means for sort of their broader aspirations as they try and compete with the Teslas in the EV space.
Yeah, so they actually did quite good in the second quarter in terms of production. They actually they actually raised Q2 production versus other automakers who were not able to do so. So, they're weathering the storm better. They did mention last quarter that there was component shortages and things like that, but this is not highlighted here in this report. It sounds like it's all systems go. And from the sound of it, it sounds like the EV productions that they're forecasting are also ready to go for 2023 with new deals they sign in place with LG Energy and also CATL, the big Chinese battery manufacturer.
All right, Ford shares up just around 5% after hours. Pras, thanks so much. Well, coming up with Mark Zuckerberg and Meta under the microscope this afternoon, we're going to dig a little bit deeper into this report. Again, 3Q guidance is what the street is taking an issue with. You can see it reflected in shares after hours. The stock off nearly 3%. More on that when we come back.
Saddle up, friends. More breaking news here on Yahoo Finance Live, and it's regarding Spirit Airlines and its potential merger with either JetBlue or Frontier Airlines. Jared Blickery here to break it all down for us. Jared, what are we learning? There's another shareholder vote. It's been postponed about 9 times.
Yes, it has, and it was postponed.
Losing track.
I know, it's one of those merger deals. It just is. So 4 p.m., they said we're suspending, or we're actually going to take a recess, and they're reconvening right now on that deal. We don't know what's going to happen, but if that vote goes through, there will be a purchase. Now, this is our travel and reopening screen. All the discount carriers are way down here. So we have JetBlue down 1%. They're the potential other suitor. We have Save, that's down 1.5%, and Frontier is down about 18 basis points. This is a 3-year chart of Save, Spirit Airlines right here, and you can see been underwater the entire time, unlike a lot of growth stocks, wasn't able to punch above ever those pandemic highs from previous. So breaking news on this, still ongoing, and we're going to keep you posted.
I know, it always feels like it's still ongoing. All right, Jared, thanks so much for that update. Let's get back to Meta because they missed on second quarter estimates, top and bottom. You're seeing the stock falling after hours, off just about 2%. So coming back just a bit, a lot of that movement to the downside has to do with its 3Q guidance. We have Brent Thill, Jefferies equity research analyst, here to discuss. Brendan, was a mixed picture because, yes, top and bottom lines a bit weaker than expected. Guidance, obviously, a huge issue. But Facebook daily active users was actually better than what the street was expecting.
Yeah, look, overall ad slowdown for the entire industry. Everyone's going negative. Advertising is the canary in the coal mine. We're seeing the overall economy start to slow and advertisers shut spend off on these big platforms. We're seeing it across the board. Facebook, Twitter, Snap, Google was a little bit better, but I would consider Google more essential as it relates to kind of a nice to have on these other platforms. So we're seeing it universally, and I don't think it's going to come to a head in terms of the negativity for another quarter or two. And so look, that the stock's cheap, the negativity is insane. There's really no catalyst for the ad names until the environment finds a bottom, and that is the broader macro environment. And as long as the broader macro environment is tough, these names aren't going to work in the short term. We're seeing even the weakness now filter into other areas of tech, including software, with weaker prints, and we're seeing companies now revise numbers, down. So overall environment is tough for everyone. It's a lot tougher for ad-driven names. And I think, in the interim, dollars are going to continue to move up to Google and the big platform stories, companies that have great cash flow. And right now, it's impossible to forecast what Facebook is doing right now. The numbers have been terrible, and the guide's terrible as well.
So then, in terms of the growth drivers that you potentially see for Meta, where will its strengths be coming from?
Advertising. I think the metaverse is a long ways out. So this is an ad-driven model, and the strength comes from Instagram. The strength comes from increasing monetization of Reels. The strength is going to come over time from these new categories. Unfortunately, these new categories are super early. So, as we've said, they're at a truck stop. They're putting new tires and a new underbelly on the car. They're probably getting a paint job, putting a new Blob Punk stereo in. That's a reference from the stereo I put into my car way back when. But that, like they're totally overhauling this, and we don't know if it's going to come out looking like a clunker or if it's going to come out looking like a Porsche. And so, look, I think we've said this repeatedly. I've covered tech for over 2 decades. We've seen Microsoft, Adobe, great technology companies go into pit stops. You don't know if they're going to come out. Microsoft came from 30 to 300. Adobe went from 30 to 700. They came out of the shop looking good. We just don't know what this is going to look like. I do know that advertisers have said to us recently they're coming back off of TikTok and they're coming back to Instagram. I know there's been some hoopla about the redo on Instagram and the CEO saying the product basically sucks and we're trying to experiment. It's not as where we need it to be. But I do think we're hearing from advertisers the ROI is still one of the best on Facebook, on Instagram specifically. But they're tinkering and they're making some changes. And there's obviously some changes as well as the management team with the CFO transitioning. So a lot of change. But I think patient long-term investors at this multiple will benefit. Short term, I think tech is in a really tough spot for the next six months until we get clarity on what 23 numbers look like.
It's not just a question of what they look like when they come out of this, but when. That mega metaverse is so far off. And to your point about TikTok, we're not going to get transparency there because they're a private-owned Chinese company. Have we got any understanding of if Facebook has figured out the Apple privacy changes?
I don't think anyone's figured it out. I think the walls have been shut, and it's not going to be like it was at any point in the past. But I can tell you that as a Instagram subscriber, like their targeting is as good as ever. Like the data, if you're logged in the data has been incredible, and I haven't seen any deterioration in their ability to target. If you're new or you're trying to bring someone new onto the platform or try to figure out what they're interested in, yeah, maybe. But I can tell you with that username and login, if you're logged in, the targeting on this system is way better than any other system I've used. So I think it's never going to be what it was. Apple has made a choice to become more secure, and it's probably a good thing for consumers. It creates a headwind for Meta. They're working through this. Facebook, Twitter, the rest of the industry is obviously seeing a deterioration in their ability to target. But I think any of us that have been on these platforms for a while, the more information you give, and if you say you're 80, you're going to get articles for bathtubs with doors that open at the floor. I don't want that. I want ads about travel and sports and things that I'm interested in. So I think if we're telling the system accurately what we're interested in, I don't think the targeting's anything better. There's nothing really anything better than what Meta's doing right now. So I think it's a little overhated as it relates to their ability to target. I think the targeting is pretty good. I think the challenge right now is in the advertisers. As you mentioned, users are growing. Users continue to flock to these platforms. That's not the issue. We got to get the advertisers to come back on. And right now, the advertisers aren't coming back on because they're worried about their own business. Advertising is the first thing they shut off. It's a very bad signal for the broader macro economy.
Hey, Brendan, a couple of key executive appointments were also announced in this earnings release. Current CFO David Wenner, he's going to be taking on a new role as Meta's first chief strategy officer. And then we have Susan Li, who's Meta's current VP of finance, promoted now to chief financial officer. What do you make of these executive changes and this new role that Meta has created of chief strategy officer?
I mean, they've already rearranged like 7 of the deck chairs. You might as well just rearrange them all. I mean, they've had so much change with Cheryl leaving, and you've seen so much change. So I think in some situations, like, again, when you go into the pit stop and you're redoing the car, you might as well just shake everything loose. And look, I think we'll hear more about these changes. I mean, I'm seeing this at first blush from you, so this is new to everyone. We'll learn more about this, but I think there's a need for change. There's a need for some shakeup. Bring some new blood into these positions. And look, if you're going to hit the reset button, why not just hit the reset button hard instead of tinkering? Why not just tear out the interior, redo the paint, put the new blow-up stereo in? Do it now. And so hopefully they can get all the change out, get it stabilized, and get the ship going in the right direction. And again, I don't think Facebook is alone. This is not a Facebook or Meta issue. This is a issue for the industry. Twitter, Snap, the rest of the industry right now is going through the same situation. And we're seeing it again in software. This isn't just an ad-driven issue. It's a downturn in software demand. It's a downturn in ad-driven demand. We're going into a tougher macro environment. And again, I think it's going to get a little worse before it gets better.
All right, Brent Thill, always great to have you on. Thanks so much for jumping on here for earnings. Again, Meta off just about 1% after hours, stock off about 50% since the start of the year. A couple of other big movers that we are watching. First, let's pull up Etsy, because Etsy actually beating on the top and bottom lines. You can see the reaction in the stock right now with shares up just about 15%, EPS of 51 cents, revenue up 11% year over year, gross merchandise sales of $3 billion. That was largely in line with expectations. Active sellers and buyers, a slight miss there, although it looks like the street is looking past that. Sellers at 7.4 million, up 41% year over year. Active buyers, just about 93 billion. That's up just about 4%, 93 million, up about 4% here from on a year over year basis. Let's take a look at Best Buy. Shares off just about 3%. The company cutting its forecast for the year on weaker demand for consumer electronics. Now, this coming in the midst of higher inflation, something that was largely expected here as consumers begin to rein in their spending. Best Buy now expects Q2 comp sales to decline by about 13%. Shares off nearly 3%. All right, coming up next, Qualcomm out with its earnings report, guidance weighing on the stock here after hours. More on that when we come back.
Taking a deeper dive into earnings season with Qualcomm shares, looking at them after earnings, they're falling around 4%. Let's break some of this down with more insights and strategy founder, CEO and chief analyst Patrick Moorhead joining us now for more reaction on Qualcomm. So as we take a look at this, a lot of focus obviously on the forward guidance. What did you take away from that?
So listen, there was a lot of good news in the release, but that very important guidance piece, which I think is spooking investors right now, and it's all about the consumer market. Qualcomm, who's a major provider to consumer handsets, smartphones, and tablets, this is the concern. But when I look at that 24% EPS growth commitment for the fourth quarter, that's still better than I think a lot of fabless semiconductors who aren't even as particular about consumer. And it's overshadowing the good news, which was a beat on the top, a beat on the bottom, and a huge announcement where essentially my take is, first of all, extending a 7-year IP agreement all the way out to 2030 to 6G on IP, but an even bigger revenue commitment, which is a 100% wholesale Samsung commitment on the Galaxy S line of SoCs for smartphones and a bunch of other different markets that Qualcomm isn't even participating with Samsung.
Of course, we recently heard that deal, the exclusive chip maker for Apple, at least through the end of next year. And to your point, the handset business growing 59% on an annual basis. There's been a lot of talk about them diversifying. Any news on that behalf here?
Yeah, it was. I mean, they had record IoT and record automotive. The company also announced a $3 billion increase to the auto pipeline that gets it now to $19 billion delivered in the next 4 to 5 years. And that's a huge business. That's a very relevant business. And on the whole, I think the company has, in the last 2 years, is diversifying it, I would say, almost Apple-proofing itself with radio frequency chips, with IoT, automotive, automotive, IoT, and RF.
Patrick, still though, the stock's off just about 18% year to date. What's needed in order to change that momentum in the stock?
It's all about future. I mean, a lot of consumer companies are getting hammered, and not that advertising, I was listening to your Meta commentary, and these are very different tech businesses, but those businesses that investors see as heavy on consumer, they're afraid of inflation. I think we'll get a much better read as Apple announces later on this week. But that's what this is all about. But I think long term, Qualcomm is in a great position. Even short term, at 24% EPS, is better than a lot of their fabulous competitors out there.
All right, great stuff. Thank you, Patrick Moorhead. Appreciate the time today, sir.
Thanks.
Coming up, Meta, Qualcomm, and Ford continue to see a lot of momentum in after-hours trading. Following today's earnings, we'll show you where each company stands at the moment. Next.
Let's take a look at some of the after hours movers that we have this afternoon. Meta, you can see the stock off just about 2%. Now, they did fall short of analyst expectations, missing by a wide margin when it came to 3Q revenue guidance, something that the street is taking issue with. Revenue for the quarter, $28.82 billion, the first year-over-year revenue decline that Meta has ever reported. EPS 246 falling short. Daily active users was a bright spot in this here at 1.97 billion. Let's take a look at Best Buy lowering its guidance for its current quarter. The stock off just about 4% after hours. They lowered their guidance because of weak demand for consumer electronics. This coming amid high inflation. Best Buy now expects comp sales of just to decline about 13%. We're seeing that reaction in the stock this afternoon. Etsy, another name on our radar, shares popping. Look at this, up just about 15%. A beat on the top and bottom lines here for the company. Gross merchandise sales largely in line with expectations, right around $3 billion. The stock up just around 109 here after hours. And let's take a look at Spirit, because Spirit moving on the news here, up just about 2%, ending its merger deal with Frontier, continuing talks with JetBlue. Both Frontier and JetBlue largely unchanged here after hours, but we are seeing the reaction in Spirit, at least for now. Frontier declining to further raise its sweetened $2.7 billion bid for the airliner. This ends one of the most contentious battles within the airline industry in quite some time. And Dave, this is a story that we've been talking about, I feel like, for quite some time. And the shareholder vote was postponed 4 times before this afternoon's decision.
Yeah, the push and the pull between the shareholders and the board is clearly evident and not over yet. I mean, it looks like a JetBlue deal. Their offer is significantly richer than that of Frontier, but there maybe is some bad news here for the consumer. It was thought, at least on the surface, if they merged with Frontier, that was a good story for the consumer. You might save on airfares, and they also claimed that they would create 10,000 jobs if that were the merger. I don't believe that's the case, according to analysts, if they indeed merge with JetBlue, if JetBlue can buy them, which looks likely. Now, there's a whole other side to this. Will the Biden administration approve this deal? Analysts say it was much less likely to get approved with the JetBlue option than the Frontier. And we've seen with the Biden administration, they are not in a hurry to approve mergers and deals of this size. Look at Microsoft and their purchase of Activision. We are still waiting. We have not heard a word on that deal being approved. So this is huge news for the airline industry. Either way, it will create the 5th largest airline in the country, significantly smaller, though, than the other 4.
And I think when you're talking about approval and whether or not that will get the nod from the Biden administration, Rochelle, a lot of that's going to come down with what this would mean for the consumer, like what Dave was talking about, and how significantly this merger could potentially, if they do go with JetBlue, and we do see a merger here of Spirit and JetBlue, what that would mean for the end user, and that would be us paying for these airline tickets.
I mean, and this is a big cut. Obviously, we saw Spirit and Frontier started with these discussions back in February. And then, of course, in April, here comes JetBlue with this all-cash offer that made things a whole lot more interesting, which is what ended up poisoning the discussions, leading to these delays, because it was very hard to ignore this offer. And then they started one-upping each other. So now we're at the point where, at least for Frontier, that's off the table. So now we get to watch and see what JetBlue does next. If this hopefully results in perhaps some benefits for the consumer, obviously that still remains to be seen. There's still a far cry from the big 3 that still dominate the space, but it'll be interesting to watch. Hopefully we'll actually see some sort of progress, and maybe we'll actually see a deal come through this year.
Yeah, well, you can see the streets are at least a little bit excited that they decided to scratch the deal with Frontier, with shares up just about 2% in after hours. All right, coming up, Meta, Microsoft, Alphabet already reporting this earnings season. We're going to break down some of the big reports that we have on deck, Apple being one of those big names. We'll be right back. Meta shares now off just about 2.5% on the heels of its earnings report. Tech editor Dan Howley joining us now on set to dive a little bit deeper into this report. Dan, you were talking about daily active users, a bit better than what was initially expected. Monthly active users, though, a bit of a different story.
Yeah, so they added about 8 million daily active users. At least that's the way these slides are presented. But then they lost about 2 million monthly active users. Now, that's both on the main Facebook app. Now, you may be wondering how you can lose monthly users while still gaining daily users. That's a good question, and we still have to figure that out. Basically, Facebook says that you have to go into their SEC records to see what their definitions are for both of those. But it's certainly worth mentioning because we had seen in prior quarters when we saw the first daily active user drop from Facebook, that was a big deal. And I think we're starting to see, just as you dig through this, getting more of a sense of what Facebook or what position Meta rather is in. And, if you just want to real quick, their margins collapsed from 31% to 29%, while their CapEx from 2021 to 2022 went from 4.7 billion, this is for Q2, by the way, 4.7 billion to 7.7 billion. So they're still plowing all of that money into the reality labs. They said they're going to be pulling back on that. We did see a little bit pull back for that. They had their operating loss for this quarter for Reality Labs was 2.8 billion. That's down from 2.9 billion in Q1 2022. So just a slight decrease, and that's been kind of trending in that direction since Q4 of 2021. So, they're obviously dealing with a lot of issues here. But, I think overall, the big point is that they missed on Q3. And that's what a lot of people are going to be following.
Speaking of issues, one of their central issues right now is TikTok and whether they transition, whether they copy TikTok or not, which is their emphasis on Instagram. They are going with Reels, emphasizing that, and they've been very heavily criticized by some of the most influential people on Instagram, Kim Kardashian and Kylie Jenner. So there was an Instagram post, "Make Instagram Instagram again," that got 2 million plus likes. And then there was a change.org petition to do so, which is north of 200,000 signatures. On the heels of that, the Instagram CEO, Adam Mosseri, puts out a video, oddly, on Twitter, not on Instagram, answering the criticism. Listen.
I need to be honest. I do believe that more and more of Instagram is going to become video over time. We see this even if we change nothing. We see this even if you just look at chronological feed. If you look at what people share on Instagram, that's shifting more and more to videos over time.
Why'd he put that out on Twitter? And what do you make of the criticism of "Make Instagram Instagram again"? How's this going to end?
Yeah, it seems like the kind of criticism is that people aren't seeing what they used to see on Instagram. I think one of the Kardashian-Jenner duo who came out, Kim Kardashian and Kylie Jenner, they pointed to the fact that they can't see pictures of their friends anymore. I seem to remember this happening on Facebook as well, right? It used to be where you would go on there and you would see your friends. When I first got on Facebook, I was in college, so it was just a mess of people chugging Keystone Light. But still, it was people that I knew. Now it's just I don't know who's on there anymore. And so they divided up the feeds now on Facebook where you have a recommended feed, and then you have your home feed where you can see people who are your friends or part of your groups. And now we're seeing this on Instagram where it's definitely changing from pictures of, now I'm seeing pictures of people having kids, getting married, buying homes, things like that. It used to be that, but now I'm just getting, outside of the huge ads, it's changing the look of it to these large box screens where it's taking over the entire display and you're getting more video than photo. And they're saying basically, look, we're going to favor the video, not the photo. So if you want to get on there, you want your friends to be able to see each other, maybe they should put videos on there. So, that really seems to be what they're trying to do. And it is just aping TikTok. But, people aren't happy about it because
they are not.
At the end, they're two different ads. And I think they really draw in two different crowds, or two different apps, rather. And they draw in two different crowds. So I just don't see how Instagram can compete at this point.
It's a big bet that will get them, they hope, to the metaverse. Tech reporter Dan Howley, good stuff. Thank you. All right, some big breaking news earlier today in a 64-33 vote. The Senate passed the CHIPS and Science Act this afternoon. The bill, which provides more than $50 billion to the U.S. semiconductor industry, now heads to the House, where Speaker Nancy Pelosi says it does have the support needed to pass before the president signs it. And the state of Ohio will feel the immediate impact if indeed this bill is signed into law. JP Nasif is the president and CEO of Jobs Ohio. JP, good to have you on. So Intel CEO Pat Gelsinger said his company's $20 billion investment in the state would be delayed without this legislation. So why should the federal government be in the chips business?
Well, it levels the playing field. The chips semiconductor industry is a core industry that feeds hundreds and hundreds of other industries. So this is about America's and the West's competitiveness and our national security. It also has a direct impact on jobs, not only in Ohio, but all over the heartland as more and more businesses reshore and create open and secure supply chains, taking advantage of the Midwest and Ohio's depth of experience and capacity for manufacturing. So it's a national security issue, it's a competitiveness issue, and it's a jobs issue. And we're very grateful for the work done by the Ohio delegation, Senator Brown and Senator Portman, in true Ohio spirit, worked in a bipartisan way to help usher this through the Senate. And now we're hoping for a speedy passage at the House so they can get it to President Biden's desk and turn it into law.
So, JP, if and when this does pass, what are your expectations as to how soon you expect to see sort of the fruits of that really start making its way into the economy and into manufacturing in the U.S.?
Well, we've already transferred the land to Intel. Intel's been moving dirt around and beginning their process to develop the site for phase one of what will become the largest and most complex semiconductor manufacturing campus in the world. And that's according to Pat Gelsinger. Phase one was announced. Phase one is moving forward. We always knew that the pace of phase one would be impacted by the CHIPS Act, but it's proceeding. And we believe, based on what we've discussed with Intel and with Mr. Gelsinger, that phases 2, 3, and 4 come right behind, taking the project from a $20 billion investment by Intel up to as much as $100 billion of investment. And again, it's about American competitiveness and leveraging the outstanding workforce and location and supply chain that's located in the state of Ohio and all across the Midwest.
Speaking of the workforce, JP, how many jobs will be created here? And given the fact that we have this labor market, that we have a shortage of essential everything today and 11 million open jobs, how do you find the workers?
It is a challenge all across the country to find qualified, certified workers to do this. But in Ohio, first of all, the phase one will create 3,000 direct Intel jobs. It'll create 7,000 construction jobs and tens of thousands of other jobs from supply chain companies and other suppliers. The talent's going to come from a lot of different places, and we're working, Governor DeWine and Lieutenant Governor Husted have really been aggressive in how they've been dealing with the workforce issue, along with our organization that's private but works alongside with those government partners. But Ohio graduates 177,000 college graduates every single year. And up to this point, close to half of them leave the state for other opportunities. But as more businesses reshore and come in from the coast and start to invest in Ohio, those students will start taking jobs, co-ops, internships, and the retention of those students goes up quite a bit once you get them connected with an Ohio company. So we know it's a heavy lift, but we're up to the task, and we're finding more and more people are finding Ohio's balanced way of life, job opportunities along with affordability, a great balance for a good quality of life.
And I know a lot of people certainly hope that does tend to be the case. A big thank you there. Jobs Ohio President and CEO JP Nasif. Thank you so much. All right, coming up, thinking about taking in the sun while lounging in a chair by the hotel pool? Well, it'll cost you, and we'll tell you how much next.
anyone who's traveled recently is well aware of the slew of fees that can get tacked onto your hotel bill. But what if you had to pay to go to the pool? According to a new report in the Wall Street Journal, charging a premium to take a dip is a growing trend among the nation's hotels. $200 for some just to have a chair poolside. What do you make of that, Shauna?
You know, it's not surprising. I'm not excited about it because I think if you go to a hotel, then you should largely expect that you're able to go to the pool and not have to pay upwards of $200 in some cases. Bellagio, that's what they're charging for the Friday of Labor Day. So, Rochelle, not surprising. Other side of it, something I'm not excited about at all.
I mean, it's like people need a break. Like, inflation is already killing people. So when you add to the fact that if you just want to lounge by the pool, it's very hot, and now they're charging $200. I think that's, and as you were saying at the Bellagio, you have other places, if you want like a day bed or a cabana, you're looking at about $575 or $1,200. So maybe bring your own towel, lay somewhere else by the side, because it's going to be expensive and probably not worth it. Well, that'll do it for us, but we're going to be back here tomorrow with Amazon and Apple's earnings, so you don't want to miss it. As we can see down in after hours, we'll see what happens tomorrow. We'll be back 3 p.m. Eastern tomorrow.